Blockchain Week Hackathon, presented by the Blockchain Center and Zap.org. Special thanks again to our sponsor, Polis, polispay.org. Please visit polispay.org for more information. Polis Pay, bringing cryptocurrencies to your daily life. All right, kicking things off today, we have a workshop by the Polis team, followed later by a introduction to DeFi by Professor Jamil Sheikh. Following that, we have a money laundering through NFTs panel. You don't want to miss that one. After that, we will have a special interview of Brittany Kaiser, the whistleblower of Cambridge Analytica, featured in the Great Hack documentary on Netflix. Don't miss that one. She's incredible, and we're excited to have her join us for that. Wrapping up the day, we have stable coins and privacy protocols, and that's day 2. So if you like what you see, make sure to subscribe, hit the like button down below, join us and follow us on Twitter, Discord, and Telegram. For more information, visit blockchaincenter.com/hackathon, where you can find info on the prizes and bounties for this hackathon. All right, day 2, let's go. Welcome back. We are going to get started with the Polis team, giving us a demo of the Olympus protocol. Here we go.
Hello, everyone. Can you hear me, Hans?
Yes, I can hear you just fine, Louis. Go ahead.
Perfect. Perfect. So welcome, everyone. We're really happy to be here today, being part of this Blockchain Center Hackathon. My name is Luis Correa. My partner, Hans, is also here, and we come in representation for the Polis blockchain team. I think... Okay, perfect. The presentation is showing. So do you want to introduce yourself, Hans?
Yeah, so we're both members of the so-called DAO, and we'll talk a little bit more about that in just a second, the Decentralized Autonomous Organization. I'm the sub-manager of quality assurance, and I'm advisor to the DAO board. My name is Hans Lohman.
Perfect. So I'm Luis Correa. I'm the current technology DAO manager. It's important to understand that these are positions that were chosen by the community. So we had a voting cycle, a process, and every single DAO manager has been voted by the community. So we will talk a little bit more about the current governance that Polis has and how it will be improved once we get to Olympus. But today we will be happy to kind of show you a little bit of what Olympus currently is, what you can do to start playing with it, and how we can start imagining the future of the blockchain. So Hans, I think you know quite a lot about Polis history. So would you like to get started with this?
Yeah, let me just glimpse a little on the past and where we're going and where we came from. So Polis started out as a fork of Dash, as a lot of small masternode projects actually have. And that didn't actually go without problems, because we're a very small project. We started with proof of work, and that created issues with oscillating difficulty. There were groups that basically came in, mowed away a whole bunch of blocks, then let us stall with a long, high difficulty. So for that reason, we decided to switch to proof of stake. And that also didn't go without all the, I'd say, problems that are associated with that particular protocol. So stake grinding, those things, we've seen it all. And because of that, we're essentially now switching over to an entirely new, developed from scratch protocol that's based on a real cost for bad actors. So yeah, we've been around since 2017 and started as a fork of Dash. And where we're going is the Olympus protocol, and that is what we're going to present in this presentation.
Yeah, I would like to say that we are a community-driven project as well. So we are not, I would say, we consider the whole crypto community as part of the Polis community. So we have created a lot of technology that's open for people for other projects to get listed on. For example, I can tell you about Polis Pay, which is a current application that we have for a bunch of platforms, and that allows you to create multi-coin wallets and so on. And there's like an in-application store that you can use to purchase gift cards and so on. There's Polis Nodes. We support the hosting of master nodes from different platforms. So if you have the time, please check it out. And we recently also got into the DeFi space by listing our Grab token into Uniswap. So those are cool things that you can check out. And all of those are currently support the current Polis blockchain that Hans just described. I don't know why. Here it is.
Yeah, so that wallet that you just saw, maybe you can switch quickly back to the previous slide. That's the Polis Pay app, and as you can see, it supports multi-coin. So it is a fully fledged, fully non-custodial wallet for Bitcoin, Dash, Ethereum, Litecoin, you name it, and of course also Polis. And for the ones that are really wanting to be completely self-managed, it's all based on servers that run on Blockbook. So you can run your own backend servers if you really like to be completely self-sufficient.
Yes, so we try to create that technology that's decentralized and non-custodial as possible. So you can benefit from that from using pretty much any of our services. Okay, so that takes us to today, right? What's Olympus? What's all of this about? So starting in late 2018, I believe, we started redesigning what we wanted for the Polis project in general. So we came up with an entirely new consensus and so on, right? We did not came on to the new consensus on our own. We based our work a lot on what Ethereum 2.0 is doing at the moment. So we ended up with a design that takes proof of stake and secures it with the Casper-friendly finality gadget. So this is the consensus mechanism that guarantees that the immutability of the chain. And it's currently supported by validators. So this is a new figure for the Polis ecosystem because it used to run on master nodes and staking nodes. And now all of that will be kind of combined into a single type of network entity, and that's a validator that is in charge of blocking for blocks and finalizing blocks. And this is the figure or the entity that gets rewarded for those blocks, and it's kind of like a similar process than mining, but the calculation and so on are quite different. So that's one of the key changes that we will face once getting into Olympus. The other thing that's kind of our thing and that we're pretty excited and stoked about is the highly functional DAO on chain. So there's a lot of blockchains that have these governance systems that allow you to fund proposals, to vote proposals and eventually fund them. But we said we looked at what we wanted Polis to be, and as we always have been a community centralized project. And we had this structure of the DAO that elects 5 DAO managers for 5 key areas. We decided to put that mechanism into the chain. So there's, aside from the proposal and so on, you have like specific cycles on chain that you can vote for candidates, that candidates are able to register, to post links to their proposals and so on. And that people can use the chain to get into these documents and vote for the person that's the best for the DAO position, right? So this is all integrated on chain. This will be open for testing in the upcoming weeks on our currently running testnet. So stay tuned for that. And also we try to create Olympus on this openness ecosystem, right? That or this open philosophy as the project has shown up until this point. So this is including modern technologies and so on. We really want to make developers interact with Olympus as easy as possible because we know that that's essentially what gets the whole ecosystem started and going. And we want as much people joining our project as possible. I would encourage you to read our Olympus DAO manifesto. It's currently on our website, www.polispay.org. And there's also a GitHub repository where you can find it as well in there if you prefer that. I don't know if I missed anything, Hans. Do you want to add something?
Well, if you look at what's going on in the world right now, you can clearly see that the decentralized approach of things is getting more and more traction. There's so much going on where we see that centralized systems fail in some kind of way. And that can also be extrapolated even into the way that entire organizations are built. And that is the thing that we set forth with creating this structure of the DAO. And since it's a open source, completely newly from scratch developed system, everybody can contribute to this. And who knows, it might mean something for the future formation of entities, government bodies, or what have you. It's good if it's decentralized. That's what we think.
Totally agreed. And we are really excited for this development. We cannot wait to get to mainnet status, which is stated for Q1 this year. And as of right now, you are free to open our testnet. Most of the communication for this is on Discord, as you will see in a moment. So that's we get to finally the interesting part for everyone that wants to start tinkering with the network right now. We prepared a small repository on GitHub. You can get to it by finding the Olympus Protocol organization, and that's the Validator Challenge repository. I'm just gonna click on this text, and yeah, it's showing the repository. So you can find a bit of a small explanation on what validators are, what's the importance of the validator tracker challenge that we are we have going on today. So yeah, I'm gonna skip a little bit of this part. The thing that I'm gonna mention is that you have a lot of useful information, and this also works as a central point for every documentation or any service that you may want to use during the development of your project. So let's get started. I want to explain. Yeah.
Yeah, keep in mind that basically everything here is developed completely from scratch. But we had it audited by a third party, so the basics of it are found to be secure. And it's not every day that it happens that a entirely new project gets developed, not as a fork, but like something forkable, let's say it that way. So can you tell a little bit what it's written in and why that was chosen?
Yeah, I mean, there's the entry point. There's a little bit about the Olympus documentation, so you can find a lot of quick start guides on how to run a node and so on. So we try to keep this up to date. So if you find any inconsistency, please tell us. But it should be pretty good to get you started. We also have. It's not going back. Okay. One more. There it is. Then we have the current the current implementation for the Olympus protocol. So this is called Ogen, and it's the main implementation written in Golang, so kind of a modern programming language. And you can find instructions. It supports Docker containerization. You can run your node quite fast, actually, even a full indexer node for a block explorer, for example. So this is quite great.
Louis, can you tell a little bit why Go specifically was chosen for this?
Oh, well, we believe that it's a pretty cool programming language, and I tried not to go fanboy all the way in this topic, but it's a pretty cool language. It's modern. It was designed around some optimization concepts, such as having similar performance to what C++ would have. And also being more, I would say, easy to write, easy to understand, easier to port. So cross-compiling is made actually quite easy. So we believe that was a cool decision to take very early on development, and we felt validated as a lot of I would say implementations for other protocols such as the Bitcoin protocol and Ethereum are starting to look into Golang implementations for the protocol. There are some official ones. If you want to take a look at them, check them out. But we believe that it's a good thing for the project to have its main implementation or its first implementation written in Go.
And so it can run essentially on pretty much any platform, ranging from a Raspberry Pi all the way to a big mainframe, if you will.
Yeah, exactly. For different architectures, RISC-V is, I think, supported. The new M1 MacBooks, it's pretty great what you can do with a language that's very portable.
Let's keep moving.
Yeah, then we have the block explorer. You can use this. It's currently syncing to the main chain, but you can use this to track transactions and so on. It's a block explorer, so I don't want to spend a lot of time. We have the Oval Wallet, which is this extension that's running here on the top of my browser. You can install it on any Chromium-based browser. So this is Microsoft Edge, Google Chrome, Chromium, the Chromium browser, and Brave browser as well. So any Chromium-based browser, feel free to add that extension. We will go through that in a bit.
And it functions sort of like a MetaMask wallet, just like people are used to, right?
Correct. Yeah, it's very similar to MetaMask. It's a little bit uglier, but the user experience is an aspect that we will continue to improve in the upcoming weeks and months. Then we continue with the, this is a GraphQL site where you will be able to query the block explorer and the block indexer. So we will go in a little bit more detail with this in a moment. And there's also some GraphQL examples of some pre-made GraphQL queries that you can start trying to test the block explorer and so on. The last thing that I want to mention, and we will show you the process right now, is how to request test police. So there's currently a faucet that you can request some test police to start creating some validators, to start messing with the wallet, whatever you want to do. So I think with that said, we should get started.
This is your chance to actually experiment with ETH 2.0 without it costing anything. And of course, it's not the entirely same thing, but it is a validator approach that starts just essentially now. And it's essentially for everybody.
Exactly. So essentially, we do have, let me clear this. You can download the binaries for Ogen. They are on the repository on the same Olympus protocol organization. You can download the binaries, add them to your path variable, and so on. And then you can start it with this comment. So I'm gonna go real quick through these flags. So we want to enable the RPC interface for the wallet, the proxy. This exposes kind of like an HTTP access for the RPC commands. We also have the RPC key store because we want to be able to create and store validator keys and information to deploy them. And we finally have this one that's, I think it's optional, and I recommend it to most people, that exposes kind of like a web interface dashboard so that you can see if your node is correctly synced and so on. So I'm gonna start the Ogen instance. It will start syncing to the main chain. And then in another tab, I can open, if I hit Ogen help, help, we can see that all of the flags and the commands available. For this explanation, I'm gonna use the console right now. And we are into the Ogen console. So this is the main point where we can start creating the wallets, to start creating validators and so on. So it shows us kind of a list of auto-completion suggestions. Then if we just input the command, we know what we did wrong and we can continue. So if I want to create a wallet, let's call it Test Blockchain Center. And I have to select a password. So for now, I'm going to use the password. So of course, I discourage this use. And I have no trouble showing you right now the private keys because this is only a test wallet. I do not plan or intend to use this. And you can see how when you create a wallet, you get the mnemonic phrase that is related to that wallet. It's important to remember that the password that you choose over here will act as a 25th word for your mnemonic phrase. So keep that in mind. And instantly you get your account, and it's stored in the keychain with this name, right? So if I hit the command list wallets, I can see every single wallet that I have created on this device. If I want to start using a wallet, I can select Open Wallet. I would select the Miami Blockchain Week. Miami Blockchain Week, and the password was Miami for that one. And it tells me that I have opened successfully. So if I get the balance, I have already requested like a 1001 test police for this account. So it's as easy as this. I think my partner Hans is about to send me some coins. So
yeah, let me just send you some. I'm just going to do that right now. And they should be on their way. So you should see some more coming shortly there.
Perfect. So, I think they arrived.
There you go. It's that fast.
Perfect.
So tell a little bit about the block time.
Yeah, the block time is around 30 seconds. I mean, it's always 30 seconds. The proof of stake mechanism with Casper ensures that every block is always created every 30 seconds. So there's never waiting like weird times to getting transactions to confirm. We think that's actually quite great. And yeah, I think that's it. So yeah, this is how you get started with a wallet. You have some balance and so on. But let's say you want to start creating a validator. So there's this generate keys command. With a wallet open, you can tell him how many keys for validators you want to create. I'm going to create 5. So it returns me the 5 keys. And I don't remember the get. validator. Get validators command. Right now it shows me that I have currently no validators created on this interface. So the next thing I can do is like real quick. This command start validator, paste one of the keys that I got earlier, and it will start showing me. I think it needs to get, it needs to get confirmed, and then it will start the validator. So essentially what a validator does is it logs 100 T-polis of your balance and instantly starts your validator. So as soon as it gets confirmed on the network at the next epoch, it will start contributing to securing the network to voting for blocks and to give you rewards for doing so. So creating a validator is quite easy. Hans, do you have anything to say regarding this?
Yeah, you see that this actually works really quickly, and the validators start in essentially a very short time. And in about 5 block times, they will become completely active in the network. And from that moment on, they participate in securing the blockchain by casting their votes. Now, if those validators, if for whatever reason you try to influence that voting principle in a malicious way, your balance that you have in this validator will actually become slashed a little bit. So there's an actual cost to attacks that happen on this network. And that is a better way to secure a network because of the actual cost involved in such a thing. Now, the only way that you get slashed is by doing actual bad things. And we've tested the network for many sorts of situations that can occur. It's only when you actually really want something bad that you get slashed.
Correct. So if I forget what my account is, I can use this command, get account, and you get the account that you use. For example, if I wanted to send anyone some transaction, I would need to add their account in this way and select the amount, and the transaction will be created. So this is what Hans did on his end when he sent me some coins. Something that I want to add is that I think this is the same wallet that I created. Maybe, okay. So we use the BIP39 standard. So every wallet that you create on the that you create on the Ogen instance is able to be created on the Obol wallet. So you will just need to import the wallet, select the language, input your mnemonic key here, and after you input your mnemonic, it will ask for your password. And if you want to have the same wallet that you had in here, you will have to input the same password that you used. So that creates the same wallet. You are able to sending transactions from here to receiving, creating receiving addresses. And you can also, once you have validators, they will show up here. So I think
it works with the exact same very well-known seed phrases. So that way, it's very easy to make a backup of your wallet.
Yeah. So another thing that you can easily do is with this account, if you want to get started playing with this, we have a Discord. We currently have a Discord channel where you can request some coins. So I'm gonna open Discord here for a bit so I can show you the process. So I'm gonna go to Olympus request coins. You can very easily oh, I forgot T-Polis. Yeah, and paste your address, and the bot will send you some coins. Right now, the bot is telling me to go fund myself elsewhere because I already requested some coins today, and it has a limit
of 1. To break it.
Yeah, so it's limited to 1,000 T-Polis per day, but you can request as much as you want. There's no limit other than that, and that would be enough to get you started with a new chain. With some T-Polis.
You can run as many as 10 validators from that right away. So that's a fun thing to get started with this.
So another thing is that the same things that we did over the RPC console here can be done over HTTP. So this enables you to use any language that you want to interact with your node. I want to say here we have in the. I think I missed that. Sorry. Yeah.
Yeah.
So if you download
Go ahead.
the Ogen repository under the API proto folder, there's like the documentation for the HTTP documentation for the RPC commands. So if you have any doubt, please check this resource. The documentation that's linked on the repository also works for this purpose. And the thing is that we would just want to show you that the same commands work. So here's the one that opens the wallet. Here I have that it was opened successfully. If I want to generate some validator keys, here I have them. If I want to get the validator list for all of the validators in the network, which currently are over 1,500, I can do that as well. And pretty much every single command that's listed here, account validators, here they are. So pretty much every command that's listed in there works both on the RPC console and over HTTP. And you can start building some services using the HTTP interface for this.
Yeah, essentially any language that supports curl, even like archaic stuff like PHP, can very easily interface. Just do a post or a get to your local host, port 8081, with any of those commands that Lewis has just shown. And you're just off to the races. You can do anything. So I encourage everybody to explore all those commands and just play around with this thing. It's really easy. It's real fun. I've personally built a little flooding system to just do some transaction testing. I have not been able to flood the chain just because of lack of processing power on my VPS. So it's really powerful. The thing is able to cope with lots, and I encourage you try to break this thing. That'd be very helpful for us.
Amazing. And I think the last thing that we wanted to show you today, guys, it's a little bit, it involves, okay, so far the methods that we have shown you to interact with the node require you to set up your own node, and maybe you don't want to do that or don't know how to do that. We encourage you to read the docs, and it's quite easy to set up a node, especially using the Docker containers. But for those of you that do not want to do that, we have some public nodes that you can consult. So these are both the explorer.olympus.tech, well, Oli. It's currently syncing, so we are at around block 40,000, but it will take some time to sync. But in the meantime, you can start using this other one, which is the indexer, indexer.oli.tech. And here is a GraphQL kind of playground that you can use to design queries, to request information from the nodes. And this is quite easy to integrate with modern applications, with JavaScript, with if you want to develop for iOS, for Android. This is a very cool framework that allows you to request only the information that you need. So you can, for example, let's say I just want to get the block height and hash, and everything else, it's not important because I'm showing like a very condensed card that only shows the time slot. So I can modify the query, and I can request and receive only the information that I need from the blockchain without having to deal with large responses that are in JSON format. So this is very cool. So you can this playground includes some documentation of some queries that you can try on the information that you may get out of them. So the documentation that we shared also includes a link to this specific playground where you can play with those that I have already created. But we believe that this is pretty cool, that it will allow blockchain development to
I think we're starting to run towards the end of the presentation, Lewis. We're starting to get out of time. So there's lots indeed to play with, and I encourage everybody to really take a close look at this. There's big plans. One of the things that we're looking at is going to implement a Ethereum virtual machine, So we can run Solidity compatible smart contracts on this, set up entire DeFi environments and all of that cool stuff. And you can already start playing with this stuff because the testnet is 100% compatible with the mainnet. So we're very close to launching the mainnet officially and building everything on testnet so you can rapidly deploy it on mainnet.
That's correct. So this is this has been pretty much the technology that we think that will help you to get started with the chain. We really hope that you enjoyed it and that you are interested in exploring this by yourself. We believe that there's some pretty great things that can be built with this. So yeah, I'm gonna return very briefly to the presentation. Okay, so here's like a small roadmap for Olympus that we have right now. So we are targeting a Q1 release for Olympus. Of course, we are still working on the concepts of hardware wallet support and fixing the things that were found by the audit. So we are pretty close to achieving that status, and by the end of Q1, the Olympus mainnet should be launched. And then after that, we are planning on adding token support on Olympus. And of course, by the end of the year, we will have like the support for those tokens on mainnet. So this is quite. I went through that pretty quickly. If you have any doubts, please feel free to join our communities on Discord. The repository that I linked to earlier has all of the links that you need to get started with the project and to join the community. And we will be happy to help you on our Twitter accounts and everywhere that you may wish to contact us. So I guess that's all. Thank you from my side. Have an amazing hackathon. And Hans, you want to say something?
Yeah, thank you all for joining us with this, and I'm very excited about all the options and possibilities. We don't every day see something get developed completely new from scratch. I'm very excited about it, and I'm looking forward to all the beautiful things that we're going to build with this.
Amazing. So thank you guys, and see you. Hopefully I'll see you in our community.
All right, thank you, Polis team. Next up, we have a panel of 4 experts discussing the current state of the retail and crypto investment markets. Take it away.
Good afternoon, everybody.
Hello, hey guys. Hello.
So what are we talking about today?
Crypto and the quality of that microphone.
It's pretty cool, isn't it?
It's a solid mic.
Is that part of that old school vinyl setup?
Come on now, you're jumping too fast into it, Ari. We're going to plug my other side projects later.
Hey, don't feel bad. My vinyl's literally right next to me right now.
All right, maybe we could just talk about vinyl for an hour. That works for me. No, come on. People want to talk about crypto. How's everybody doing? How are you, Constantine?
Top of the world.
Well, I don't think anybody's going to be running this, although Ari kept raising my hand. But I'm happy to jump in if you guys like it. Throw some ideas out. How does that sound?
Sounds perfect.
Sounds great.
I think loosely what we want to talk about is institutional and retail crypto markets. That's a pretty broad topic. We could speak for a couple hours, I guess, if anybody's still listening. There's a lot going on in the space. Does anybody want to jump in and give us your view on what's happened since Jan 1 for starters? How's that sound?
Yeah, I'm happy to hop on in there. Constantine, if you wanna jump, by all means.
Yeah, and go ahead, and then I'll add. I just presented this similar topic like yesterday on the other conference. So yeah, so fresh.
I mean, in particular, the retail markets, just in general, whether it's crypto or otherwise, are in a series of upheaval at the moment. I mean, especially if you're following what's going on in the retail markets, just traditionally with Robinhood and such. From our perspective at Republic, one of the big things that really caused a lot of the upward velocity in the retail markets in particular was OCC approving banks to be able to custody assets, right? I mean, most of the run up, whether people realize it or not, has been almost entirely driven by institutional access. And institutionals, for the most part, didn't have access until that judgment. Most hedge funds, pension funds, private equity groups, their charters prevented them from participating in most of the crypto upside because they couldn't participate in assets that could not be custodied and could not be insured. And that judgment in the middle of December basically changed that entire landscape. Now you see a lot of funds taking, maybe a 5% AUM exposure to the crypto markets, most of which is Bitcoin driven, just because they have to. I mean, you just kind of look silly if you don't have at least a little exposure to it. So, I know from the Republic side and the institutionals that we work with, I mean, we were seeing absolutely huge buy orders, 100 million there, 200 million there. I mean, really to the point that it just wasn't enough supply. And that's kind of what really caused this huge run up that really seemed to have no end to it until most of those funds got the exposure that they needed. There's going to be another round here as the capital calls take place in Q2. But I think that's really the fundamental aspect of what's driven the markets here over the past month and a half, 2 months or so. So really interested to see how that shakes out further, especially as these capital calls come on, and as well as some of the difficulty increases in mining in the near future as well.
Yeah, I think also to add to that, I think to go back to when that occurred, not only is it that one event, but as you pointed out, right, there has to be this enabling for the institutions to come in. Unlike a retail participant who can operate on their own volition and decide how to allocate very quickly, when you are an institution, you've got an entire wrapper of regulatory, legal, and customer arrangements. So this is going to be something that, with institutions participating, that is going to be a long, ongoing process. There are some institutions that are coming in. Many of them are probably thinking of themselves as front-running the next group. Not front-running in a bad way, but anticipating where the ball is going to go to next. If you are an institution, you've got an entire infrastructure that has to be changed. This is not stuff that happens overnight. Even if you are what is considered to be a very flexible operation, like a hedge fund, you've got a mandate, the legal documents that you've sent to your investors stating what universe of strategies and assets that you're participating in, what custodians you're using, what service providers you're using. All of those things have a huge impact on what your ability to do things are. And that's not even getting into conservative entities like pension funds. Endowments have actually been rather forward-looking in this. Family offices are usually very forward-thinking and have significantly more flexibility. But there's a lot of paperwork that has to be done for existing institutions to actually move this over, which means that this is a potentially long process, which is good. I mean, that's something that's going to sustain us going forward for a long time to come, as this rolling even 0.1% or 0.5% allocation to crypto hopefully continues.
Sounds like it's great news for the lawyers, Ari.
It always seems that way, doesn't it? Yeah.
They were the only ones winning during a winner. It was their lawyers' market more so than anything else.
Constantine, you want to chime in?
Yeah. Well, I guess maybe it's not like that fresh of an information. But I guess it started from an interesting survey that to me, like from Fidelity Digital Assets, like where they did a survey of 774 different investors, half from Europe, half from US. And what's the highlights of this story was that 1/3 of them, actually 36% of institutional investors, they currently invest in digital assets. So the entire narrative, like the entire, like, the necessity, like, of allocating, as my colleagues and Ari were saying, like, that's no longer an option. Like, I tend to say, like, it's very simple. Like, and if you're a CIO or a CFO of an organization, you're allocating zero to digital assets, you're going to be fired. It's very simple. So, and right now the perception changed, which is also interesting. That before, a lot of investors, they were quite negative, even though they had to like learn about it. Now the 60% of the people are actually have neutral or positive perception. Then the appeal to just even building the infrastructure, 80% of the people are saying that all the banks, all the technological players in the market, whether you are a payment processor, whether you're a custodian, whether you are a clearinghouse, or like all the people are now building the infrastructure. So that changed, like I think the categorization, like, and the mindset of the people, they are getting more and more educated now. Like people are starting to understand the difference between the cryptocurrency, like just utility token, a stable coin, or a central bank, like digital assets. So yeah, and that I think is important. And I guess I'm more excited the last days, like what is happening, like, in the other part of the world. I would say the Wall Street bets and the crypto punks who are crushing the the little guys, as they say in CNBC, that are crushing the bigger guys on Wall Street. That is, I think, really fun to see. Elon Musk, Alex Ohanian, like, Jack Dorsey are using hashtags in Twitter, like, Bitcoin, and the price has surged like 20 to 25% in one day. That means not only institutions, but also retail folks are uniting. I think consolidation of efforts is another trend, and a very important one. People start to get it. People are using it as a tool to demonstrate their unique position and their unique choice of where they're going to allocate their assets. And I think the fact that we're doing it as a one unified entity, whether it doesn't matter whether you're just like having some fun to do it on Reddit, like subdomain, like named Wall Street Bets, or anywhere else. I think the fact that people are starting to wake up, I think that's an amazing trend by itself.
I think it's a very, very interesting topic, especially, right? We're supposed to be a panel of experts, right? And there's this whole thing. One of the themes, right? There's this. It's such a rich topic. You can take whatever you want out of, the whole GameStop situation, and it's But one of the themes is what makes an expert, right? Because I think there's a lot of things, like you said, like one takeaway that I hadn't gotten was exactly what you said. So I like your call for unity, that we're all together on these things. But I think
Are you running for office?
What's that?
Are you running for office?
Yeah, heaven help us. So I think that the whole expert versus non-expert thing is particularly, I think, poignant, because one of the takeaways that I don't think has quite really been appreciated is, probably going to piss somebody off, but man, how bad the so-called expert was at their job. And the reason why I say that is, by the way, not because money was lost. There are plenty of times that as a trader, you make a bet, you lose money. That's what it is. But to take a position that is so large and do so for those that may not, I'm sure, are at this point familiar, but there's a certain amount of shares outstanding, and the amount that was shorted was a multiple of the available to actually get. So essentially, they painted themselves in a box because there was simply no way that they would realistically be able to cover very easily. And they were putting themselves at great risk at a time when the stock was actually extremely low. So that's why I say they were so extremely bad at their job. And here the so-called, non-experts found that out and exploited that and really put it to the so-called expert. And it's kind of interesting that, to me anyway, that whole dynamic of expert, non-expert, holding office, not holding office, and so on. I'll leave the rest, but but I think that's very interesting in the context of crypto and decentralized and centralized exchanges and so on.
Well, that really becomes heavily exasperated with a group like Milton, because Milton Capital is really a cornerstone institution for due diligence on Wall Street. I mean, they have hundreds of copycat funds that follow them that don't have the ability to produce the same level of diligence from an engineering or analyst standpoint. So, these other funds, maybe in the hundreds of millions, just simply follow the moves that Milton's doing. So there's a cascading effect here that's taking place from a failure at an institutional level, up at the top. I think that the greater thing to keep an eye on, and I think this is going to be a huge tilt of the hat towards blockchain and decentralization, is how fast these institutions that were providing retail support were shut down or brought down, whether of their own design or not. One called a Ameritrade down, one called a Discord, Wall Street Bets down, one called a Reddit, and there's interruption service on Wall Street Bets, and the list goes on, and obviously into Robinhood. So the motivations of that decision we still don't fully understand yet, but I think this is just going to lead further into the decentralization conversation, where you can't run into that, where you can't shut people out, you can't shut community or retail out, or even institutions in some instances, right? And I think there's just an inevitable crossroads that we're coming to, and this is the type of event that expedites it, right? Just like COVID, for the most part, expedited a variety of things in the crypto landscape, right? And obviously, no one wants a pandemic, but I mean, it really pushed the industry forward probably 3+ years in a very short amount of time, which for crypto is a lot, right? A year in crypto is like 20 years in almost any other industry, it feels like. So to be able to catapult herself 3 years forward, and then have events like we have happen this week with GameStop and AMC, and the retail fervor and individual retail power, is going to, again, I think, kind of leap this thing forward. At Republic, we're really known also from our crowdfunding perspective, right, where our whole mantra is the democratization of finance and access, and we've been pushing that for a long time, and even very much from a legislative perspective, is now we've been able to increase the Reg CF limits from 1 million to 5 million here starting in March, and you're going to start to see more of that democratization and retail unaccredited access. And what we're seeing at GameStop just furthers that narrative that there's a lot of power behind that, and a lot of interest, and it's not going to stop growing at this point.
If I may, or go ahead, Danny.
Please go ahead, Connie.
No, I think it's just generally exciting topic, because you see, we can go ahead and talk about like something like BlackRock, right? One of the biggest asset manager in the world, with almost like $9 trillion joining the game, like spearheading like the application into SEC for their like 2 funds to have a derivative play for futures, to essentially, like, again, I'm not going to criticize them, but essentially to potentially manipulate the market the way they do, like in a traditional world. So it's a good thing. Like, I guess actually it is a good thing. So when we talk about institutional adoption, there is this mantra that because there's a new flow of capital and the market cap will grow in crypto, that that will change a lot. That will actually become introduce the stronger perception in the market that the market cap is bigger, then hopefully volatility is even lower, and people have more confidence, blah blah blah. Maybe if it's over $1 trillion, the ETF will be accepted, and then we're gonna have like
2 trillion.
Huh?
She said 2 trillion. That was her number.
Okay. Well, 2 trillion, whatever. Like I think there are numbers that
Trillion here, trillion there. Pretty soon you're talking.
yeah, it will
You
go
can have
there
one,
anyway.
you can have two.
Exactly. So I think it's all realistic. The thing is, what I'm more concerned about that actually now, like small guys, like as they call the retail investors, they have more edge. So we like as a community, like the smaller investors, they have better opportunity to actually have the voice. To have to vote with their capital in the projects where there is a governance opportunity, and especially in the truly decentralized applications, they have an opportunity to actually impact the direction where the project is going, because there is no owners, there's no shareholders who want to squeeze you. There is a common desire to grow and to become something bigger, to implement those, I would say, not idealistic, but realistic ideas to make it cheaper, faster, and better for everyone who are using the particular chain. So, and the bigger the game will become, the harder it will be actually for the smaller guys to have this edge. So, not to say that there's pros and cons in every strategy, but I guess right now is a beautiful time that we have to appreciate. It's a moment in time and space where it's still pretty early. It's still early adoption, and we, like a lot of folks, have this voice, and we have the opportunity to see those beautiful moves. Later on in crypto, it will mimic more and more traditional markets, and it'll be harder.
Agreed. Constantine, if I could just follow up on that last point you made. We've touched upon a couple of topics. There's democratization. There's unity. Thank you, Ari. We're all feeling more unified.
Well, that was constantly.
I'm feeling more unified now. There's the idea of the different dynamic in terms of how much retail drives, and that's the whole retail community, versus how much the institutional, this latest new larger wave of FOMO money coming in from Wall Street, how much that's driving and changing the ecosystem, not just asset prices. But if we talk about where we're at and the role of these different segments in the market, what I'm curious about for 2021 and beyond is DeFi. DeFi is, I'm not going to lie to you, 8 months ago, I couldn't even spell it. I didn't know what it meant to me, to the firm I was working for at the time, to my clients, to the ecosystem. I hadn't given enough thought, hadn't learned enough about it, and still have a lot to learn. But just look at what has occurred in the space just since last spring, and you start to see the emergence of these players that are getting more investor capital. And mind you, that's crypto native funds, but that's who should be going. And people who've done their diligence understand it and understand the risks, and also want to foster the growth of each one of these pools and of the entire system. What's interesting to me is, where do you guys think we'll be in a year in terms of broader adoption? And I don't mean a BlackRock playing in DeFi. I mean just broader levels of adoption as you go up through the different strata, from pure super cypherpunk to mid-range, kind of crypto native, and then beyond.
Are you asking from a speculative asset nature, or are you asking from a technology deployments perspective?
I'm actually interested in both. I think the latter part's more interesting, because if you spend enough time, and I've been fortunate to do that over the last couple of months, trying to understand what does DeFi mean in the long run. Those pools, those protocols, these new models and platforms that succeed and are truly innovating, then you start to think about what it can mean if you really, it's not so much replacing today's legacy financial services infrastructure and markets around the world, but innovating and permeating those markets, and those innovations becoming available to a much broader range of clients, of industries, of players, of firms. I actually think it's going to accelerate faster than a lot of people realize, just based upon the value of these innovations.
Yeah, I can tell you from the Republic perspective, our advisory arm is probably the most pronounced in the space, and not only do we work with the startup side, but also the institutional and enterprise side. Without a doubt, it is explosive. I mean, the amount of enterprise companies that we're working with at this point, Fortune 500s, every single person or every single Fortune 500 company at this point, if they don't have a blockchain department, it's on its way, right? And that's a big part of the often discussion. So, and a lot of it's really exploratory, which is really interesting, right? Like, we know this is interesting. We know we need this. We're not sure how to implement it yet. Whether that's, and I won't name specific names, whether it's large insurance firms or huge retailers, sports franchises, these are all people that are rolling this out already. And if it hasn't been deployed, it's going to be deployed, within 12 months, some type of solution. Constant POCs. I mean, we probably see a dozen plus institutional POCs a week are requests for. And then beyond that, you start looking at central banks. Every central bank on the planet at this point has a digital department or digital asset department. Figuring out how to use it, how to work with it, how to protect themselves. So I think for the most part, probably the standard retail individual doesn't have exposure to that. They don't see it. But I can tell you that it's prolific at this point, and it's much farther along, I think, than most people realize.
I'd even add, I think that's a very forward-looking and very valuable perspective. Even taking a step back into what one might not think about as being strictly DeFi per se, but I think crypto has, because of the way that it came as sort of its Wild West and sort of outlaw sort of reputation, forced it into a number of things that created a lot of innovations. So that sounded very fancy, but what do I actually mean by that? People talk a lot about prime services, and especially for people that come from traditional finance, they go and they look and they say, oh, we don't see a prime broker in the way that we saw it over here. And you know what? That's true. So the question you have to ask is, why? Right? Is it because there's an insufficient demand for it? Clearly, people know what prime brokers do. They understand all of those things. Certainly, there isn't necessarily a big balance sheet that has stepped in to sort of provide a whole lot of things. But on the other hand, there is a lot of leverage and in the market itself, right? So when you go to a lot of crypto native exchanges, you can obtain a lot of leverage. Well, a lot of the reason why you go to a prime broker was because you wanted to get leverage. A lot of the reason that you might, as a trader, be at a bank or be at a proprietary trading firm was because what you wanted to avoid is, you were fine taking the risk. You just wanted to really make sure that when you walked away, you didn't like lose your home, your neighbor's home, and the home after that. In other words, lose more money than you put in. And having these various institutions enabled that because they covered it, and for a variety of reasons, which aren't worth necessarily going into. But that sort of infrastructure is out there. I can go over, maybe not me as a US person, but one can go onto an offshore type exchange, offshore from my perspective, not to others, but to one of these exchanges, participate, and should I get liquidated, it's no harm, no foul. That's part of the game. I'm still welcome back as a customer. That's fine. I got liquidated. It is what it is. And everybody's fine with that. If I did that at my futures broker and I put in 10 grand and I lost 20, they're coming after me. So it's a very different dynamic. Obviously, in the case of some of these Bitcoin native exchanges or other native exchanges, they aren't going to allow you to just lose that money. They will auto liquidate you. But it seems to be what I might call a DeFi prime broker or this distributed prime broker. It's a lot of the same services that are out there. So I know there's a lot, when people talk about DeFi, it's very exciting. There's everything from Uniswap to just people going to blockchain and so on. But even on sort of more of the vanilla stuff that we're all used to, I think it's unrecognized how much distributed finance infrastructure there is out there.
Yeah, I guess I might add a little bit because we are right now actually actively looking into some of the yield farming strategies, and we're looking to probably roll out a product like a fund that will be yield farming like product. The reason why we we sincerely had a conversation internally, like we have cover call option strategy where we piggyback on the volatility of Bitcoin, and we pay 1.5% premium, basically like a fixed income like product like per month, and then on top of it, sometimes it's much more. So and then there's alpha on top of from the trading. We have a whiskey product where we tokenize whiskey distillery, so just an STO game, which is just fun, like, and maybe later on we're gonna grow bigger. Maybe we're gonna list on Republic. Who knows? For now, we've signed a letter of intent with INEX. So we have wealth management arm, we have VC arm, and we realize there's one product that we as a firm, like as Way Financial, we haven't tried yet because we're so caught up with other things, but everybody on a side, we're investing individually into the DeFi space, which was ironic. Like I'm sharing right now something very personal, like, which again, I'm not sure I have to do it like online, but we don't have a lot of users, so whatever. The idea was beautiful because we saw how is it also like possible that the several layers of yield is unlocked. I think that's the beauty of democratization. Like, if the bank, even if they had good intentions, they're not able to pay out even 8 to 10% APY year on year, just not able because there's so much costs involved into other operations. The smaller guys who are redistributed, they have like small costs also to run those yield farming or AMMs, and they have an opportunity to redistribute the wealth among the users. So which is, I think, just by itself, it's a beautiful concept. Like it's innovative, and not only innovative, but it's also lucrative for a lot of players. And in time, we're going to see that the yield will come down. So it's going to stabilize, and it's not going to be so crazy amount of money. But there's right now, you can go to Chainlink, you can go to Synthetics, you can go to Aave. I mean, you can go to a lot of Compound, and you can make just 10 to 20% per year, like in stable coin, which is insane amount of money if you consider that in some of the world multi-billion economies, they're not like the inflation killed all the economies, and it's negative rates on any investments, if you're talking about bonds or anything so at the same time, the smaller projects that are managing merely hundreds of millions, the entire I did a note here, like the entire total value locked in DeFi is projected to hit $50 billion. I mean, it's minuscule if you compare to the global market. Right now, it's 25.
Yeah, I think barely 25 now, right?
Yeah. So in DeFi Pulse, you can actually track this information. It's public information, and I mean, and that is impressive. You can actually audit at any point of time if you want any of those organizations. Like you don't need to wait for quarterly report or yearly report. I think those are aspects that are just impressive. We're now seeing slowly but surely a shift into more transparent and more democratic finances.
Yeah. And one of the points that you make there, I think, is kind of the sleeping giant on the institutional side is once some of the larger institutions understand some of the additional financial mechanics associated with some of these crypto assets, and this is a question that we answer fairly regularly for those guys, but understanding things like yield farming and staking and areas where you're able to make additional alpha or beta points on those assets beyond just potential upward price velocities. And the more and more they start to understand that, and the more and more that there's infrastructure built that they can leverage, they're not going to build it themselves generally, right? They're going to look for services that can offer that. And there's like a gold rush right now of people building out that infrastructure, which is great. I think as we start to see the institutions more and more have a better understanding of how that works, what that looks like, what the risk profiles are associated with it, and the actuarial guys then having to build out like understanding, all right, locking up liquidity for X and what is the long tail value of that versus not having liquidity. Eventually those formulas are going to be put together. And as that starts to come together, long term, I think you're going to start to see the landscape change quite a bit. And it will be really interesting to see what happens with the overall access and liquidity of the general markets when the value of holding the assets continues to increase, or at least stabilize from that perspective. So I feel like that's kind of like the sleeping giant that hasn't really woken up just quite yet. I know in how we manage our treasury, that's a big conversation. And we're starting to translate that onto others.
So I'll fully step forward and say that I'm not, intimately familiar with a lot of these yield farming strategies. You've definitely piqued my interest, but in a world where, as you pointed out, there are negative interest rates and so on. What is it that they are doing that they're able to return 10 to 20% to the investors? And related to that, is that coming back? Are you talking about you put in a stable coin? Are you receiving the yield itself as in a token, or how does that work?
Yeah, normally it will work USDC or USDT depending on what platform are you talking about, and then you have native tokens like in some of the, depending on there are 3 different types of stable tokens like DAI, compound, like you have depending on the collateral. One is like I would say something like simple, like really simple to understand. USDC, USDT that is pegged 1-to-1 to dollar, right? So it's collateralized by dollar. You have other synthetic like stable coins that are collateralized by other cryptos, which is more complex to explain, and we will not have enough time even to have this conversation. But and some others, they may be collateralized with other assets, right? So it may be even something real, like let's say by gold. There's those projects that are rolling out, or a basket of different currencies. Like if you remember the Libra, like they were trying to collateralize their token with 4 different currencies. So multiple different experiments. I call them not only financial but socioeconomical experiments. So this is number 1. Number 2, the way they can achieve so great returns is again because their cost of running business is so low. So if you think about like how much you need to pay out, like in salaries and supporting the infrastructure, like all the expensive servers, like renting buildings, everything, the cost of running a bank is huge, so and plus they take a lot of the profits, it goes to the C-level executives, like and there's cascading towards the smaller guys who are just not ripping all the creams, they're just getting what they're getting, and in this particular model, like if you think about it as a principle, right, 20% of the efforts and 80% of the like reward and results are coming. That's in practicality how it works. Sometimes it works even 10 to 90. So the automated market makers, they're actually redistributing the wealth between the borrowers and the lenders. Like they are redistributing the opportunity to make money with them. So they share sometimes like 90 to more percent of the percentage, like with the people who are actually lending their tokens. So you can deposit USDC or any other. You can deposit Aave, you can deposit Chainlink, Cardano, like any other like token, and there is a different. Sometimes it's floating, so there is no fixed rate. Sometimes that's another element that you have to take into account. But the beauty of it, if you don't have a lockup for a quarter or a year, you can even take out money whenever you want, which is another beauty. Like, and it's fast. It's easy to understand what is happening. There's a risk, obviously. I think it's just, and I will stop for here because I'm getting too excited. So, impermanent loss. There is another. Yeah, it is permanent loss. That's another important risk I would want to voice out, because there is a topic that, yeah, you can have 10% yield, right? But if the price of the token actually goes down 20%, then all your yield is eaten up. But the question is that, if you're a believer that's in time the price will actually go where you're expected to go, it's still lucrative because you have an ability to have the yield in the native token. If you're a non-believer, just use stablecoin. It's 1-to-1 to dollar. Yeah, you will have a smaller yield. Let's say it's 6 to 8%. You can use platforms like Nexo, like Celsius, like BlockFi, or Voyager, yeah, a lot of other platforms.
Voyager pays 8.5% annually on USDC. Just holding it in there.
So that's a good point. So what you're saying is you're going to go put it on these other platforms that are acting as a bank. So now you've actually, you've introduced credit risk.
Yeah. Correct. Well, yes, a format of that. Yes. Yeah.
That's right. They are acting as banks. Effectively.
It is credit risk because you don't. It's I understand the AMMs. They are providing a service. They're doing it in an automated fashion. They're not going to be perfectly efficient, but they return a lot. And just in general, that's a good business. So they provide a service and they distribute that, and it is what it is. I get that 100%. But when you're like, what I'm interested in is trying to figure out, like, or the reasons that these returns are there is because they're taking what might be available as a 2% return and then, leveraging that up on the back end so that if there is something, some sort of hidden tail risk that we're unaware of, does that come and bite you later on? But because it's a low probability event, might take a year or 2 or 3 to evidence itself. That's what I'm trying to understand on the back end. I know that many of these firms are well run, and that's for sure. But even at very highly respected places, these are still relative newcomers. There aren't audited financials and so on. So that's what I'm trying to wrap my head around. I don't really, for instance, with Aave, I really know very little at all, or what Compound does, or what happens on the back end.
Yeah, Voyager is interesting to look at because they are a public company. So there's, quite the paper trail associated with what's going on. A lot of the times it's really lending into liquidity pools. It's like the big piece of it generally, where you have either traders, institutional, otherwise, that need access to short-term liquidity like immediately, and it's like a bunch of microloans are just taking place on an automated fashion at high cost, right? But high cost and a high cost to the user, but a low cost to the institution that's providing it, right? And that's what's causing kind of these higher interest rates than that we'd see. And this is kind of what Constantine was kind of alluding at, is these larger players have the ability to do these micro lendings into these liquidity pools that doesn't cost them anything to do. A lot of it's done in smart contracts. It's all automated. Like all the bookkeeping components, there's no legal fees associated with running these types of contracts. So they can charge, say 10% on the money, pay out 8.5% to the liquidity provider, the individuals providing the tokens, and then, eliminate most of the risk since it's all done in an automated or smart contract fashion. So
clearly it's a super efficient model for a lot of people in space, and the evidence is there, and therefore, and thus the growth over the last 2 years. And it's just such early days. I mean, it's not for everyone, but I think the evidence is there that it's a very efficient model.
and needed. You know, if you look at major market makers in the space like QCP and Amber or Grapefruit or whatever, they rely on those liquidity pools in order to orchestrate a lot of what they're doing. So that's only going to grow, and especially as the assets grow, right? As more and more assets gain more traction and more notoriety, whether that's from a engineering perspective or from a speculative trader perspective, those pools are just going to become more niche, and with that more expensive, right? So there's a lot of interesting processes where you can do that yield mining, and if you have a diverse portfolio, you can really spread that around. And this doesn't even involve things like staking and governance and other aspects of the ecosystem where you can be involved in also kind of making this, right, and being a more active player. So this is what we're talking about here, is a very subtle, non-participant, set it and forget it type of situation. So like, again, I do recommend take a look at Voyager. It's actually a great product. Coinbase competitor. Their iOS is great, but yeah, they think they pay 8.5% on USDC, like 6% on Bitcoin. Again, if you just have your Bitcoin, with them as a product, you get these annual returns. I mean, you could run a fund and just have, if you just got 8.5% on a $20 million fund every year, I mean, everyone will love you. So it's again, this is kind of this shift we're going to see, and as the institutions get more and more understanding of how to leverage these tool sets, I think you're going to see a lot of changes in the space.
Yeah, and I can add to that, like, we have even better rates than a lot of those folks, just because we serve some of the crypto whales, so we can get some of the institutional rates from the providers that work with those folks, so that's why, like, we bypass everyone in this context, right? So but that's for the bigger ticket size, so that's and for the smaller folks, what is amazing, and I think Andrew touched upon this a little bit also. So something as Uniswap, for example, or like Balance or Curve, you have hundreds of different coins that are listed there, have different pairs, you can instantly swap the tokens, and the fee is minimum, that's very low fee. And I think, like, the more technology is going to advance, those decentralized automated liquidity pools, they will become bigger. So what it allows you, without being a professional trader, to deploy money into this pool, and essentially you're becoming, in a way, you're becoming part of a market maker. So and they're not open to anyone to provide liquidity, but the more I would say democratization comes into play, the better, they're becoming into, again, allowing everyone to participate. And I think just the fact that you can have only $1,000 or $10,000 worth of your crypto assets and can participate in this is just impressive. And as Andrew mentioned, if you have 8 to 10% yield year to year, that's a separate strategy. People can live on this.
Let me throw a question out to the group. Konstantin, you talked about the fact that Wave is considering creating a new DeFi fund project, for lack of labeling any differently. So a new product that you can offer to your clients that's going to capture some of the aspects and the returns and the unique innovations of DeFi. If I want to ask the three of you, if you look at the world of actively managed crypto hedge fund or crypto fund management groups, let's just say in the Western Hemisphere, those that have been in business a while, have a decent brand, a track record, assets under management, have done pretty well last couple of years, but haven't yet have so far done very little beyond, there's a BTC fund, there's maybe a top 10 liquid coin fund, maybe active managed, hedged here or there, basis trade, but haven't done much real DeFi other than their PAs, but as far as the products they're offering to clients, how many of those of Wave's competitors effectively do you think are going to launch something similar this year in percentage terms?
I don't know. And I can see that I don't think there are enough people who actually have expertise and ability to launch such products. It's actually, you would think that it's simple. It's not that. Like the only thing what I would say, like an honest criticism towards these products. I mean, if you don't know what you're doing, you can be also wiped out pretty fast. Like I've seen strategies with 3 to 4 different layers how you can, create, let's say, one of the strategy I'm selling it like easily, like so you can stake money in synthetics, you can buy SNX, stake it with the minter pool, then you can mint SUSD, then go to Curve, then basically stake it in Curve, and then you go to Balancer, and this is continued. You have to like always actively track what's happening there. Now you have Zapper, you have other opportunities to see, well, like holistically, where are your assets and whether you're using Trezor or MetaMask or like Ledger and other opportunities here. But it is still not that easy. Like, in some of the projects, you always have to double check the rewards. They're not automatically rewarded to you, like with the free tokens. In others, you have to look up the ratio between your collateral. So there are a lot of things that can go wrong. Let's put it this way. So the people who actually
it can be a painful learning curve, is what you're saying.
Exactly. You can also easily lose money. So it's not an investment advice just to go and put all your money just because you can have like 8% yield, right? You have to be very, very careful, like, because those strategies also require they require like certain tax avenues, so, and also financial understanding what the hell you're doing.
And depending on jurisdiction, certain licenses. I think that's really probably the bigger gatekeeper to this, right?
Exactly.
Danny, to answer your question, how many of those companies are gonna pop up? The answer is a lot, but how many of consequence? Probably not that many, because it's not an easy place to get into, right? It's not something that you can spin up, overnight. It requires infrastructure, requires a incredible amount of domain understanding in order to be able to compete with Wave and other players. And then again, jurisdiction for that type of business is incredibly important. Where are you domiciled, and what does that structure look like?
There's some KYC challenges as well, of course. The bigger money, I mean, it's just
custody is even better, even bigger challenge.
Yeah.
Like, for example, we as an IRA, registered investment advisor, we can work only with qualified custodians, and we have a very highest fiduciary responsibility towards our clients. And that as Andrew mentioned, there's a cost to that. We're paying 6-digit numbers just to maintain this legal and compliance hurdle. How many firms who are starting can afford that?
Yeah, and it's not a cost that ramps up slowly. That's another piece, right? It has a huge upfront lift, and I mean, some of it can be templated because there's some of it that's been done at this point and been distributed, but you're still, I mean, you're starting with a huge weight on your shoulders right out of the gate. Yeah. The compliance legal jurisdiction component of anything in crypto, I think, is often underestimated. It's probably one of our biggest focuses at Republic. I mean, we have 11 attorneys in-house. Since securities law, I mean, our CEO is an attorney. He was the general counsel for AngelList for years, and that's something not to be overstated. And one of the great things about the U.S. is especially recently, we've gotten some really clear direction as far as what type of swimming lanes we can operate in. But that being said, being able to navigate that appropriately, and also keep in mind that there's going to be a lot of oversight, and more oversight this year than ever, and that's only going to increase. So
those compliance costs are only going to continue to increase. Obviously, more lawyers, more compliance, more layers.
Well, that's what we started with, right? Lawyers are winning.
Yeah. The only thing that I would add to that, because I think that's very well covered, is that in addition to all of those things, I don't think you're going to see a lot of traditional market participants cross over, into that particular space. Even if they do cross over into crypto, I think that there's a certain a large part of the strategy when you're talking about existing companies is, don't burn down our existing business. And I think that there's, I think rightly so, a perception that there's a lot of risk in these and a lot of hidden risk that is not showing on the surface, akin to essentially, right? I forgot what the name of the firm was that blew up before Melvin. We had other people that blew up.
Citron Research.
Well, that was on the GameStop one, but there was the guy who had the option selling strategy that blew out. Was it that must have been like March, April when the market tanked, right? Was that when the guy came out and he was in tears on YouTube apologizing to everybody?
I know.
But you know what I'm talking about. So for me, I will tell you straight up that Constantine's excitement is infectious. Maybe a poor word given our current world, but nevertheless, I'm very excited about looking into DeFi. But having been in the markets for a long time, this strikes me as having a lot of embedded leverage and being the equivalent of short tail risk somewhere in there. This stuff doesn't come for nothing. That's just my view. Happy to be proven wrong, and I'm excited to take a look into all of this. But to wrap it for the institutional, I think that's gonna be a long road for them. I think Constantine, you're gonna have a clear lane as far as the traditional markets participants.
Guys, I think right now might be an appropriate time for me to do some shilling. So, because I know our audience has been waited very patiently for the last hour, and I hope they've really enjoyed this. But when we're not talking or thinking about crypto, liquidity, institutional versus retail, DeFi, the future of the human race, what I like to talk about is rock and roll. So for all those out there this weekend who haven't checked it out, check out Old School Vinyl.
Shout out the devil.
It's a great podcast. You can get your motley crew there if you listen and you're patient. We'll get to it eventually, Andrew. And all your favorite bands. It's my favorite podcast about classic rock and roll. That's Old School Vinyl. Check it out on Spotify, Apple Music, and wherever you get your podcasts.
That was so velvet.
Yeah, that
I
mic.
love this microphone.
Mic is so good.
So shameless.
Yeah. I'll do my own so long as we're here. So I know you guys are at Republic and at Wave. What we do, I'm at Digital Gamma. I'm one of the co-founders, and we're working on a repo product, which helps investors, particularly from the traditional side, embrace Bitcoin and understand that there are these opportunities for lending. We prefer a collateralized viewpoint, which is a little bit more safe. But there are significant opportunities, and we see it as we say, the ability to get junk bond yields at investment grade risk. So for you investment nerds out there, that's our pitch. So.
I don't know. I can go. So we are, asset management firm. So we have different hats. We have VC arm. We have wealth management arm. We run different strategies in different hedge funds. Right now working also on an infrastructural fund with Cardano, by the way. So we're going to stake some of the, the staking pool we're going to create with them, and we're also launching a VC fund with them to help invest in infrastructure. So anyone who's building something on Cardano, please, let us know. We'll be happy to cooperate. The last thing I will say also, I'm also having as a product placement, also having a YouTube channel and a podcast, Holistic Investment, and where I interview a lot of interest in people ranging from investors to entrepreneurs, in the space, mostly in the space, a little bit of VC mix, but mostly people who are very directly working in digital assets, ranging from asset managers, prime brokers, custodians, and just people who are very knowledgeable in the space. So yeah, I'll be happy if somebody would listen to it, or if you know some of the people who you think I should interview, also happy to take a look.
and then I'll hop in just about Republic for those of you that aren't familiar with us. Spin-off of AngelList, actually, about 2017, originally built on the Jobs Act. We were focused on regulation crowdfunding, Reg CF. Around that same time in 2017, the ICO boom happened. So we realized that ICO is just another form of crowdfunding, and in some cases a better form of crowdfunding. So that's how we got into the blockchain space. As it stands now, Republic is 3 divisions. Reg CF still very much at the forefront. It's very consumer facing. So if you're looking us up, you'll see a lot of that. Again, all about democratization of finance and access for people. So Reg CF side, then we have our venture arm known as Republic Labs, investing, syndication, and allocation through a really large cultivated LP network. We do a couple $100 million through that every year. And then we have the blockchain division. So I run the blockchain division, includes our advisory arm, working with startups, enterprise, governments. We have our own tokenization platform, minting on ERC 20, 1404, Stellar, Algorand, Tezos, soon to be Binance Chain. And our just now launching token sale platform. So we'll be running our first token sale fully compliant in the US with retail access here coming up in the middle of March, and more on that later.
That's awesome. You guys had a big year last year. I love what Republic's doing in the space. And I think imitation is the best form of flattery. So I anticipate other folks will be doing what you're doing. Maybe not exactly the same thing or as well, but I love what you guys are doing. And of course, I'm a big fan of DigiGamma and Wave on a personal and professional level. I'm still a free agent, but I will be updating my LinkedIn profile next week. I'm excited to let everybody know what I'm doing. But right now I'm having a lot of fun in the crypto space when I'm not talking about rock and roll.
By the way, albums on the live album list, 10 through 6, I rate better than 5 through 1.
See, that's what we like. We like a little bit of debate, a little bit of tension. Maybe next season we'll do it again.
Perfect.
Stay
Let's do it,
tuned.
guys.
Guys, it was a real pleasure meeting all of you. I've learned plenty from all of you, and this was great.
Likewise, gentlemen. Thank you so much.
Thanks, guys.
See you
Cheers.
soon.
This is who
Welcome, everybody. We have a roundtable now with our Zap.org team, and I'm sitting with the lead developers, Adam Minka and Eric Monganero. I will let them have a brief introduction of themselves, and we'll jump straight into it. Zap 101. All right, guys, so can you just give us a brief overview of your involvement with the project and a little bit of background of yourselves, your careers, and the projects that you've helped to develop?
Yeah. I think I met Adam when I was doing a Coinvention, right?
Yeah.
So I met him, talked about a lot about crypto. He's did a lot of ICOs, right?
Yeah.
From Consensus, and I was like, whoa, well, he knows a lot about what's going on. And we started not just doing normal convention stuff, but that's kind of like the whole flavor of what we're trying to paint here is having a hackathon and, you know, bringing like innovation to the market as well as people speaking, because there is a place for both. And, you know, this is software, but it's not the thing.
Great. So you guys both have a history of helping to host hackathons and have been involved in this space for a while.
Yeah, absolutely. I mean, Eric and I started off initially working kind of, you know, on this conference. And one of the things that Eric highlighted was we just loved playing around with code a lot. And there was a lot of interesting things that kind of came out, you know, and nobody really knew, you know, what technology was going to be best or, you know, what was going on. We still don't really know that. But we just started live streaming, you know, us just playing around with code and set up like a development community. And we're just looking for projects to really dig into. Eventually, you know, I kind of beelined it for Zap, and there's a lot of reasons for it. But one of the main reasons is another person that we met there was Nick, you know, Nick Spanos. He was a speaker at the conference. And, you know, we started hanging out with him a lot more. I knew who he was, and it's a lot of fun.
I had to go help my friend. And I was like, I saw y'all in the lobby, and I was like, oh, I should probably hang out. But my friend's lost in the city. I go get him. You know, I was like, okay, you're here. Cool. See you later.
Yeah.
Great. So you guys met. Eventually, you started playing around. You found out about Zap. You got involved,
Yes.
and now you guys are leading the project.
Yeah, I mean, I think it has to do with like a duocracy, honestly, because this is an open source project, and I'm really trying to, you know, see a great foundation that was laid for the actuals of that protocol. And now we just have to develop Zap applications.
All right. So
Zaps, you know.
let's jump into what Zap is. If you could give us a brief overview in the most simplified manner of what you think Zap is.
Was that it's like Chainlink, Uniswap,
No, it's like
and Ethereum combined, right? You remember that's what the community member said?
Yeah,
No, but it's
that's what they say. So we'll just say that.
Yeah, it's really there's three foundational components of Zap that are very interesting. And you know, Nick really drove the forefront of this. And the first is really just bonding curves, which are used ubiquitously throughout DeFi.
It utilizes bonding curves.
Yes, leverages bonding curves. The second is this Oracle mechanism, which allows data to come from off-chain or, you know, monitors on-chain events and communicates into smart contracts. And the third,
that's important because that is part of the Oracle problem that is so often not solved. We need off-chain data to be brought into the blockchain and the smart contracts.
The best way I think about it is that we're so used to having a camera and like a keyboard around us that we forget that, like robots, you have to have the input from somewhere. But in a smart contract, it's kind of like blind to, on purpose, to the outside world because we can't actually trust the data coming through unless it comes through that, you know, sealed channel.
yeah, and I think at this point as well is, you know, a solution before that earlier was like a 90s voting system in like a token curated registry format.
Yeah.
And I'm not going to get too much into it, but essentially it would go up to voting rounds. People would say, did this happen or did it not? And people that hadn't, you know, voted correctly would win. But that's prime for disruption and like, you know, very easily manipulatable. So this outside data that you get from a, you know, validated source from the real world is really important.
So, and we'll come back to your third key point of Zap, but just to recap. So the first, utilizing bonding curves, then you have this Oracle solution that's helping to create models with accurate data from off-chain. And the third point?
Really comes down to sub-tokenization or fractionalization, right? So you have to have something that's divisible, right? So you know, in the same way you use an ERC20 or a cryptocurrency to denominate something, right? You have to be able to have this pricing mechanism with the bonding curve, something that you're going to deliver as a service. And then the third component is how do you represent individual ownership or represent utility of these services, and that's the third component.
And you do that through the bonding curve as well. So on the bonding curve, you can actually create your own curves with Zap.
Yes.
Right? You can, at the bottom base, you have the number of participants over the
Supply.
value.
Yes.
So like, and that comes down to I guess our native, you know, sub token called dots, where you would have a supply created for you. So therefore it can be used across chains. Something needs to be like airdropped or created in another chain where we're going to be implemented, then you will be able to have that supply. But you can also alternatively just create your own actual ERC20 token as the supply of that automated liquidity, I guess, function.
And you mentioned dots. Can you explain what you mean by dots?
Dots are really just, like I said, you could either have your own currency or our common currency that is like a Satoshi is the Bitcoin.
Right.
So you can just say against the supply of what? And you can define that earlier on. And that's kind of what me and Adam have been working on, is making an application to really take all that really important information and try to really abstract and make it easier so everyone can be like, oh, okay, I'm selling my data. This makes sense because it looks like it visually.
If you can, I guess, like to wrap it up really simply, you essentially set the amount of a token that you would like to issue for a specific service. And then with that, you create a deterministic price depending on how many are in existence based on this bonding mechanism. And then you allow to deliver on the service through a function that we call redeeming of the dot. So this overriding mechanism where you're burning and creating tokens is called continuous token generation. And it was, they called these curation markets, and De La Rouvier had written an article about it. The team went kind of really deep with it. And I think, we're kind of at the point where, all this is coming full circle. And, there's a lot of utility for it, currently, whether that's synthetics or whatever it might be. It's really cool.
And can you talk to us about why early adopters are rewarded and how that relates to the bonding curve and the deterministic pricing index that you set?
Yeah.
Like, step one, I think, right here is that for those who are listening, the reason why we're talking about this is because in a maker-taker model where you're buying and selling on any book on Binance, you are trading against a bot. There are walls set for traps to be for people who are entering the market, small person who wants to be able to interact with this asset, get some or sell it at will without having front running or this stacked book for against the small guy, and that's what that deterministic prices that he was bouncing off of. You can know exactly. So even if there are people buying and selling, you know exactly where it's going to be.
Yeah.
It is predetermined. And that's what the shape of the curve and why we talk about it so often is because what you're saying, incentivizing early delivery. You can tell that if you can control how it goes up, whatever your asset or your services, then those people at the very beginning actually have a very decent price, and it actually has a way for everybody to enjoy in that supply.
So the Zap's mechanisms work in a very unique fashion, kind of extending on what he was saying and trying to answer, I guess, yours and bridge the gap here, is they work in a very unique fashion. Since we're working with cryptocurrency, we can do things that were never possible before, right? The money itself is programmable when you're talking about Bitcoin, right? Mm-hmm. We have the capability to have it follow a set of rules. Humans can't do that, right? They can take money, they can go away. So what we have now is when we write a smart contract and you're abiding by an agreed set of rules, kind of like in the case of Robinhood, I mean, they just shut the machine off when you're playing it, right? That's what happened recently. With Zap, what you have to do is you have to have some skin in the game for the price to actually go up. So it's not a fake price. It's an actual true market value. It's much like if anybody's ever taken economics and you look at a supply curve and a demand curve, if you can think about, depending on certain market conditions, you might want a down curve, you might want an up curve. You could have a flat curve, right? You could have a static price if you're really good and you know what your price is. But Zap's unique value props, to your point, is that early adopters can get rewarded, right? Or if you have a asset that is, as it becomes more abundant, becomes less valuable, right? You can price things like these. So Zap has a very unique capability in its bonding curves. A lot of people are using what's more accurately automated market making. So they may have a pricing oracle and it's setting and it's saying, hey, look, this is the price. You might get flash loaned attacked. Something crazy might happen. Zap is really built to follow a static set of rules at the outset, reward people or change the price depending on the factors that you set. And everybody can agree going into it.
So that leads us into the curated marketplace and creating the market makers.
That's correct.
So I'll let you expand on why Zap is so important for people who want to cut out all of the middlemen as part of that process.
Yeah, so I think that it's like, what was the killer app, Uniswap? You can, if you want to create your own Uniswap in a quick manner, but not have it traded on a public, token, then that's perfect. Or you're making like a closed system as your business model, then you don't want to have it be exposed to your supply to the outside world, but you can choose to. And that's kind of like just one of the features.
Yeah, I think I think this is really interesting because you hear anybody who's gone on a Reddit message board or watched some goofy video on the internet, they talk about pull the buy wall or pull the sell wall, right? And they're talking about this thing, and basically you could be trading on Binance and you think you got $1 million, but then when every buy order clears out from underneath you, the rug pull, the traditional rug pull was, they've put the price up to a certain point, and then you just pull all the buy orders. Now who are you going to sell it to? These mechanisms that are in place to be able to lock liquidity, to guarantee that there's something backing up a specific service. This is something that's really evolving, and it's at its infancy. I know people like to think, this DeFi stuff's great. What we're doing right now is going to look like what the 90s looks to us now in web, right? It's going to be box like HTML stuff. As a matter of fact, many DeFi sites do look like that. So we're really early in the game, and I think people have to understand how significant mechanisms these are.
And they create new terms.
Yeah.
And create new ideas that are associated with the advent of programmable money.
Yeah.
And I think that's a great point and a lead into right now. It's a big discussion. Everyone's selling our data, and there's this idea that eventually in the future we'll be able to own our own data.
Yes.
And we will be the ones who can profit off of our data.
Yes, 100%.
And our own information, our contacts, our influence. So can you talk about how Zap can help someone become self-sovereign in that way?
Okay, let's think about tools that we really like right now that we're trying to integrate with Zapier, all these things that actually do help your life. We want to be able to actually have what our team is really working on is being able to bridge that gap, and tools that are low code, no code, that actually are like what you're saying, how you can sell your data and really easily.
To provide a platform for that.
Yeah, because you can actually, with a connection like that or something like Parabola, you can actually go into a Google Drive document that actually has information and sell it. You actually have to own this much of this token or bond this much to it, and it opens up to you.
And what's interesting is when you talk about incentivizing someone, an early adopter, if you have, a bonding curve that might go in an upward slope.
Yeah.
What's interesting is that with the data, the more accurate the data is, the more people are going to trust and want that data. And I think that's part of the incentivization for early adopters is if we're not only putting out data, but it's good data, then there's value in that.
So we're talking about oracles then. So we're talking about what he said, synthetic elements. All these things need an actual way, just like any robotics, because we talk about what do we already know. Blockchain, virtual machines, whatever, it is related a lot to robotics. Like the robot needs to see, hear. Otherwise, if you don't give it those sensors, it's
It won't execute.
Sure,
the
but
program
there's
of the
even like the robot itself, even in standard robotics, can't trust its environment, and it has to do all these things to make sure that I'm not bumping into a wall, or if it's not 1,000 degrees out and I'll melt or something. So what we're doing with an Oracle is to not just have pricing fees, but actual events happening in the world in text. So we can provide a rich thing. Because
You can provide context.
Yeah, the context is something that a lot of people are using. It's something I thought was a great way of explaining it. Is like when I saw something like dodo decks or synthetics, because we are interested in being able to explode free trade. What's happening with GameStop and having like that type of control over the market sucks, and that we want to we have to like, okay, what's the price of this right now? Can we back it up against something? Can we control the supply of this thing? All answered by our protocol.
I think a lot of this can be solved by I think at risk of going to kind of like meta, what I'm about to say is like ancient Greece talked about like things, right? Now we're like, oh, everything's data. Like everything is data. Like everything, your entire world, everything you perceive, anything can be data. So talking about
What
like
is that, Newton's demon or something?
yeah, it's Oracle or I know what you're talking about, but
Yeah, what is that? Is that Newton's demon? What was that? Basically, if you had like keep track of all the information inside of that.
Yeah.
Like
you could
amount of entropy.
But data is the new oil.
And data. We're calling it data now because we're so driven on like Boolean systems and like all this all this crazy stuff. But like
the universe itself is
essentially, how do you have trustless mechanisms with machines? Like we're bridging the gap, right? How do you have trustless mechanisms, but also all these things we enjoy on a daily basis?
And that is part of the Oracle problem.
Yes. And then the second component of that, I guess, from a larger standpoint, is like, how do you actually sell things that you know to be valuable when you can't find a marketplace, you can't price it, you don't know who it's valuable to? For instance, a boat might be worth, in Connecticut, $4,000 in the summer and worth, $0 in the winter because the ice is frozen, right? And you have to have some kind of price elasticity. So there's the oracles.
In Denver because there's no boats.
Yeah. So it's just like there's a very complicated set of problems, and if I could explain in the simplest form, is like we're giving you like a computer to be able to navigate DeFi with, right? You're gonna build all kinds of stuff, and you're gonna make pricing curves, and you're gonna do all this stuff. But we have a basic rule set, a protocol that's gonna allow you to price things, create oracles, feed in data, and all this type of stuff.
All right, and just for the sake of times, I would like to get into next. Where do you see Zap fitting into the universe of multi-chains?
Yeah, we were talking about dots beforehand. The dots are that's the reason why we're not a security. Like we have this huge utility that is associated with being able to essentially airdrop to the other chain that we just become a part of. We're like, oh, know what? Tron's
so you mentioned you can airdrop.
Yeah, well, yeah, because
it's not an airdrop.
It's not an airdrop where you're giving away free coins. It's like getting your own token on the other chain.
You create a bridge.
We're talking about a bridge between Binance Smart Chain.
Right, interoperability between those other.
And we're like that's why I'll probably do a workshop on the hard hat instance that we have, because a lot of chains like IOHK is going with an Ethereum virtual machine. So there's like a really great use case for that, and we can bring the protocol directly to it.
I think there's a lot of interesting things to be done with bridges, but I think like multi-chain in general is just how do you look at the larger ecosystem, and how do you promote, like you were saying, interoperability? I think where Zap fits in all of that is just given the three mechanisms, and getting I guess there's like a vision that I have of it, and then there's the actual like what is the most immediate. Everybody's talking about token bridges, but the real cool stuff about like multi-chain and being able to go off chain and up into the upper layers of blockchain is like lower transaction fees. You're not encumbered by the blockchain, although it provides many benefits. Blockchains are they're not meant to be this fastest thing ever.
It's not a dictatorship. It's a consensus.
Yeah, it's meant to be incredibly redundant. Yeah. So as you go up chain and cross chain, you're going to be able to enhance things like Bitcoin, you're going to be able to enhance. We've looked at Bitcoin really hard, by the way, but
So that leads us kind of into wrapping tokens.
yes. Yeah.
So okay, wrapping tokens is just like the same problem as we were discussing about synthetics. We have to actually have these tethered to something. What is it tethered to? And was it backed up by? And you can see there's a lot of really good solutions out there, and I think that that's what we're implementing. We're like, we're inspired by the open source projects like RenVM. Like, how can we create our own networks? How we can keep that decentralized and interact with it? It's like it's inspiring.
I think kind of like making a segue from that point too. There's a lot of custodial versus non-custodial, and right, we're both non-custodial people. Like, we don't want people to have control over it. But the good thing about consensus networks, right, is like a consensus mechanism is that you can have, a network, a dark pool, a whatever, holding custody of your stuff, but you still have complete, control and access to it. Much in the same way, like blockchain, like people don't think about Bitcoin, it's not on your phone. It's on the blockchain. You do not hold it, right? You just know the right set of, letters and numbers that can get you to be able to sign something to send it somewhere else, right? So like there's a lot of cool things wrapped within that just statement alone. Like when you're talking about moving up layer, multi-chain, and being able to bridge things, jumping on and off and do all this other wonderful stuff.
So we're getting kind of like, we're looking at the Web3 development.
Yes.
Yeah.
Because when you say that, I'm always thinking about wallets are separate from the network, from the node. Because I don't care about if it's Binance Smart Chain or Ethereum. I'd like to have Ethereum go crazy. If solutions don't work out, it's all good.
You use your private key from one
But
chain.
in my thought process, especially like during this hackathon, we'll be able to get people to know where the wallet is, what the actual thing that we're working with, and then how to interact with it. And I think that type of being agnostic allows you to be anti-fragile and like to be able to go with the flow. Like we care about the ideas behind it, and then the language that we program in might change.
I think right now in blockchain we're building Steam cars, and a lot of projects are building Steam cars. They're like, wow, Steam is so powerful, and like where we're going is like Tesla's. Like we're jumping up, and we're like, okay, we're
self-driving.
self-driving Steam cars.
That's what I think is so exciting about the Zap project is that you guys are figuring out these problems now that are solving what we're experiencing in real time in crypto.
And pain.
However, you're also helping to build a tool that can be translated to someone in 10 years and a platform to provide people with their own business, really, if you wanted to.
We just don't even know what's going to happen, so we want to be able to like give people the tools.
Eric and I really have like what's in front of us and what we're trying to accomplish, and some of that stuff's like, to us it's super like dull compared to like what we know is capable, but it's really important for the mass market, because if we can get it in the hands of other people, then it's like it would be incredible.
I'm like, yeah, listen, we're in here for the long haul. We're like, Nick is talking to me about how he's running this Doge party in 2014. I see my old landlord. I'm like, what are these people doing? I know about Dogecoin, but it's like, oh, we're weird about that,
Yeah.
Great. Well, thank you both so much. This has been fascinating. I'm excited to see what the future holds for Zap. And I know that the community is really hoping to see some new UI, some teasers. So stay tuned and visit zap.org for more information on the project. And up next, we have the Introduction to DeFi with Professor Jamil Sheikh. Stay tuned.
Thanks, everybody.
Okay, hello, can you guys hear me? Okay, great. All right, is my audio good? You guys can hear me? Okay, great. So let's get started. Welcome everyone. We're going to do today a introduction to DeFi, and we're going to look at some key smart contracts. Actually, what we're going to look at is we're going to look at different categories of DeFi, and then we'll look at 2 or 3 different smart contracts, specifically MakerDAO, Compound, and Uniswap. It's hard to get into all the details. There's a lot of details. We would need probably an entire day, but we're going to try to get into a kind of a broad overview of DeFi, and then we'll kind of dig into a little bit of the details, specifically around what I would like to really cover is Uniswap, and the constant product formula and how that works. To a lot of people, it's a bit of a mystery. And so a lot of the information that I'm presenting today is going to be very, very basic. If you're already familiar with DeFi, it might be somewhat familiar. If you're absolutely new to DeFi, then this should be really, really good for you. But if you're familiar with DeFi and you're not familiar with how Uniswap works underneath, then or how MakerDAO works underneath, then this might be a good introduction to that. So so this will be kind of a broad introduction, but there'll be some areas where we're going to kind of go into some quantitative detail. Like I'm going to go into some of the formulas, and as much as I can squeeze in within an hour. Normally, I do a course on DeFi that can last a day, like 8 hours. So this is kind of more of an abbreviated version of that. So I'm going to get started. Just a few introductory things. One is, and this is really important, is here a standard disclaimer. Nothing here that I'm presenting here should be construed as investment advice, or that I'm advocating the buying or selling or trading or staking of anything. So everything here is just for information and educational purposes. Beyond that, there's nothing I'm going to be suggesting in regards to investing or anything like that. So please be aware of that. I also started a DeFi Discord, and this is a Discord for DeFi education. So if you want to learn more about DeFi, we're going to launch it in actually March. But if you want to get in now, it's open now. But we haven't made a wide marketing around the Discord yet, but we will soon. But if you like to get into a Discord where you can learn about DeFi and not get hammered for asking what people might think is a stupid question, then this is that Discord. And I'm running a DeFi conference March 3 to 5 called DeFi Con. If you guys want to learn more, I've got all the major protocols coming. I've got Compound. We've got Consensus. We've got people from DXDY, from Harvest, all coming. And we're signing up more and more people every day. This is basically going to be a educational lecture series. So they're going to come in and talk about how their compound works, how their protocol works. They're going to come in and talk about how yield farming works. And then they're going to move on, and we'll move on to the next lecture. So it's going to be kind of this back-to-back lecture series, and that you can come in and learn. Right. So if you want to register for this now, go to DeFi, that's with 2 I's, con.com, and there's a registration link, and we'll send out the invite link for that early March. So please be sure to sign up for this. A little bit about me. I run a company called Chain House. I'm based in New York City, and actually we're just expanding to Asia now. I'm also a professor, an adjunct professor at Columbia Business School, where I teach blockchain. Also at NYU and CUNY, I teach both business side and technical, like coding, machine learning, blockchain, and AI. I just came out with a book from O'Reilly called Mastering Corda. Came out in November. It was an Amazon bestseller. It still is. I think now it's like top 50. And I have an MBA from Columbia. I'm actually doing my second master's at Georgia Tech in AI. So I'm not only am I teaching, I'm also learning and running a company. And that's my kind of bio. If you guys want to contact me, you just go to jamil.io, and I've got information there. I also run a very large blockchain meetup group in New York City. We're, I think, past 6,000 people now. And before COVID, we were doing lots of events, about 30 events a year or so. That's actually how I met Anna, who graciously invited me to come and speak here. We do, now we're doing events online, but once we get back to some degree of normality, we're going to go back to doing events in person, and we'll get a lot more information around DeFi during these events. I kind of really look forward to that. Okay, so now the topics I'm going to kind of cover today. I'm going to go over quickly what DeFi is, and then talk about some of the earlier use cases of DeFi, which are like tokens and SDOs and ICOs, and people may have heard of it, and then asset tokenization, and then all this new stuff that's kind of emerging. So kind of we're going to rewind back a little bit. Say, well, these are the things that occurred the past couple of years. You can consider them under the fold of DeFi. And then all of a sudden, all this new growth that's occurring, especially the past 12 months, and kind of look at what they are, like money markets, exchanges, prediction markets, and oracles. And then we'll look at, some of the risks that are occurring in the space and some of the tools that you can use if you want to learn more. And we'll go into Q&A. Anytime you feel like asking a question, just, pop it into the chat. I suggest that we kind of keep questions towards the end. I'm going to try to skip over a couple of these slides just while monitoring the time, so that we can kind of like focus on more of the juicier stuff, and kind of skip some of the stuff that might be a little bit more, people might be more familiar with. I don't know where everybody's at. I don't know what the audience is at. So I can't make too many assumptions about everybody. So just tell me by your questions where you feel like we should kind of concentrate more on. Okay, so let me get started. So quick overview, what is DeFi? It stands for decentralized finance. Whenever I teach, I like to start off with the very, very basics. I can't make assumptions about people. And this is in contrast to CeFi, which is centralized finance, or which is what traditional finance is, right? Finance today is centralized. And we experienced that pretty heavily this week because we saw what happened with Robinhood and stocks like GameStop, where Robinhood came in and said you can no longer buy GameStop stocks or equity anymore, and whatever the reason was, whether the reason was justified or unjustified, the point is that some authority had the ability to come and tell you you can't buy or sell something in what supposedly a free market. Right. And so the idea in the decentralized finance is, well, such things should not be possible. An arbitrary decision by an authority to come in and say you can't or can do this should not be possible. That the rules of how finance work are embedded in code. Right. And so that you can see the code is open source and it's transparent. You can see the rules of the game, so to speak, and that you interact with a blockchain and you're doing your financial transactions through these smart contracts, and you know the rules of the game. Now, that doesn't mean that there won't be shenanigans and all that. There still can be, but at least you can kind of compute and assess more openly what your risks are. Right. And because these applications are programmatically created, these economic models are programmatically created. I can create a money market by coding that money market. I can create a money market by deploying that code onto a blockchain, and also I have a money market similar to what a bank has when they sell you CDs, or the Treasury has when it sells you T-bills. It now has spurred the ability to create all kinds of innovative and creative new economic models. Anything that I can think of, as long as has justified economic principles, there's supply and demand, equations that make sense. If I can create that in my mind, I can then probably create it in code, and then I can deploy it, and I can make it real, right? So I can realize ideas that I have about how finance should work and implement it immediately, right? Probably within a day or 2 days, 3 days, depending on if I have the coding capability, and get it out into the market and potentially test it and see if it's successful or if it's a failure, right? Because of that, DeFi is probably one of the more complex and intricate areas of blockchain. So blockchain itself is fairly complex in how it works for most people, especially if they're not a technologist. But then if you bring in DeFi, it adds a magnitude of complexity. And we'll experience some of that complexity today, right? We'll see some of that kind of complexity, but that complexity creates a lot of power. And that is one of the driving forces behind DeFi, that not only is it decentralized, but it's extremely creative, right? And that doesn't get the most of the attention, but that's where the attention should be. It shouldn't be that it's decentralized. That's almost a given now, but where the power is that I can create and design my own economic models that I engineer on my own. I can sit down and take a piece of paper and engineer an economic model and work out the principles of it, and then convert it to code and deploy it. And boom, I can start trading with people. I can start interacting financially with other people, and the rules of the game are defined in that smart contract. So for me, that's very exciting. That is kind of a major realization of what blockchain is and what blockchain should be. It's not just Bitcoin, but now all of a sudden DeFi is taking us way, way beyond the vision of Satoshi. So why should I care about DeFi? Obviously, if you're here, you do care to some degree. But if you have friends and you say DeFi to them and they're like, I don't know, I don't care. Here are some of the reasons you can tell them why they should care. Number one, DeFi is something that's global, right? So it's not that it's a local market. It's not the New York Stock Exchange. It's not NASD that's only dealing with US equities, and then you can't have access to Chinese stocks, and you can't go to Europe and get access to Swiss stocks. You got to go through all these processes to open up an account in a Swiss brokerage. Here, the minute you deploy a smart contract, that financial and economic model is accessible globally, right? So some kid in Vietnam can also start trading. The minute you deploy that smart contract, they can start trading, and anybody in the world can start trading as long as they have internet access. Theoretically, also settlement is rapid, right? So the minute you trade, within a block or 2 blocks of consensus, that the trade settles. It's not like the U.S. equities where it's T+2, where I've got to settle in 2 days. And actually, that's one of the reasons Robinhood had to, or they're claiming they had to limit their allowing their customers to buy GameStop, because they had to put up money with their clearing firm, and that 2-day window meant that they had to cover that money, and they couldn't use customer money for that. So that kind of is different with DeFi. Settlement time is within a block or 2 blocks. You earn interest potentially if you put crypto and you're generating interest income on that. You're earning it per block, right? Not per quarter or per day or it's per block. So it's more frequent increments, right? And then we can do things at a fractional level, right? So I can potentially invest 1/100 millionth of a penny. If I wanted to invest that small amount, I can potentially theoretically invest that small amount, or I can pay that small amount of interest. And I'm not saying that you should, or not that it's the way to do it, but it's possible, right? Whereas right now in traditional finance, you can't do that. And there's theoretically lower friction. There's a lot less things in the way. There's a lot less paperwork I've got to fill out. I don't have to worry about getting approval. I don't have to worry about going to a bank and knowing the bank manager and the loan manager and being on their good side and all that kind of stuff. And the market is always open, right? So you can trade at 3 o'clock in the morning and get up and start trading and getting involved. It's not that the market closes and you're not going to get jumped and surprised when the market opens and there's a sudden fluctuation in price and you get caught by that. The market is always open. So over the long run, like the FX market, over the long run, this is going to reduce volatility, not increase volatility. Over the long run, that theoretically will reduce volatility because information that changes prices will be more evenly spaced out over time. The arrival of that information and the impact of that information on price shocks will be more evenly spaced out over time than all kind of combined in and impacting the market at 9:30 in the morning when the market's open, and then boom, all of the price shock occurs at once. These are some of the reasons why DeFi matters, and where we're trending is that DeFi, I believe in 10 years will be the norm of how you do DeFi. Now, there are some challenges, and we'll talk about some of that, but that's going to be, I believe, in 10 years from now is how everybody does finance, or a good portion of how they do finance will be what we call today DeFi. I don't know what it will be called in 10 years from now, but today we call it DeFi. This is going to morph and manifest in different ways. And it's going to challenge governments. It's going to change how people do things. It's going to go through some setbacks. It's going to go through growth spurts like it is right now. We're going to see regulation come in. We're going to see all kinds of people get scared about this. Actually, we saw a member of the Bank of England say, I think it was yesterday, that cryptocurrencies will be gone in a few years. So I don't think that's the case, but you can see that it's creating some friction with authorities, and we'll see how this pans out. But I believe in 10 years, will be how we can will be the norm. And most importantly, as far as my personal, it's going to be accessible to the unbanked. So you have hundreds of millions of people globally that don't have access to banks. Never mind that they're not accredited investors and cannot get involved in these investment opportunities that are only for a certain segment of society. But with DeFi, and as long as somebody has access to a simple computer, even if it's for an hour a day, if they have access to a phone, they can get involved and make money and potentially build a business. And so I think that's incredibly important and exciting about DeFi, which is significantly different than centralized finance, where if you want to trade, you need to open a brokerage account. You have to go through a bunch of hoops. Some of them are good, like KYC, AML, they're good. But then so many people have been disenfranchised because of a lot of these rules and a lot of the accessibility. I need to be able to get to a branch. And if I'm sitting in a remote village and live in a remote village, it's going to be harder to get into a branch. Therefore, I am not going to be cared for by the bank. The bank's not going to see me as the market, and I will never then therefore be educated by the bank around what my product options are. So this is some of the reasons why DeFi is going to be important. And if you're talking to your friends about the importance of DeFi, those are some of the major points I would bring up. So how do we get here? I'm going to quickly turn back. Everybody's kind of familiar with Bitcoin. We've solved major fundamental problems with Bitcoin. We solved double spend, right? And we think that's a simple thing now. We've kind of taken it for granted. But 10 years ago, it was a massive problem, right? How you solve double spend, we've kind of solved it. To some degree, we've solved decentralization, even though that's debatable in a lot of spaces. I'm not going to get into that debate. But blockchain is fundamentally not technology. It's fundamentally an economic system. It's a blackboard or a chalkboard where I can start creating whatever I need to create. And that blackboard and chalkboard is an economic system itself. It's an economic foundation. It gives me the ability to create economics on top of it, right? And that's what blockchain is. It's an economic platform. Now that we have this economic platform, whether it's Bitcoin or Ethereum or any other chain, I can build all these other things on top of it, right? So Bitcoin got us into the door, and it's getting us through a lot of this stuff. It's leading kind of the way in that kind of vision and that kind of thought leadership. But Satoshi's not around, and yet Bitcoin is the preeminent crypto. That indicates that the personalities are not important. That the thought leadership around the person is not important. It's that the vision and the ideas are more important, and therefore the ideas are now out of the bag. Like the cat is out of the bag, and so Bitcoin has basically put the cat out of the bag for us, right? The problem with Bitcoin was not that it has a problem, it's that there are certain limitations with Bitcoin, is that it does only one thing. You can only trade Bitcoins on the Bitcoin blockchain. You can't do much else, right? That's because it has a rigid data structure in its ledger, and that data structure is from, to, the amount, so to speak, and all you can do is put entries that fit that data structure, right? Effectively transactions between two parties, right? So if I want to send Anna Bitcoins, I can send her Bitcoins, and there's a data structure on the Bitcoin blockchain that records that transaction, but the Bitcoin blockchain cannot record anything more complex than that data structure, right? So if there's a credit default swap that Anna and I are getting into, that information cannot be stored on a Bitcoin blockchain because that data structure is too rigid. So, well, I don't have the fields for you to put that information in, so therefore we can't store that kind of trade, right? So, and we call that kind of non-Turing, sorry, not Turing, but non-Turing, like from Alan Turing, non-Turing complete. Has some kind of scripting, but very limited in what it could do. And then Ethereum came along and allows us to build more robust. We can define our own data structures. If I want to define a structure that has these type of fields in it, I can just define it, and then I can define behavior right around that structure. Right? I want to be able to do this with this structure. I want to be able to add this to that field. I want to subtract it. I want to create inventory around this and that, and that's what we call smart contracts. We're kind of coupling data structure, customized data structure with behavior, and now I can just deploy that on a blockchain, and potentially anybody can invoke that and has access to that, right? That changed everything, right? Once were able to do that, that changed everything. That ushered in the idea of ICOs. And what is an ICO? It's effectively a data structure on Ethereum. It's just an allocation table, right? You've got people who are on the Ethereum who have accounts on the Ethereum blockchain, or addresses or accounts, similar to a bank account, like similar to how you have a bank account number. And they're allocated an arbitrary number next to it called tokens. So we just happen to call them tokens, but it's just an arbitrary number. And if you want that number in your associated with your address to increase, you buy into it, you pay Ether in, and you increase the number in that allocation table for your address, right? And that's basically how crowdfunding on Ethereum, which we call ICOs, got started. It was basically a core data structure, an allocation table. Column one was the address of the people that wanted to put money in, and column two was basically a token and how much money they put in divided by how much each token costs, right? And so by keeping this allocation table, I was able to offer raise capital, and what I promised in return for raising that capital. We know now a lot of cases was dubious, right? So there's all these projects, and I'm going to give, I'm going to do this, I'm going to do that. So people put money in. There was no collateral involved. There was no way for me to redeem anything. No way for me to say, hey, I bought equity, and therefore I can go after the balance sheet. If the company's not going to survive, I can go after the assets. But that didn't occur in the ICO world. You were just buying in on hope, right? But the point is that these smart contracts allow me to create an allocation table, which is a key value pair, and raise capital by changing the values in the allocation table, right? And that effectively became how ICOs were done. And then, that caught up, the illegality of all of these things, it caught up. And, we know now about 90% of these ICOs were problematic. I don't want to say fraudulent, but that is probably an appropriate word. And, we have these headline cases like the SEC suing Kick and all of that, right? And, you have blockchains like EOS that raise phenomenal amounts of money and are spending it. And then there's a kind of a bust period, right? So 2018, 2019, it was kind of like 2018, like we just basically, ICOs started to dwindle, and then they morphed into what's called STOs, right? Security token offering, basically an ICO, but a regulated ICO that's following the SEC mandated policies and procedures. And that kind of market kind of cooled off. The ICO market kind of cooled off, but it will come back. It still exists, and if you go to STOmarket.com, you'll see like these issuances But it also opened up the Pandora's box around DeFi. It's like, well, I can do all these different things. I can create other data structures. I don't have to just do an allocation table. I can do all kinds of things as well. And so then this idea of tokenization came out and said, well, maybe I don't have to not have a collateral underneath. Maybe I can put some kind of collateral and issue tokens against that collateral. It could be gold, it could be oil, it could be real estate. All these companies came up and say, well, I'm going to take this asset. It's not a project anymore. It's an asset that you can see it, and I can put it with a custodian, and I can issue tokens against it. And now the token has value, right? There's value that you can redeem, and that value is identifiable to possibly something physical. In the case of there's like crypto kitties, there's virtual cats that you can buy and sell, but I can associate tokens to something that I can kind of relate to. And kind of track and see and things like that. And that kind of emerged and had its place and still has its place in the market. But we can consider this the early stages of DeFi, right? People are like figuring this out. Solidity coders and developers and blockchain developers are figuring out they're cutting their teeth on this kind of stuff. They're learning from mistakes. Some of these projects are doing well. A lot of them are not doing well. But it was the precursor to like where we're at today. And today's we're a precursor to where we're going to be going a year from now. And we'll see where that happens. But each time we move forward, we're getting the blockchain and DeFi thing is getting more and more resilient and stronger. And we're learning from the mistakes of the past. And we're becoming, even as we're becoming more and more resilient, we're becoming more and more complex and more comprehensive and more thorough. As we'll start to see in some of these examples that we go into, right? So typical tokenization layout. There's, you've got your issuer that places an asset with a custodian and then issues tokens against that asset, and the token holder, like me or you, would then go in and buy tokens from the issuer, right? And then you can go off and trade those tokens on an exchange, right? Basically, general. This is kind of like a approach taken the past couple of years. There's a bunch of platforms out there that do that: Polymath, Harbor, T0, and there's a bunch more. They manage documents. The problem they have is liquidity, right? And you're going to see that this is what a lot of DeFi focuses on right now. It's front and central in terms of the focus of DeFi is how do I create liquidity immediately, right? And so beforehand, the problem we had is with the asset tokenization and ICOs is great. I can sell the tokens, but now that I've bought a token, I'm a buyer. How do I offload the token if I want to get rid of the token? And liquidity was a problem. I had to hope that that token got listed on an exchange, and maybe there was some liquidity there, but that was a big bet. And big part of DeFi now is, and you see these protocols, the thing that they focus on, or one of their major focus is on creating liquidity immediately, potentially seeding that liquidity and allowing that liquidity to grow, right? And so even while you're trading, you have the assurance that there is some liquidity there. Now, nobody's guaranteeing any liquidity. We've seen DeFi protocols have an enormous amount of liquidity within a day, start from zero liquidity to have an enormous amount of liquidity, then within 2 days have zero liquidity, just go up and down and get thrashed around. But we can learn from that as well, right? So, and then we've got these tokenization platforms that are doing real estate. At the same time, there's this now demand for stability around cryptos, right? So, hey, cryptos is very, very unstable. These ICO tokens are not stable. Bitcoin, which has failed in the sense that it's a currency, it's not a currency, right? So one of the problems is we need a currency to have stable value, right? So even though Bitcoin is a store of value, that store of value is not predictable, right? And because it's not predictable, it cannot be currency. If I take $1 today and buy a gallon of milk, and tomorrow I can't buy that gallon of milk, but then the day after I can take that $1 and buy a Lamborghini, then my ability to rely on that $1 and how I behave with that $1, how I treat that $1 is going to change. I'm going to save it. I'm going to stuff it. I might not eat. I'm going to hold on to that dollar because I'm like, let me hold on to that dollar for another 2 more days and starve myself so that I can get that Lamborghini once it goes up. Our behavior changes significantly if our psychological trust in that dollar's value is not predictable, And if I can't predict the value of that $1 and what it will buy me, what its purchasing power is in a day or 2 days or 3 days or a month, then my behavior around holding that $1 will change. So in that sense, Bitcoin, I would not say it's a currency, because nobody is buying Bitcoin to buy milk, right? Nobody's buying Bitcoin to do that. They're buying Bitcoin to sell it to somebody else at a higher price. And that's the only reason you would buy Bitcoin at this stage. You're not buying it to buy pizza. So, so because of that, the volatility around it is significant. If you look at some of the volatility numbers, this is standard deviations. This is not price. This is the volatility of Bitcoin in standard deviation. Same thing for Ethereum. The volatility in standard deviation is pretty high, right? So 12 standard deviations in volatility is astronomically high, right? So if you're in equities and trading equities, if you're trading 2 or 3 standard deviations away, you're considered a cowboy, right? You're trading significantly risky stuff. And here's Ethereum hitting 10, 12 standard deviations in terms of its volatility, which is significant, right? So that created this need for stability, right? You have all this volatility. There's a desire for crypto stabilities, and that caused the emergence of what's called stable coins. Basically, I have a token. It's just a token, and I need some way for that token to equal some value that is constant, whether it's $1 or something else. I need to bring stability to that token's value. And there's many ways to do it. I can peg it against an asset. I can take a token and promise you, say, hey, if you buy this token and you ever give me that token back, I promise to give you $1 back. As long as it's redeemable to $1, that token's value is pretty much going to stay around $1, right? And so these stable coins emerge. There are different kind of strategies around how these stable coins manage their value. So if I got $100 million, I put that into a pool of like into a vault, and then I issue 100 million tokens. The theory is then that those 100 million tokens, each one of them would be worth $1 as long as I made it redeemable, right? So if you gave me that token back and I issued it to you, but you gave it back to me, I'm like, I take $1 out of that vault and give you the $1. And if somebody wanted to buy that token, they give me $1 and I give them the token. And theoretically, that token's value would be $1. And so there was fiat collateral. I put $100 million into a war chest and then issue tokens. There's asset collateral. I can put $100 million worth of gold and issue tokens against that. This crypto collateral, I can take $100 million worth of Bitcoin and, or something else and issue tokens against that. But what's really emerging now is algorithmic stablecoins or computational stablecoins. We'll look at one of them, like MakerDAO, that has that kind of capabilities, right? Where there is no underlying asset. It's just the math in smart contracts that work in supply and demand economics that work to stabilize the price of that token and keeping it not at $1, but around $1, right? And that's some form of stability. Okay, so let me just go through. Let me skip some of these slides. Tether is an example of a fiat stablecoin. There's a bunch of them. USDC by Coinbase. Now the decentralized stablecoins are now coming of age, right? The major one is MakerDAO. I actually personally am working on a algorithmic stablecoin myself right now called Universal Basic Coin. Hopefully it'll be out in 2 months, just an experiment. And if you guys want to work with me on that, please hit me up. And this stablecoin MakerDAO is basically a 2-token system. You have what's called a DAI, which is the actual stablecoin, which is worth around $1, right? And then there's another token, which is the governance token, and it's used to pay interest. So you can use stablecoin, you can borrow and lend the DAI. And a Maker is how you would pay the interest back. And Maker, if you own Maker tokens, it's like voting rights around the governance of how MakerDAO works overall, right? So kind of briefly how MakerDAO works. There's a bunch of MakerDAO smart contracts, but conceptually here, like we're looking at the slides here, conceptually here, you put in money with MakerDAO, you have to over collateralize. So let's say you put in $300 worth of ETH into your MakerDAO, you're going to get back to about $200 worth of what's called DAI, and that DAI is of stable value. Even though the value of ETH may go up and down, the value of the DAI is stable, right? So there's some economics behind it. I'm going to go over it briefly. So like, why would you give up $300 worth of Ethereum to get $200 worth of DAI? You haven't lost that $300 worth of Ethereum at all. Some people do not want to give up that Ethereum. Like, well, I want to hold on to it. I don't want to sell it. But at the same time, I need some liquidity. Companies that might be paying employees might not want Ethereum. They can go off and get DAI and pay maybe in DAIs and dollars, and convert the DAI to dollars, right? And just some stability around that, right? So if I want a stable coin, I can like put ETH into the MakerDAO contract and get back DAI, and it's collateralized. The DAI is minted at the time that I submit the ETH. When I submit that ETH into the contract, DAI is minted, so the supply increases, the DAI supply increases, and I am going to pay an interest rate for taking on that DAI. That's known as the stability fee. And I pay that interest rate. I'm trying to get my mouse here. I pay that interest rate in Maker token. So when I pay back and try to get my collateral back out, I've got to pay back the DAI, and I pay back interest, but that interest is in the Maker token, which creates another supply and demand a market for the Maker tokens, right? There's another supply and demand dynamics for the Maker token. I'm explaining to you the supply and demand mechanics for the DAI token. The DAI tokens originate or are created once I put ETH in, right? If I return my DAI, the DAI is burned. And so that's how we remove supply, right? So that's how it impacts the valuation of the DAI, right? So if the value of the DAI starts to increase against the dollar, let's say the value of a DAI starts to become less than $1, and here's a chart of how much the DAI is worth. We can see that at times it exceeds $1 a little bit, like $1.05, but by and large, it's hovering around $1. If the price of DAI becomes less than $1, that means the collateral that it represents, that's sitting in the Ether that's sitting, is cheaper, right? So it's like saying that I bought a house for $100,000, right? And now the dollar is worth half of what it's worth. That house is now worth twice as much, right? It's worth $200,000. So what's going to happen is there's going to be a desire to go in and buy more of that out, and which will then bring back the price of DAI back up, right? The demand would bring back the price of DAI up. And conversely, if the DAI exceeds $1 in price, that means the collateral is more expensive, and people will sell off the DAI, right? And burn off, create more DAI, and that will reduce the price of DAI back to $1. So that's kind of economic dynamic of like increasing the value of DAI versus the underlying assets that it represents, and increasing the supply and demand accordingly will move the price of DAI and keep it around $1. Okay. So, but there's more details. I don't want to get too much into details. There's 2 more protocols I want to kind of cover. But we can get into more details on MakerDAO probably in another session. So, and then the Maker tokens, they're incentivized to keep the system stable as long as people are transacting. They're using Maker tokens. Maker tokens are burnt. That means the value of Maker tokens are going to continue to increase as the supply of Maker tokens decreases. That incentivizes the governance, people with the Maker tokens, to make the right governance decisions in order for the Maker tokens to continue to be burned. As they're burned, and the demand for that token stays the same, the value of that token will move up, right? And that's kind of the general theory around that. So each of these 2 tokens within MakerDAO, they have their own economic model, but then they have an economic model that ties them together based on supply and demand economics that allow them to like cooperate and work with each other. And so the DAI token serves its purpose of trying to maintain stability around $1, and the Maker token incentivizes good governance decisions. Like example of governance decisions is like, how much should that interest rate be that we charge people that are going to take DAI out? Those kind of decisions. If the interest rate is too high, then people are not going to take DAI out, and the value of Maker is not going to increase, right? The Maker token. And so they're incentivizing good governance of the MakerDAO metrics and parameters like stability fee, interest fee, and things like that. Okay, that's a kind of a quick overview of, and this is an example of some of the smart contracts that are working together. So it's fairly an elaborate thing. Now, what we have emerging in DeFi, and this is a major part of DeFi, is the notion of money markets, right? And if you're familiar with opening a bank account, you know you pretty much have a money market. You buy a CD or you're in an interest-bearing account, you are involved in a money market. And money market is basically a market of borrowers and lenders, right? So hey, I've got an asset, I want to lend it out, or hey, I need to do something, I need to go borrow some money, I need to buy a car, I need to buy a house. I've got excess cash, I'm going to deposit it, right? And in the DeFi world, there's slightly different terms that are used. So a liquidity provider is somebody who's going to provide cryptos and say, hey, here is cryptos that I can give to you. You can consider somebody like a depositor. He's going to deposit, or she's going to deposit stuff. They're providing liquidity. And then you have borrowers, right? And then you have some similar bank terms like APY, the yield, right? So if I'm going to borrow or if I'm going to lend, what's going to be my return on investment? What's going to be my yield that's going to be I'm going to be able to make? What's interesting to note is in some cases borrowers can actually make money. They actually can earn interest and make money on borrowing, and which is kind of wild. And we'll see some of that in a bit. About 20 minutes, right? How are we doing on time, Anna? Are we okay? So let me just take a sip here. Okay. 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 So there's a bunch of platforms that are doing these money markets. Compound is one of the bigger ones. Aave, Dharma. There's a bunch of them. There's also Celsius, but they're centralized. But I think the last number I had with them is that they had about $3-4 billion, $5 billion that they're managing in cryptos, right? In the money market that they've created. So the demand for this kind of stuff is significant. Basically, with Compound, a lender parks, and a lender is also, so in order for you to borrow, you have to be a lender, right? So you can only borrow if you lend, right? And so if I wanted to borrow DAI, I can lend ETH, right? So I would lend in, ETH, and I would borrow DAI. I would put it into a contract, and then I would get a yield, and I would also get what's called, in the case of Compound, as a borrower, I would get also Compound tokens. All right, and those tokens have valuations themselves. So if I go to compound.finance, I can see the money market here. If I'm going to lend, I can lend at these rates here, right? And if I'm going to borrow, I can borrow at different rates here, right? Obviously, you'll see the borrowing is more expensive than lending. And when you borrow, the interesting with Compound is when you borrow, you also get not only the token that you borrowed, but you also get comp tokens, which have its own market rate, which can potentially mean that as a borrower, you can actually make more money. You can make money on the money that you borrowed, which is kind of wild. So if you look at the growth rate in lending, I've got some more charts. You can see that lending has increased significantly, especially over the past 12 months. I think total locked in DeFi right now totally is about $30 billion. And this was maybe 1/10 of that a year ago, right? So the growth is significant, right? So that's kind of Compound. Let me just kind of skip to, this is the comp token that you get as a borrower. So the token has its own market rate. And these are some tools that you can use to see if you were to supply and borrow a certain type of token, how much you could potentially make. Okay, and there's calculators out there that can do that for you. Okay, now this has led to this kind of notion of yield farming. Yield farming is the idea that I have Ether, I've got tokens, I'm going to try to park it and shift and search and move around and find different protocols that I can park and make and maximize my APY. Like, okay, I've got Ether, I'm going to park it with MakerDAO. I'm going to pull out these DAI, and I'm going to take these DAI, I'm going to put it into Compound. I'm going to do all these different hops. And yield farming is basically now the strategy of like, how can I do that and best maximize my APY. And so we see tools now coming out that help you with yield farming. An example of one of them is Yearn Finance. You can go out there and it'll help you maximize your APY and find ways to move your money. So there are people that are like they're parking their tokens and they're borrowing tokens, and then they're taking that tokens and they're parking it back in again, and they're cycling it back and forth. And so all these different strategies are involved. And there are tools that help you kind of do that, right? So this kind of yield farming, and there's a bunch of terms around, related to how to do that, like crop rotation and things like that. I'm not going to get into that here, but yield farming is becoming a major way of doing DeFi as a user of DeFi. And this is worth exploring. The other major use case, we can call them exchanges, right? And we've got maybe about 10 minutes here. Exchanges is basically the idea of you're swapping things. So like when you buy equities in a market, you go buy a stock, you buy GameStop, you're basically swapping. It's like, here's dollars, give me stocks in whatever company, right? And it's basically a swap, right? And so these exchanges allow you to do swaps. There's a bunch of different types of exchanges, right? There's centralized exchanges, Coinbase, Gemini, and then there's decentralized exchanges. What was big a year ago, 2 years ago, were like the 0x DEX, the decentralized exchanges that were based on 0x. But what has emerged now is other kinds of decentralized exchanges that are not based on 0x protocol. They are just pure smart contract based, and they just work completely on the Ethereum chain. There is no nodes or relays or other kinds of things. So what I'm going to do is I'm going to skip over the 0x, talking about 0x. I'm going to jump to talking about how Uniswap works, or like one aspect of how Uniswap works. But quickly, a DEX is basically a bunch of computer nodes, a bunch of nodes communicating with each other. These are decentralized mini exchanges that have what's called makers and takers. Basically, market makers say, I'm willing to buy and I'm willing to sell. They're called makers and takers, and they communicate with other nodes, and it's called relay. So there's off-chain search. I'm running a 0x node. I've got a bunch of makers and takers on my node who are willing to buy and sell based different tokens at different prices, and I'm connecting to other relays and saying, hey, do you have a maker or taker that matches up with a maker or taker in my node? And if we do, then the settlement and trade occurs on chain, right? And so we see a lot of that occurring, but that market has not really taken off. The 0x has not really taken off to the extent that we see with exchanges like Uniswap. So I'm just going to jump over to Uniswap here. Okay, and I've got some Python code if anybody wants to, like, they go to how and hits 0x exchanges, and anybody wants to kind of see that the limit order book on any specific 0x exchange, like or relay, like Radar Relay. But Uniswap is big now. Like there's a lot of activity occurring in Uniswap, and so in Uniswap there's two functions that you can perform. You can provide liquidity, like add or remove liquidity. So you're coming in and giving liquidity, and you're taking away liquidity, or you can trade, right? You're basically swapping. Say, here's one token, give me this other token, right? And that's it. So those are the two main functions that you can do in Uniswap, right? We're going to look at a major component. This is actually, I think this is a paper written by Vitalik Buterin on constant product formula, and we're going to see how Uniswap uses constant product formula. And there's something called divergence, where actually when you put money in, you actually immediately lose money in Uniswap, but you can recoup that in other ways. And I'm going to show you how that works with Uniswap. That's why it's important for you, if you're going to trade and play with Uniswap, to understand the economic model behind it. I'm going to kind of give you a quick introduction here on how that kind of works. And I think we'll probably shift to some questions if we have any questions, because we've got about 9 minutes. Okay, so the way that Uniswap works is I send Ether to a Uniswap smart contract. There's a liquidity pool, for example, for Ether DAI, they come in pairs, right? So there's Ether DAI liquidity pool. I send an Ether, I get back DAI, right? And I am a liquidity provider. At the same time, on the other side, they're ETH, they're traders. They're willing to like put in ETH and receive DAI, right? Sorry, the liquidity provider puts in 2 tokens. They put in both ETH and DAI, and they earn something. I'll explain to you what they earn. So I'm a liquidity provider. I've got extra assets. I want to deposit, right? "Quote unquote" deposit. So I take ETH and DAI and I park it into Uniswap, the liquidity pool that's specific to that pair. And on the other side, there are traders that are switching back and forth between ETH and DAI, or they're like, hey, I want here's DAI, give me ETH, or here's ETH, give me DAI, and they're trading back and forth. I am providing that liquidity for the trader to be able to do that. Okay, and so I'm a liquidity provider in this scenario. And let's take it for example, ETH is at $100 and DAI is at $1. It's a stable coin, so it's at $1. So what I would do is I would submit both that the ETH, and I would submit both the DAI into the Uniswap smart contract. So let's say the Uniswap contract already has in inventory 99 ETH. It has 9,900 DAI that already exists in the liquidity pool, and I'm going to come in and I'm going to put something in as well. So I put in equivalent amounts. I've got to put in 1 ETH, and let's say 1 ETH is $100. Therefore, I need to put in 100 DAI. Right, so the two have to be equal. They have to be equal amounts. And so I put both of them into the Uniswap smart contract, and now I'm a liquidity provider. And what happens now is the inventory goes from 99 ETH and 9,900 DAI to 100 ETH and 10,000 DAI. Right, and I've just increased the inventory. Because I've increased the inventory, the Uniswap contract calculates what's called a constant product formula, or a constant product, using the constant product formula. The constant product is a number that I'm going to use later that will tell me how much I can pull back out as a liquidity provider. And this is a little bit different from how trading works, right? But this is kind of the innovation, right? This allows what we call automated market making. Now, just by providing liquidity, I've become a market maker. The algorithm, this constant product formula, is adjusting what I can do or can't do as a market maker in terms of my ability to put stuff in and take stuff out of that liquidity pool. All right. So that formula you can consider it a form of automated market making. And that's the big innovation here. These contracts automate market making. Whereas like in the 0x exchange, I needed takers and makers, which were humans, or maybe they were bots or they were scripts, but I needed individuals to say, hey, I'm willing to buy and sell at certain prices. And they sit there with their store window open, waiting for customers to come in. In this situation here, algorithms are taking care of that, right? And so I don't even have to worry about whether a trader is going to come hit my bid or hit my ask. All I have to do is park liquidity. And whatever happens with the traders, they're trading my liquidity or not, I don't really care, right? I'm going to earn fees and things are trading, and I don't really care. So it bifurcated the liquidity requirements with what the traders do, right? It kind of bifurcated that and separated it out. So before I put my 1 ETH here and the 9,900 DAI in, right, I compute the constant product formula, which basically is the quantity of one pair versus the quantity of the other pair. And constant product here is 980,100, an arbitrary number, right? And we'll see how this number is used, right? Now, if I put in 1 ETH and 100 DAI, I'm going to go in as a liquidity provider. I put that in. After that, after I make that deposit, so to speak, I effectively own 1% of the liquidity pool, because out of that 100 ETH that's in the pool now, 1 ETH is mine, right? And 1,000 out of that 1,000 DAI that's now in that liquidity pool, 100 of those DAI are mine, right? So I own 1% of that liquidity pool, right? And my constant product is recomputed, so it becomes 100 times 1,000, which is now the constant product is 1,000,000. Okay. And so now that I have it at 1,000,000, if I want to withdraw, I can withdraw as long as whatever I withdraw maintains the constant product, And I'm going to explain what that means, right? So this is the key point in Uniswap. This is very, very important to understand, right? If you can understand this, then the rest is just trivial when it comes to Uniswap, right? So I'm in a situation where imagine the price of ETH goes to $120, right? So it was at 100. I put a deposit of 1 ETH and 100 DAI. It goes to $120, right? Now what happens to my liquidity pool? I can withdraw 1% of that liquidity pool as long as I don't change the constant product. So I have to find two numbers of ETH and DAI such that multiplying those two numbers equals 1 million. Okay. And if I do that with ETH being at worth 120 DAI, if I do that, I find that these are the two numbers I compute. And I have a spreadsheet which goes through these computations. If you like, just email me or I'll give it to Anna. I'll post it on our DeFi Discord, which goes into step by step that kind of break down the calculations. If I go to, I'm just trying to look at getting my time here. Yeah. If I compute and I figure out what are the two factors that allow me to equal 1 million, which is my constant product, that's why we call it constant product, because I cannot change it when I'm withdrawing liquidity. That constant product must remain constant, right? And so I have to find the two factors that allow it to be constant, and those two factors are 91.28 ETH and 109 DAI. So when I withdraw, so the price of ETH moves up to 120, and I want to withdraw at that point, I will withdraw such that I maintain the constant factor at 1 million, because that's the constant factor it was at this point, like a second before. I have to maintain the constant factor. And so I pull out that much. And if you calculate that, I pull out $219.09. Right. So I put in $100 in ETH, and I put in $10 in DAI. Right. If I hodled it, my value would have been 220, but I put it in and I pulled it out of the Uniswap smart contract. My value is 219.09. So I lost a few cents on it. And this is known as divergence risk. Right? There's different terms and older terms that are used, but the correct term now is divergence risk. If my price changes of my like the ETH, if the price changes, here's an example of the price changes, like from P0 to P1, right? This is how much I lose. The only time I don't lose is if the price of ETH doesn't change. So if I put in $100 of ETH, ETH is like at $100, I put in 1 ETH, and I pull out at ETH equaling $100, I pull out, then I incur no divergence loss. But if I do that if there is a price change in ETH, whether ETH moves up or down, right, I lose in my Uniswap contract. So then the question is like, why would I? And this is a graph that shows your divergence over price changes. So why would I possibly ever put money in? Why would I possibly put ETH in? Because what's happening is the liquidity pool is actually growing. So your 1% grows because on the other side, the trader is trading, and when they're trading, they're throwing in trading fees into the liquidity pool. And as the liquidity pool grows, your 1% grows. And so then when you do pull out, regardless of Ether going up or down, you can potentially, as long as the trading revenues exceed your divergence loss, you can pull money out. And so that's how you make money on Uniswap. You make money if there's trading activity, much as like how a market maker makes money. If there's no trading activity, they make no money, right? And so if there's significant trading activity in Uniswap, then those people that are providing liquidity are able to come divergence loss, right? They overcome divergence loss and collect their proportion of trading fees. Okay. So that's it. And I've got there's a bunch more on oracles and prediction markets. I'm going to kind of skip that. I just want to share with you guys some tools. You can go to Glassnode. There's a bunch of nice tools there. Yam Finance, some tools there I recommend. DeFi Pulse. is a great website. This is like a year ago or 6-8 months ago. You can see the value locked is about 9.5 billion, and this is today about 27 billion locked in smart contracts. Great tool for that. There's DeFi Rate, also another great tool for you to kind of track what's happening in the DeFi space. Okay, Anna, are you there? Yep. Okay. So I did get a chance to cover the Oracles piece, but I was going to cover Chainlink and Zap. And Zap is, a way to solve front running and a way to solve market making. Please check out Chainlink and Zap and the Zap protocol. So if you guys want to contact me, here's my contact information. Thank you, Anna, for this. Appreciate it. Thank you, guys.
Next up, we have our friends from the Divi Project, Jeff McCabe and Nick Saponaro. Welcome.
Is Nick here? Oh, yeah, Lainey, are you there?
Hey, Jeff, are you there?
Yes, I'm here.
Hey, welcome.
Thank you.
Of course. So we're going to walk through the Divi project. I'd love for you to give a brief overview of what it is, simply for all of the viewers who are tuning in.
Yeah, so we're basically a payment token, a proof of stake coin, and we started in 2017. We did an ICO. We raised 2.6 million. Our market cap is about 50 million now. So we've done exceedingly well. We're one of the best ICOs from that era as far as how much we've been able to generate in value relative to how much we actually raised. So that's one of the reasons people kind of get excited about us, because we've been able to prove that we're able to do a lot with a small budget. And what we're basically focused on is making cryptocurrency very easy. So at the time when we first started, people didn't really understand why this was needed, but now it's become very clear. Most of the cryptocurrencies are still very difficult to use. And so we're focusing, trying to be in some ways like Apple, in that we really focus on sort of all the things that make cryptocurrency sort of painful or scary for users, because to some extent we know that cryptocurrency won't really be adopted by the masses until we have a much easier way of using it, right?
Right. And I just want to go over proof of stake. And just for anyone out there who's just now learning about the Divi project, can you tell us why proof of staking is so important right now, especially in cryptocurrency?
Yeah, well, so staking is an interesting thing. It's when Bitcoin first started, everything was proof of work. And I remember even in 2017, when we decided to do proof of stake, so many people were hesitant to sort of endorse it. Even though it had been around for 4 years or so, people said, oh, this is an unproven technology. We can't trust this. Proof of work is the only way to do it. But we saw right away that proof of stake seemed to be the sort of the future of how money should work. And what I'm looking at right now, as far as proof of stake and the importance of it, is that when we look at regular money like fiat currencies, we're talking about a continually expanding money supply. The governments and the banks expand the money supply through inflation. And cryptocurrencies expand too. So when we look at who gets the rewards for that expansion, it's very different, right? In the case of Bitcoin, it's the miners that get it. In the case of fiat currencies, government currencies, it tends to be the super wealthy that are getting the benefit of the expansion. Proof of stake kind of solves that from a very fundamental level by giving those rewards to everybody. So, for example, in the case of Divi, you only need 10,000 Divi to sort of start winning stakes, and we have ways to do pool staking. So the idea is that if you have some Divi, you're always making more, and people really like that. And so we actually added, from the beginning of our blockchain, we added 3 different ways that you can win more or earn more Divi. So we have what's called master nodes, we call Divi nodes, and we have staking, which is a different type of node. It does different functions with the blockchain. And then we have what we call a lottery block. It's really more like a sweepstakes that's added. Basically, every time you win a stake, you have a ticket to this lottery, and then once a week we pass out a bunch of bonuses to random people. So that kind of makes it a very sort of gamified and exciting ecosystem for participants to be in. Gamification is really important with cryptocurrencies and really kind of any type of marketing or business these days. There's lots and lots of books written about it, and people love games, they love to play. So by sort of gamifying our entire ecosystem beyond what it had done before, it has made it very popular. And it's all designed to sort of keep people excited about Divi and build a brand. So the way I see cryptocurrencies and money in general is that everything has a brand. If you know about branding, you know that brands sort of beat everything. They beat features, they beat profits, they beat just about anything. And if you have build a strong brand around something, it's worth more than almost anything, any aspect of your company, whatever that is. Bitcoin has a phenomenal brand, right? It's, loved by tens of millions of people at this point. And so that gives it a lot of value. And so as a cryptocurrency CEO or founder, creating that brand of what your cryptocurrency stands for is extremely important. So in the case of Divi, I wanted to early on create a brand of Divi kind of being cool. We knew we needed to basically, we compared ourselves to Dash a lot at the beginning. So we wanted to make it sort of better than Dash in many different ways. And that's why we added sort of 3 different staking mechanisms. Dash invented the masternode And what we did is we invented the multi-tiered masternode. So there were 5 different tiers, gamified that. And the reason we did that was to make it so that people wouldn't sell the rewards they were generating with the nodes, or instead would keep them trying to reach the next tier. And that's proved extremely effective. That's why our price has gone up, and we've had so many people get excited about what we're doing. So with the idea with our brand, though, is that I realized early on that probably cryptocurrencies would be adopted first, not all across the spectrum of users, but among young people. When I say young people, I'm talking about high school, even junior high, and college. Those are the people that adopt technologies first. And I started calling that the TikTok effect. We learned in the tech industry that TikTok, it started out as people dancing in front of videos and making these things, and everybody laughed at it, suddenly took off, and now businesses all have their TikTok accounts. So that's the way this whole paradigm of new technology is coming about, and it will happen in cryptocurrency too.
Absolutely. I think you're spot on. I actually have a history of working with brands and building brands, and I think you've hit the nail on the head there. Building brands is all about creating desire, and it's also about continuing to create loyalists for your brand with a good product. Once you've caught their eye and they are desiring what you have, and then you make sure that that product is delivering on what they need, you're solid. You've got your base. And the tools that you're saying that these young people are attracted to that help you market, like TikTok, social media, we're seeing what's going to happen in the future, especially with these social media platforms, as we figure out how to make them more decentralized. I think when we recently saw what happened with Twitter and Facebook and creating a more open place for freedom of speech on Parler, I think we saw that there's a need for a social media platform that is decentralized. But these tools are obviously very important in utilizing, building the base for your brand, and you're right on that. I also wanted to mention I have Adam Manka here. He was just on the Zap.org panel, and I know that Zap and Divi have partnered together in the past, and I'd like to talk more about the technology that you were hitting at, especially when you talk about gamification and looking at these multi-layer chains. I'd love for you guys to talk about wrapping and your partnership together with Zap.
Yeah, absolutely. Hey, Jeff, how are you?
Yeah, it's good to see you.
It's great to see you. So I actually want to touch on something before we get into that, because Jeff mentioned kind of like the gamification of proof of stake and, the sex appeal that specifically Divi has. And they have somewhat of a tiered system combined with, kind of like this lottery reward built into their proof of stake architecture, if you will. And I always found that really fascinating. So your community is like really involved, helps people get set up with Divi nodes. And also, they have this other component where, randomly you're able to, I guess, win a larger reward than typically possible. So what does that look like from like, I guess, like the implementation of that? How many blocks is it? I couldn't remember the exact one.
Well, what do you mean? Like as far as how the lottery block works, or?
Yes.
Yeah, so we just do what's called a super block. So once a week, we have a super block, and that pays out those 11 winners. And it used to be that, somebody could get lucky and win multiple times the lottery. We had 11 different winners, one big one and 10 small ones. We actually just did a hard fork at the end of the year and made it so you can't win. And actually, you can't win more than once a month with a particular address, because we had a lot of people complaining, oh, the rich are getting richer, the rich always win. Of course, they're staking more, they're getting more tickets, they're more invested, they should get more. But we got so much pushback on that. We're like, okay, we'll make it so the rich don't get as rich as fast, So now it's a little bit more diversified, and some smaller wallets are winning. Of course, the rich can just create more wallets and split up their funds, but they don't always do that. So So at least it looks better. And so, yeah, that's kind of what we did. But it's been really exciting. We've had many cases where sort of smaller owners of Divi have won one of these. And, these are people sometimes in Africa or Venezuela where it's a big deal for them. And there's other people that when they do win, some of the big owners, they're very generous and they donate those rewards to great projects or to help some of the smaller owners. So it's been really fun to see that. We really focus on the community, having great people. We think that quality beats quantity. So we're not going for a massive number of users. We're trying to go for people that are really friendly, really believe in the project long term, and are very sort of inclusive of newbies. Because we have a lot of people that come in and they only really have Divi. Maybe they have Bitcoin. They're coming in because they've heard it's easier and they just like the community. They've heard that the community is really friendly. So, and we give them a lot of help. We have people 24/7 in our channel that helps people, that just walks people through anything and everything they need to know to get into Divi or, the different products we're building.
Great. And I guess for the other question, can you simplify?
Oh, if you guys want to talk about wrapping.
Yeah. So I guess like the goal in the discussion and what we're aiming to do with kind of this multi-chain and, trying to port Divi over to other platforms to allow it to participate in DeFi is really trying to come up with a non-custodial version of a cross-chain bridge and allow for, automatic staking. So while you're going cross-chain, essentially what we'd like is like two functions. The first is to be able to port Divi over to something like Ethereum, right? And the second is to make sure that not only is it decentralized, but also there's some kind of mechanism that just allows it to be automatically staked. And therefore, what also occurs is trying to figure out a mechanism by which your stake, while you're holding Ethereum wrap Divi, if you will, it has the capability to grow automatically. So there's no other need for you to be able to pop it in and pop it off from the other chain. Now, there's some challenges that go into that and trying to figure out kind of like how do you get a reliable oracle to tell you what the balance is? How do you have an event watcher? How do you manage the wallets? How do you have them be more secure? Because at the end of the day, what you don't want is something crazy like a flash loan attack. You also want to see pricing that's not manipulated, meaning you don't dictate the price on one end or the other, but you want it to be as equal as possible as it can be on the exchanges. And the way that you do that is by having easy arbitrage opportunities, having enough liquidity on one side so that you'd be able to trade, get on and off. And also the kind of like two-way functionality. Once you pop it on Ethereum, you want to be able to take it back off.
Right.
Mm-hmm. That's what's really interesting to me, is being able to have users automatically move it from one chain to the other, doing it themselves and in small quantities. Because generally when you do wrapping, you have to find a custodial agent, and there's often a minimum, and there's emails and KYC and all kinds of stuff involved sometimes to do these types of manual wraps. So what the Zap team is trying to do is to make it all automatic. It's a lot harder. I'm glad we have somebody as smart as Adam working on this, because it's very complicated and it's a big problem. And once it's solved, it will become something that's very important, I think, in the entire cryptocurrency ecosystem, because there's all of these proof of stake coins that should be wrapped and be available on multiple other chains. So right now everybody's focused on Ethereum because of DeFi, but there's Polkadot, there's Cardano, and there's even chains like Wax, which is one of my favorites. We want to do a wrap Divi there, so that we can basically have NFTs that are paid for in a different version of Divi, or have Divi attached to them. That Divi has to exist on the Wax blockchain to do that. So wrapping tokens is something that seemed like kind of a novelty when it was first done. Everybody thought it was really cool and stuff, but that's going to become an incredibly important part of the entire crypto sphere, if you will, because there's so many different uses, and making all of these coins interoperable is extremely important for making crypto in general easier to use. it's so confusing for the average person to try to understand where and how they can find these cryptocurrencies and what it means to be on one network or the other. Making everything interoperable everywhere is really important. That's why we have one of our main initiatives we call Divi Everywhere. So we're trying to get Divi, some sort of wrap Divi onto every single important blockchain, so that wherever people want it, they can find it, and then they'll have an easy way to move that from one to the other automatically. This is why Zap's technology that they're developing is incredibly important, not just to us, but the entire cryptosphere.
To the entire ecosystem of, building out what we want the cryptosphere to be, to build Web3. So
Yeah.
Yeah.
I mean, once you guys solve this at Zap, it's going to be like a massive use case that nobody's even paying attention to right now. It's very early stages. That's why I think Zap is a really good coin that people should be accumulating right now, because I believe you guys are going to do it. We've had enough talks about it. So I tell everybody, buy Zap. I just think it's a really good.
This is not financial advice, though.
This is what I tell my family and friends. Don't blame me if it goes down, but
it's great technology. So
yeah.
Yeah, and I think like the other thing is, we had about 4 different teams working at it. I only say about 4 because one was 5 and then kind of got absorbed by the other one, and then that's usually how it happens. There was basically 2 suggestions for the custodial versions. Some looked at other projects and how they had done it, which that's most of wrapping is somebody takes custody of it, they issue a token out here, but that looked simpler, but every time you add a trust element, you don't know what's going to happen. And then there were 2, one was like an event watcher with a non-automatic staking, and that one worked, but didn't really seem to go far enough. And then like one of the final ones was a little bit more intricate, in kind of where they're at right now, is looking at the other 2 custodial versions, trying to figure out how like you can sub it out for like multi-party oracles and have some kind of validation. And then also, taking what we learned from the non-custodial side, plugging, what we've learned from each of those and combining the teams up, and then kind of implementing it all. So yeah. I know Nick's guys, we have a bunch of guys all over, and Nick had tasked some people with working on it. They got really far with it. And then we had an internal team kind of that we were working with, and they got pretty far as well. So we actually have some shared notes coming up next week, and we'll see what's going on there. But it's coming along nice.
Yeah, I want to give kind of a practical example of why this is important. So for example, Divi, we have pretty high staking rewards, but in order to stake, you need to set up, the desktop wallet, and you have to have 10,000 Divi. Then you have to get lucky. You have to win. You have to, win this minute by minute blocks, and then you win your stake, right? So right now it's 418 Divi. Once this is moved over to Ethereum, but with the Zap process, then you no longer have to do that. All you have to do is have 10,000 Divi or whatever we set it at. We could basically set it whatever we want. We could make it 1,000, or we could make it more. We could gamify it. We could create tiers of how those stakes are distributed from one blockchain to the next. What that means is that use cases that are using Ethereum could now add Divi very easily. They would add the eDivi that's there, and those applications, simply by adding Divi as a way to pay for it or to pool it within their app. Like say you're creating a game that uses Ethereum, and people have a certain amount of funds in that game because they want to buy and sell nifties, or they want to sell weapons or whatever. So they may have $400 or $500 sitting there, right? So these companies can basically encourage users to use Divi, because they'll be just accumulating Divi within that wallet, right? So people that have that Divi there aren't losing their stakes. They're going to be getting it anyway, while it's sitting anywhere and everywhere. And if the company itself is holding that Divi, that eDivi, on behalf of the user, and maybe converts it into their local tokens, they're now earning the stakes. So this type of staking and this sort of automatic cross-chain staking because it becomes a very interesting mechanism for both users and businesses to make profits in ways that have never been done before. And this is something that can turn into a $1 billion industry over the next few years once this problem is solved.
Absolutely. And you, I think, are getting at something too that you brought up earlier, NFTs and gamification in general. This is the perfect example of why those things are valuable in these new gaming worlds, and creating these NFTs that can provide value within these spaces. So yeah, I don't know if I know you mentioned gamification earlier in another panel. So I don't know if you want to expand on why that's, important right now, or talk about the NFT space.
Yeah, absolutely. I think when you're looking at something like Divi and kind of the approach they take, like trying to go after these games and different things that engage users, right? It's really ultimately the goal to make sure that more people use it and make it as easy to use it as possible. One of the easiest bridges, as I guess like the gaming industry and real life start to like blend, especially like VR, AR, XR, this kind of space. It's a really easy way to prove a use case, because in the game you can train younger people, like Jeff was saying earlier, your junior high, they're all the way up through college. These people are going to get used to it, using it in game. They're going to see how to use it in real life, buying items, NFTs, everything else. So I think Divi's really taking the smart approach there. And as for like the gamification, games teach us at the end of it just more inherently complex things. Like you take something away from it, whether it's a storyline, whether it's emotion, whether it's some financial type of understanding. All these games do is literally teach you skills, and you become better at them. And ultimately, I think the bridge for it is a lot easier in the gaming world. So I think it's Siege Worlds is a really interesting, way to evangelize Divi, and Zap for that matter. I think you're including that in there as well.
Yeah,
If
definitely.
I understood correctly.
We're going to add Zap to everything.
Nice.
Is there, currently, do you guys have a game that someone could kind of get plugged in, get introduced to, Divi and what we're talking about?
Well, we
Is there a
actually
partnership
have,
you have?
I have a media company that I own called Lightning Works. You can find it at lightningworks.io. And one of the things that Lightning Works owns is it owns part of a gaming company in the UK, and is funding the production of a game called Siege Worlds. And Siege Worlds, is sort of a test bed for a bunch of new technologies revolving around NFTs and blockchain and cryptos. So basically the way the game will work is that you pay to play, like per game, and then part of that money goes to the development team of that cryptocurrency. So it becomes a funding source for coins like Doge or even Bitcoin that don't have a funding source. They don't have a foundation that's sitting on a bunch of coins. The fans can go and play with their coin that they love, and it helps fund that coin. And the other thing that's cool about it is basically when you shoot the enemies and you kill them, then you get some of that coin. So it's a way of introducing your coin to new people, because they'll suddenly own these coins. Some of them may just sell them, but others may find out what this is, or they may hold on to them and get excited about it once they do their research. So it becomes sort of an advertising tool for the community to spread this coin around. So what we're planning on doing is adding a lot of the coins that have really great communities that are really passionate about it. And Zap is one of those. Doge, of course, Litecoin. There's certain coins that kind of stand out to me that have passionate communities. And the game itself, basically, for good players, you can, by playing it, you may say pay $2 to play the game. It takes about an hour, but you might be able, if you're really good, you can win back money. So I think people really like that. People that aren't winning money are still having fun. They're getting something back, and they're getting an education in how to play. So what's interesting from my perspective of designing products is that people in the crypto world tend to do sort of these tech demos, but they're often not actually very appealing or fun. And so I'm really focusing like at this game and making it really fun. Like this game has to be so fun and so interesting and innovative with the game dynamics that even if cryptos weren't involved, people would still want to play it. Cryptos just make it better because of the NFTs and because of the way you can play and win back some of your money, right? So the cryptos make it better, but even without the cryptos, it needs to be really great. And so I'm spending a lot of time thinking about that. You know, I've gone over I've been planning this for many years. So over the years, I've been playing all the most popular games to kind of see like why they're popular. I'm asking kids. I have a 14-year-old daughter. She loves video games like every kid that's 14. I was asking her like, why do you like this game? And I ask her friends the same things whenever I get the chance, you know, like grill them, you know, like, why do you like this game? Why did you pick it? You know? And some of the games are it's really obvious how fun they are. You know, you start playing them and pretty soon I've spent the entire day, you know, playing this game because they're so addicting. You know, I remember one of them was Sim City. It was like amazingly addicting game. And
Yes.
so you tend to learn like what makes the games really fun. And so we're having a lot of fun doing that. At the same time, we're making a comic book we're going to be releasing pretty soon. We're trying to be first. There's several companies that are building digital comic books for the blockchain. We're trying to be the first ever to be released, and we're getting pretty close. So we're not sure if somebody's about to jump ahead of us or not, but we think we'll be first. And so we're making a game, a comic book called Siege Worlds. And within that comic book, you'll be able to like find NFTs that you can play in the game. And so we're talking about other companies too, where some of those things that you find could be used in more than one game. Games that are not related to us, not made by our company, but with agreements with other companies, those weapons or magic items, whatever they are, can be used among multiple games. And that's really very exciting. It's a really easy way to sort of tap into the players and brands of other sort of partner gaming companies.
Absolutely. That reminds me of, I grew up playing like Final Fantasy and Kingdom Hearts. And I want to lead this into something else, but you would find these Easter eggs within, you know, those partnerships. And for fans of one thing, that was so exciting. And I think it's so important. I've kind of grown up as a digital native, and I would say that technology taught me math, taught me so much. So what you're saying, you're not only having fun, but you are kind of secretly developing skills that are helping to create this entire universe of, you know, new technology and blockchain and whatnot. I think this is a perfect segue into bounties. You talked about hidden NFTs. I'd love for you guys to discuss bounties and kind of like these hidden treasures within what you're talking about as you go deeper into the gamification of, you know, these different technologies.
Well, normally when we talk about bounties, we're talking about, you know, like I think of bounties like in terms of ICOs where people get paid a little bit of a coin to do certain micro tasks, like, you know, tweeting something. What you're talking about, I'm referring to as Easter eggs. You mentioned Easter eggs, but so you're talking about Easter eggs, or you're talking about something related more to bounties?
I think what I guess I am kind of tying the two in, where in the development process of creating these things, you know, bringing developers in by using or utilizing bounties, and then, you know, once you've started to really develop this, you know, world or game out, being able to leave things behind, like the Easter eggs and the hidden NFTs
I think
and whatnot.
And I think bounties are actually, you know, sort of a version of crowdsourcing in a way. So we could do things, and I've thought about doing this, where you can, with the video game, you can basically offer a bounty, or you can basically crowdsource people to develop different monsters. Like we want to have lots and lots of different monsters for the different waves. I've actually hired my daughter. She's making monsters for me for $10 a monster. She's a really good artist, and it's been pretty fun taking her designs and having the team create them in 3D and animating them. you know, and when she was like 10, she fantasized about being a video game designer. So it's really fun for her now at age 14 to actually see her things sort of coming to life in this and being added to the game. And she's making some really scary stuff too. So it's really fun to see what she can do. And I think that's the kind of thing that is really valuable. You know, I've thought about it, like, you know, we could have a whole force of kids that are kind of creating stuff. I don't know if it's even legal, you know, to have a bunch of 14-year-olds making stuff. You know, of course, for her, I can call it a chore, right? But it's there's so much potential with crowdsourcing, and crypto is kind of natural for that, where you can have people be paid around the world in a single crypto, and people can then create, you know, in our case, it might be different monsters, it might be different models for the monsters, it could be characters, it could be weapons, it could be different things that we put in the environment. And the reason that's really important and how that's sort of natural with Divi is that a lot of the best creators of these things are going to be artists. They're not going to be people that are crypto nerds. They're only going to be interested in doing this for crypto, if that crypto is very easy to use. You know, it's easy for them to convert it back into dollars or Bitcoin. And if we can create basically a wallet ecosystem, which is what we're focused on, that's really easy, then we can bring in all the creative people, all the product designers, all the artists, all these sort of visionaries that make the really good products that people actually want to use. And so what we're doing with Divi is trying to make it so it is the ecosystem for all the creative people. Apple was very smart early on. They really focused on getting creatives in, and that's sort of where I got the idea. But I think that people don't really realize, you know, at the surface, how important it is to make things easy and what that actually does for your ecosystem. When things are easy, people aren't also afraid to get out. You know, right now, you may pay somebody in Bitcoin, but that if they're not familiar with crypto and they get paid in Bitcoin, they will go through the sort of scary and complicated process to get their Bitcoin and then get it onto Coinbase and sell it and then run away with the money, right? But that's not what we want. We want people to hold on to their Divi and hold on to their cryptos. So the products we're making to hold on to this will be very, very easy and fun to use, so that they won't feel the need to run away from the crypto sphere. They'll stay there, and we want them to keep holding their funds in Divi because of all these staking mechanisms. They're earning a lot more Divi than they would be if they're holding it in Bitcoin or fiat currencies.
So I actually have a question for you, Jeff. Why? I guess like what experience do you have that made you want to go for accessibility? Like, you have this Divi everywhere policy, and I wholeheartedly agree with it. Like, get it everywhere you can. But some people really focus very nichely on a specific market. I think you're going after a very broad approach. Is that because you think that you're going to get like 80-20, like one's going to really pop off and then you're going to double down on that? Or are you just going to try to go after the broad spectrum?
Well, part of going after the broad spectrum is that I have a very focused idea, right? I mean, it's, you know, making Divi into something that's being used by 100 million people or more. It's just that there's a lot of parts and pieces that are necessary to do that one focused thing. It's not easy. In the old days, you could just create a cryptocurrency and everybody would buy it because there were only a few of them. Now you have to do, in order to be the cryptocurrency that has a great brand that everybody's using, that everybody knows about, you know, the future is a kind of a moving target, right? It's moving around. What's with all the technologies and everything that's going to exist in 5 years, we have to be building now for that future that exists exists then. And there's a lot of parts and pieces to it. So it does look to people sometimes like we're unfocused because we're doing all these kind of things. Like, they ask me, why are we doing video games? Why are we building a digital nomad space? You know, why comic books? Why all this stuff? And the reason is because of what I went back to, the TikTok effect, right? I believe that cryptocurrencies are going to be adopted first in high school and college students, or even younger. And there will be there'll be a tipping point where all of a sudden in 1 year, every single kid is using cryptocurrencies. They're all sending them to their phones, to each other on their phones. And if you're not doing that, you're not cool. Like, it's going to be uncool to use dollars, you know, and it's going to happen really fast. And we're talking about 100 million kids or more in that age range. And so if you think about it, what cryptocurrency will they use? You know, Well, that's why Doge has a huge potential. Like it is really cool with that dog and everything. Kids will love it, you know.
I think
So, but we want to be there
Yeah.
too, right? And so what I'm doing now is creating a lot of use cases that appeal to that age group. You know, we're going to be creating a sort of a gig economy app that allows you to, you know, earn crypto by doing gigs. And for young people, the gig economy is really important. People don't want to be trapped at a desk. They want to be traveling to Costa Rica, where I live, and surfing in the mornings and the evenings, and working during the day on a whole variety of projects because they get bored fast. And there's just not many jobs available to young people. You know, the older people get all the good jobs, so they have to do gigs. So we're doing gig economy. We're doing, like I said, the digital nomad space in Costa Rica, where we have yoga and surfing and an organic farm and all this kind of stuff, and a restaurant. You can basically live your whole life there if you want, because everything is crypto, right? You can earn crypto and you can spend it on your rent and your food, right? So it's gonna, I don't know if you can do that anywhere, you know?
It's great.
Yeah.
I think also you're hitting on a broader theme. People traditionally didn't have the same relationship with money that we have current day, right? I've been thinking about this in depth for a long time. You read an old book, something like Huckleberry Finn, like one of these books where the people have actual silver, like, or a young kid goes out and earns money. Like, that was perfectly acceptable. Go try and set up a bank account at 12. You're not going to be able to, right? You're not going to be able to work. Like you were saying, I don't even know if it's legal. Like if I'm paying a 14-year-old, it's like the laws have become so ridiculous, like as far as creating barriers to entry for people to be able to exchange value, which is really what it is at the end of the day. And I think we're doing future generations a big disservice by not teaching about money at a young age. And I think a lot of these games have made people a lot smarter because they had in-game currencies or in-game value. Like, you know, sometimes it's mana or sometimes it's gold. But like I was saying earlier, it's teaching different types of principles. And for that, I think the future generations are becoming a lot smarter and a lot more aware how you interact socially, how you interact with money, how you interact with everything else. In addition to that, it's causing like a real big divide, I think, with older generations because they're like, oh, this is the way it's done. It's always going to be this way. But I think we're actually kind of moving back to like this age where people have more freedom and we have different relationships with our money. We have different relationships with our governments. We have different relationships with communication. It's not coming through a static, you know, talking head on a TV screen. It's coming through to you like events like this where people throw something together and you talk about it, and you know, crypto conferences where people are talking about the newest things, or where a trading card now again has value because it's a limited supply and they don't keep rerunning the prints. So there's a lot of concepts at play.
Yeah,
and
so
I think that
I call that branded money, right? So there's going to be brands of money in the future. And like in Costa Rica, people use both dollars and colones. And people often have both in their pocket. People accept both everywhere. And it's two different brands. At the time when it comes, but sometimes people will say, do you want your change in colones or dollars? And you think, well, if I take dollars, then, you know, it may not depreciate. And if I take colones, everyone takes it everywhere. I don't have to do the calculation. Each of them has their brand. They have their features, you know. In the future of money, we're going to have, you know, 1,000 different types of money in your digital wallet, right? And so the branding becomes very important. That's why we want to make Divvy like the cool brand for young people, because they'll adopt it first, and we'll get you know, millions and millions and millions of users. So one of the things that people that are making a decision about what brand of anything to take is, you know, first of all, they ask, is it cool? What do my friends have? But also they ask, like, what can I do with it? And that's especially the case with cryptos. What can I do with it? And so that's why we're making sort of these different use cases for Divvy that nobody else is doing, and everybody else is chasing, trying to make DEXs and doing DeFi and do all this stuff. And we're focusing on these funny little projects that people often ask, like, why are you doing all this stuff? But when I explain it to them, they go, oh, wow, that's really interesting, you know, and people see the potential of it.
And to tie it all together, I think you hit the nail on the head with the fundamental of crypto. Look, not everyone's banked. We have a ton of people out there who are unbanked, right? And crypto solves that problem. We all have a phone in our hands. And when you talk about this younger generation and exchanging money
Speak of
and
the devil.
currency.
The Amber Alert's going off everybody's phone.
And when you talk about how easy it will be in the future to exchange, even if we have these thousands of different cryptocurrencies, branded monies, the technology that we're building now is to have that instant exchange. When we talk about wrapping and we talk about the interoperability between these networks and chains, that's the future. And that's what, building a product and branding it to be that trusted token in the future, when all of that is sorted, all of the problems are gone. I mean, you guys are so early and you already have such a great brand. It's very exciting.
Yeah. I mean, that's one of the problems I think that Zap has had, is that it's so complicated. The brand is confusing to people. It has a great logo and name. It's very simple. And that's why I'm very excited about the Zap 2.0, because it's going to solve that problem. Yeah, because people will be able to see it. There's all these gamified systems, with the listing of the oracles. And once people can see it and use it more easily, that it solves that problem that Zap as a sort of a technology has right now. So I'm very excited about it.
Yeah, I'm very excited about it as well. I think to tie both of you guys together as well, some of the failures in the past, specifically, we used to have all kinds of money everywhere. And in the Midwest, you might have the Central Bank of Wyoming, the Southwestern Bank of Wyoming.
You're talking before the Federal Reserve.
Yes. And one of the problems was there was no settlement or relay mechanisms. And, not everybody was an expert running these banks. They didn't really understand. They went bankrupt all the time. So people all agreed, it's okay, let's try to centralize it because that's the best way to do it right now. But their failures now have solutions, right? So you have instant settlement layers, cross-chain liquidity, market making oracles, MPOs, validators, all these tools, mechanisms that kind of tie it all together and allow for kind of that utopia that everybody talks about, the Wild West, where it's oh, you can do everything. It's well, you can do everything, but also everybody going into it has rules that are established, are enforced, and you can pick what kind of rule set you want.
Creating your own economy, which is what he's talking about, your own marketplaces. Yes.
Yeah. So I think kind of the same way where we used to build huge towers in New York City and people are let's move to Palo Alto, make everybody on the same floor, have this not top-down management corporate structure. A lot of great things came out of it. We're talking you through a platform that wasn't possible 20 years ago. We're going to see that same kind of boon with crypto, where we start really moving up the ranks and doing wonderful things. So I think maybe it's not everybody's vision in the beginning. It's hey, look, this is going to end everything. It's going to completely transition, but it's going to be a flavor for everybody, like Ben and Jerry style.
Yeah.
I think what you mentioned about this wasn't possible 20 years ago, but there becomes a need. And once the opportunity and the development, the work, the processes meet, that's the innovation. And when you look at coronavirus and all of these platforms, Microsoft Teams, these platforms to stream, it's amazing what the world things that happen in the zeitgeist, current events, drive for our evolution as humans. And I think what we're seeing right now in the US with Wall Street and the markets, it's going to drive people into another sector of money. And money needs to compete. It needs competition to grow. And yeah, I think in the next few years, especially, I don't know, as Brock Pierce put it yesterday, if everyone fled tomorrow, the crypto world is not ready. But as we continue to build these things out and have these conversations and support all of these technologies, I think the shift is happening maybe sooner than some people had initially projected.
Yeah. Well, what's interesting about branded money too is that, right now we kind of compare cryptos and fiat, but there's a lot more brands of money that are coming, entire classes of money. There's going to be tokens that represent gold and silver, and basically any type of commodity can can be one. There can be, a coin that represents a whole basket, like a whole basket of fruit futures. Somebody was talking to me about that. Nobody knows what fruit futures are unless you're in that market, right? But you could buy one coin that sort of resembles or represents all of that. And, there can be coins that represent real estate. There can be coins that represent all the real estate of a particular country or a different type. There's going to be so many interesting tokens that sort of cobble together different types of value. And those are all going to be tradable instantly in your wallet and swappable with everything else. What that does is it creates a huge amount of competition between different types of value. So, for example, if you look at how much different types of money are worth, like all the cash in the world is less valuable than all of the real estate in the world. And so once you can tokenize that real estate in some way, it becomes a serious competitor for cash itself. And cryptocurrency, blockchain has the ability to do that, along with the right legal mechanisms. What that does, though, is it helps sort of democratize sort of value, and it makes it very hard for certain individuals or certain conglomerates that want things to be the way they are now with fiat currencies and the way they're built to sort of help the super rich and the bankers make more money. It helps sort of put some real competition into the system, and blockchain is going to be able to do that. And so cryptocurrencies they're a very direct competitor in some ways to fiat currencies, but there's all these other competitors with huge vested interests that will be coming in that will also be able to compete.
Well, I couldn't agree more with your entirety of your strategy. I love the Divi community. I'm a huge fan of everybody over there. I love Nick. I love you guys. And I want to thank you very much for, coming on and talking about Divi. As much as we can get the opportunity, I'd love to talk about it more. It's a lot of fun. You guys do interesting stuff. It's not some of this it's relatable, I think is like the way to say it. It's a really cool, just a community and project.
Thank you.
Yeah,
we've
thank
worked
you so much.
4 years on it now.
Can you actually please tell everybody how they can get plugged in, the Telegram groups, Discord, and
Yeah, generally you can search anywhere for Divi project. You can go to diviproject.org, and from there you can find, we have a variety of different websites. We have different products under development. We have a mobile wallet coming out soon that's really going to be spectacular. We're just, we're so picky about every little detail. We've got a bunch of people on our team that just want everything to be perfect. And like my partner Nick was saying, he's using it, our beta version. He says for the first time working with cryptos, sending and receiving, it's actually fun. It actually makes it fun. And so we really added that as a core plank to our strategy. Things have to not just be easy, but they have to be fun. And, money is serious business, but it also needs to be fun if people are going to use it. And if you can make your brand of money fun, people will use it a lot more than the one that isn't fun. So that's part of our strategy.
Favorite part about Divi? Live at 5, even though I don't want you to go over there right now. But live at 5 is great.
Yeah, we're doing it.
There
we're doing it today. I'm actually in San Diego right now. And so Nick and I will be sitting side by side for the first time ever at our live at 5. That's going to be in 3 hours.
That's amazing. All right. Well, thank you so much. It was such a pleasure talking to you. I can't wait to see what happens with the Divi project. Love the partnership and everything we've seen so far. So I'm interested to check in 5 to 10 years and see where everything's at then. Thanks for coming on and hosting this interview with us. If you're watching, please stay tuned. Up next is Brittany Kaiser, the whistleblower of Cambridge Analytica, featured in the Netflix documentary, The Great Hack. Stay tuned.
Hey guys. Great. Okay, I'm live. Wonderful. Perfect. Hope you guys are all enjoying Miami Blockchain Week. I wish I could be there with you guys in person. It's been a couple years since I've been to BTC Miami, and it was so much fun last time I was there. So I hope everyone that is there in person is enjoying that, is enjoying the Blockchain Center house and the hackathon and everything that's going on. And for all of you guys that are joining us from a decentralized location, well, you know, join the club. I'm joining you from Austin, Texas, and I'm so happy to be here. So really happy to be back again. I know I spoke on a panel with Trent Poole, and Mr. Nick Spanos also joined us last time to start addressing what I would call is a really hot movement right now in blockchain legislation. So right now we are in a situation where we still don't have a lot of federal laws that protect and define things for the blockchain industry. So if you are an American, a couple of years ago, you probably didn't know anyone that was establishing their blockchain companies in the United States. We had hardly any legal definitions that actually gave us clarity. And for the people that dared to start their companies here, so many people were having to give their money back to investors, or they were getting in trouble with the SEC, not really because so many of them were bad actors or had chosen to do something wrong, but because digital assets and the distributed ledger technology space had not been well defined in legislation. And therefore, things were being over-regulated in a gray space that lacked definition and lacked really like easy to understand rules for entrepreneurs to pay attention to and to go by. So the way that this started to be fixed, I'll go back and tell you a little story of exactly how this came about, which was that Caitlin Long, who many of you have probably heard of, was trying to make a donation to her alma mater where she had gone to undergrad before going to Harvard and going to Wall Street before ending up full-time in crypto. But she was trying to donate in Bitcoin to her alma mater, the University of Wyoming. And she wanted to make a donation specifically to provide funding for more female engineers, right? And she wanted to provide this funding in Bitcoin. And what she found out when she was trying to make this donation was that it was illegal because she didn't have a money transmitter's license. So not being deterred by that piece of information, she sought out legislators who were interested in introducing a Bitcoin exemption to the Money Transmitters Act so that you could donate or make payments or receive payments in Bitcoin without having a license, right? Which obviously makes sense to all of us in the industry, and that's what, you know, how we expect to go about our business, but that's a new concept, right? So they started working on this at the end of 2017. So come January 2018, and Caitlin Long goes to the Satoshi Roundtable annual conference and starts talking to quite a few other blockchain entrepreneurs about this and saying, you know, this is something that we really need. I think most people agreed at the time that it would be great for people in the industry to be able to actually start and grow businesses in the United States of America in the DLT market, in the blockchain industry, right? I think everyone was on the same page there. So this made a lot of noise at Satoshi Roundtable, and Brock Pierce happened to mention this, like, oh, hey, you know, there are some new laws that are being written in Wyoming, and they're going to be introduced to Congress. And I got really excited, and I was like, hey, you know, I have spent a lot of my life doing lobbying. So helping write new laws, helping write amendments to laws, and helping get those laws passed by talking to legislators about why those laws are important. My background is in human rights law. So I traditionally have always worked on legislation that helps individuals secure their rights. So both internationally as well as locally. And so that this really spoke to me in general, because I think most people listening to this would agree that owning your value, owning your finances, and therefore your digital assets is one of the greatest ways that you can protect your own rights, where no one can take that away from you. And so I really saw this as, in a way, an extension of human rights law, because how can you protect your own rights if you don't actually own any of the value that you create in your life? And so to me, this was really straightforward. Like, obviously, we need to define our digital assets in law. Obviously, we need to give people rights to these digital assets, and we need to allow people to be able to freely trade or create businesses in this industry, and not have this kind of massive gray area that makes it so difficult regulatorily for anyone to really build and be confident building and spending so much of their blood, sweat, and tears, creating a company, right? So I decided to quit my job. For those of you that that know me, at the time I was working at Cambridge Analytica, and most people don't know exactly why I quit. They think I quit to become a whistleblower. I quit I quit in order to fly to Wyoming and start working with the legislators there. So I flew there to meet Caitlin Long after I was introduced to her by Brock Pierce, and I got there and they were introducing two bills to Congress, and one of them was this exemption to the Money Transmitters Act. And the second one was a definition of digital assets. For the first time, that saying digital assets are a new asset class that needs to be defined by new legislation. But first, we're going to start to make some definitions of what this asset class includes. This bill included a definition of a utility token for the first time in law. So separating tokens that are just used in order to run or power a network from actual securities. So this was a massive challenge to the SEC to say, hey, we're going to exercise our state rights, and we're going to say that you do not have purview over every token that is ever created out of a blockchain company, because a lot of these tokens are actual utilities. They're not meant to rise in value. And if they do because they're on open markets, it's not because they were designed that way. They were actually designed to power networks. And we need to make sure that we have that defined in law. So that was really exciting. And I sat there in Wyoming working with not just legislators, but the banking commission and blockchain entrepreneurs that flew in from all around the world. We had some incredible legislators like Representative Tyler Lindholm, who was the first person that started writing laws around, and he wanted to get rid of the Money Transmitters Act altogether, let alone just do a Bitcoin exemption. But he was very pro BTC and was working with Caitlin. And we had all these incredible legislators that were very motivated by the fact that there were hundreds of blockchain entrepreneurs flying in from all over the world to say, hey, I would like to build a company in America, but until you create these laws, it's, I'm not going to do that. I'm not going to risk all my time, my capital, my money to do that, and potentially have it all taken away from me. That doesn't make any sense. And so we were there meeting with legislators, meeting with members of the Banking Commission, explaining to them how important this technology was, not just to us, but to the economy. And that if the state of Wyoming decided to stick its neck out for the industry, that guess what? They would really reap the benefits, because right now there was no safe haven for blockchain entrepreneurship in the United States of America at all. And whether it was, a large group of Americans that wanted to create their companies in their own country, that's one thing. But there were also people flying in from Switzerland and Singapore and Hong Kong that said, hey, I'm not even an American, but I would start a company in America if you had laws that protected me and my company. And so from there onwards, we've now passed 20 blockchain laws in the state of Wyoming. Many of those have been passed completely unanimously in terms of the vote, which is incredible. We have done everything from pass the first ever crypto banking license. It's called a special purpose depository institution, or a speedy bank license, if you are just reading the acronym. And that allows for the first time a bank to be created that just deals in digital assets, which is really exciting. Kraken actually got the first license that was issued. So Kraken is America's first 100% crypto bank, which is very cool. And then Caitlin Long decided to stop working in traditional finance and moved over to creating a bank herself. So Avanti Capital, that is completely focused on institutional clients, which is also very exciting. So those two licenses have just been introduced, and it's really great because this is for the first time where you're seeing a bank that has laws around, fiduciary responsibility to clients. So your responsibility is first to the well-being of your client and their assets, not to just creating profits for shareholders. So we're looking at these ethical business models in terms of how digital assets are handled. So that's pretty exciting. And we've really written and now passed legislation that covers so many different things. And I now sit on the subcommittee for data definitions, on the standing committee for blockchain, fintech, and digital innovation, the congressional standing committee. So what we do in session these days is continue to draft laws that have to do with this industry and with digital innovation in general. But for instance, we're writing laws that create an LLC structure that are just for DAOs. So distributed autonomous organizations now have a registered LLC company that allows it to operate in a legal manner and a way for that to be registered, et cetera, and so forth. So that's pretty cool. That took a long time to actually put together that structure. We're now writing laws such as anti-SIM swapping legislation for the first time that puts more regulatory compliance and data privacy precautions on telcos. So obviously, a lot of people in the blockchain industry have been targeted by SIM swappers and hackers, and so that is also a new piece of legislation that we're trying to get through this year. We're writing the first ever laws on digital identity to actually define digital identity in law and give us the rights to protect our personally identifiable information, or PII, and to use digital identity standards and platforms to go out and interact in our digital lives and to have that accepted by companies and governments. It's really getting very exciting. And so, I wanted to break for a moment to say, Wyoming has been such an incredible example of what is possible when entrepreneurs work with legislators. So a lot of you out there, you might think the government is here to regulate me, not here to help me. Well, that's not true. It depends who in the government you're talking about. And the more time you spend with people who have been elected to government, or the more time you spend getting your friends elected to government, then those people are really looking out for you and they want to hear what you have to say. They want to help you. And so it's been such an incredible experience to work with legislators that do really care about this industry and are specifically really motivated to help us build our business. I mean, Wyoming has now had thousands of companies come into the state, including big companies like Kraken and Cardano, right? So there have been now, minimum, when Bitcoin was still at 10K, the amount of assets that had moved to Wyoming was already over $10 billion. Now it's probably closer to $30 billion that has moved to Wyoming because of these laws. So obviously other states are starting to take notice of that. And what that means is that there is now a movement within the community to start to think about how do we get some similar laws at least passed in other states so that we can start to hope that we would get some federal laws passed sometime soon that will apply to the entire country and will make everyone feel a lot more comfortable building and doing business here. Because I think, you know, we'd all love to see that. And so there's some really exciting movements with quite a few different states. Like since Wyoming passed the first package of around, I think it was 13 laws in 2 or 3 different sessions that we did, that's when a lot of other states started looking into that and saying, okay, well, we want to try to pass these laws too. And that was still when, you know, I suppose like 2018 crypto is a buzzword, but still the blockchain industry hadn't become, you know, institutionally acceptable or as attractive as it is today. So this year is the right time for this movement to really be picking up speed again, and for states to really start to consider making similar moves to Wyoming. That is for a number of reasons, not just to attract companies from other places, because first mover advantage is really with Wyoming, but it's to make sure that everyone that is from that state and lives in that state are building businesses within that state. It's so that the government and companies in that state have the ability to use 21st century technology in order to properly conduct transparent and trustworthy transactions and business. You know, the state of Wyoming now has all of their land titles secured and registered on the blockchain. One of their biggest industries, beef, they now have all of their cattle on the blockchain to be able to prove from the time the cows are born to the time that they are purchased by a consumer, that that is verified from the field to your house, and you know exactly where it came from, the exact farm that it came from, what that animal was fed. Beef Chain is the company that built that, the first USDA approved blockchain company, right? So that tracking and traceability, that transparency in the food supply chain, so exciting. So tons of states can take advantage of these practical applications of blockchain. I would say after this past November, we're hopefully going to see a lot of states, either county by county or by state, start to think about blockchain voting. There have been 5 states that have already conducted blockchain voting. And I think, you know, when we're in a situation where no one can agree on whether we have actually counted votes properly and we have to do recounts, well, guess what? You know, there exist technologies where these votes can be tabulated and registered on a blockchain. We can be secure in the numbers that we are seeing and receiving. And that's really something that we need to start to move towards. So I think there's just so much motivation for states to start doing this that, you know, I have been working with some incredible people that are both hosting this conference and some that actually might join in this conversation at some point soon, to start to assist other states in understanding how they could possibly pass some of these laws. We had a few really exciting developments over the past couple of weeks. North Dakota has just dropped their first blockchain bill. I believe South Dakota is joining as well. And we have, I don't know, I think about 12 other states that might be dropping bills in their next session, either current session that is about to happen or in their next session, which is really, really exciting. So I think there's going to be this huge wave of momentum that just gets bigger and bigger this year. And it really takes all of us pitching in and getting hands-on on this for that to really work. You know, I don't know if so many of you guys have ever called or written to your legislators before. If you haven't, it's really easy to find out what that, like who represents you if you don't already know, and what are the different ways to contact those individuals. So look up your representatives, look up your senators, and write to them. Even write to your state officials, write to your banking commissioner, and just send an email. You can even call their office. They're not going to pick up, No one's in their office. And in general, they don't pick up. They listen to the voicemails that are given to the public number. And so you can just call and say, hey, I'm a blockchain entrepreneur. I'm a developer. I'm an investor. And I would love to do more business in my own state. Can you please look at passing digital asset legislation? Can you consider, a positive outlook on the blockchain industry and start to think about those laws and policies? Every time you leave one of those voicemails, every time you send one of those emails, that's an extra data point that means that basically gives those legislators the ability to really know that they have to take action on those initiatives. Every time they get one of those, they then at a certain point are legally bound to taking action on those topics. So if you didn't know that, you do now. And I really hope that everyone listening to this even writes, one email to one of their legislators. But it's so easy. Once you write it once, you can send it to everybody. And it's a really easy way to be active on these topics. Is Trent here? Have we got him?
Hey guys.
Yeah, perfect timing.
I'm in Santa Fe and I couldn't find I couldn't get a coffee shop. Everything's closed down in this city. So anyone planning to travel to New Mexico, just be mindful of that.
Right. Well, it's looking good in there. I just took everyone through kind of the history of the movement in Wyoming and, what they can do to start to be involved. And, that we're starting a movement with getting different states who don't have blockchain laws to start introducing them. So maybe you want to give them a little bit of an update of, what that organization looks like or what are our next steps and, how people can start to get involved and help.
Yeah, certainly. Thank you, Brittany. We are in the process right now of getting bills filed. So everyone who may or may not have any activism or advocacy backgrounds, sessions usually pick up right after the election, the first weeks of January. People start getting sworn in, and then they go immediately into writing bills and drafting legislation. Some states allow you to start drafting legislation immediately after the election's over. Others have times you wait, periods where you file, and they all pretty much start ending about the first week of February. There are some that allow you to keep introducing afterwards, and you can even intro into the summer sessions. Every state is different, so it's a very decentralized, not one size fits all approach to how you combat these. But in the states that we're kind of focusing on, which are the states in the frontier states, kind of near Wyoming, and in the area that tends to be more rural, we're in the phase of getting legislation introduced. And as you know, some states have already passed. The Dakotas passed. South Dakota's deadline was this last Wednesday. North Dakota's was the week before that. Nevada's is on the next week, Monday, and New Mexico the same. So a lot of legislation is getting created right now and pushed through. Utah's was 2 weeks ago. Utah has a great blockchain voting bill. They're going to expand the voting systems they already have in place there, and there's a great provider there with Votes, who I know you were there when Brock got the first ballot for president ever cast on the blockchain.
That was huge.
Yeah. And that was from the vote system in Utah County. So hopefully they'll be able to pass blockchain voting in Utah. Multiple other states are on board. We're looking at a good portfolio, about 10 states that will be trying to, not make every state Wyoming, but certainly preempt anything that could be prohibitive at the federal level. So, Wyoming's a special state, and no one wants to, they have the most favorable blockchain laws, banking laws. It's certainly the most competitive state for anyone who's looking for an edge in the industry, and they've gotten $20 billion plus of market capitalizations of thousands of corporations that have moved there. No one wants to take that away from Wyoming, but we certainly want to see competition amongst the states around there. At least allowing people, like you said, to own digital assets, right, and things of that nature that are a little more benign. And as you know, there's a lot of people that probably don't want to see things like that happen. It's the usual banking associations that we're going to be educating on a case-by-case scenario. And so we have a lot of work to do, and we're definitely looking for people who are interested in helping draft legislation, helping speak on topics, helping us organize, helping us do outreach, and kind of run the micro campaigns that will be needed on each state-by-state case. And so if anyone's interested in that, you can please reach out to me or Brittany or the Blockchain Center. They're very involved in this project. And yeah, I think that it's going to be a lot of fun, and certainly look forward to the battles ahead. So thank you all for having us.
Absolutely. Yeah, no, thank you so much, Chen. I think that's really what we're asking everyone for. As I said, what pushed us over the line in Wyoming was the blockchain industry getting involved. So, if you have time, as I said, the easiest thing to do is to write to your legislator and tell them that you care about blockchain and digital asset legislation. If you want to get further involved, if you have businesses in certain states where you'd like those laws to go through, or you have an expertise in the industry, we'd love for you to testify. All you do these days, you don't have to fly anywhere and show up in Congress. You can actually just come in on a Zoom, or you can do a phone call with a legislator and tell them about why this stuff is important to you. It's really the more hands on deck, the better, because every voice counts. Every voice that a legislator or a banker that's never heard about these types of technologies before, doesn't know a lot about them, that just gives them more confidence to move forward and vote on legislation that they might feel like is a risk, but after they talk to all of us, they probably feel like they're just a part of something that is inevitable, right?
Yeah, and I think that's the biggest battle isn't really trying to get people to do what they don't want, is just educating them and informing them that their preconceived notions or misconceptions about this stuff really isn't correct. And once we get through that, we tend to all be holding hands, singing Kumbaya, and right to the promised land of the libertopia dream that we're trying to build here. But you were actively involved in Wyoming, and I know you mentioned it, but thinking about legislation and the process of getting legislation enacted, it's a pretty Sisyphean task. People don't want to listen to you if you're grassroots. People don't think that you're serious. The legislators themselves are having to combat and manage their time. And so the fact that you guys were able to go into Wyoming and get 19 bills passed, 20 bills.
20, yeah.
Most passed unanimously is I don't know if it's ever been done before. I would be shocked if it had, for a portfolio of bills for one industry without a cater or a platoon of lobbyists from every edge of the world coming in there. I mean, it's pretty it's a pretty big, it's an epic feat that was accomplished, and I think that's a testament to what the movement's capable of, and what this technology actually does is it's democratizing the monetary system for a lot of folks. It can be democratizing the vote for a lot of folks. It can be democratizing data. It can allow us to understand property rights, and so many different pillars of blockchain technology that can be utilized for the common good and the welfare of the people and the everyone who plays a role in a state. So I hope that we can be successful, and I appreciate everything you're doing and helping us on this path, and everything the Blockchain Center of Miami and New York are doing to help us make that mission accomplished.
Yeah, absolutely. It's totally a people's movement. And I love, Trent, that you mentioned that in general, like this is something that takes tons of expensive lobbyists like flying in from all over to accomplish. And, no one got paid $1 to do any of this. Like we just literally drafted in blockchain folks from all across the planet, and everyone just flew in and showed up. And, you know, legislators in Wyoming that don't usually see people that are not from Wyoming, all of a sudden are surrounded by 150 people from all over the world, from countries they've never even thought about, and are hearing why, you know, America needs to have blockchain laws so that this industry can, you know, be able to build things in America. And they were shocked, like shocked into submission, enough to say, like, all right, all of these people have obviously on their own time, on their own dime, decided to come here because they're just so passionate. They want to tell us how important this technology is to them. And okay, well, I guess we better listen. And, you know, after enough meetings and enough weeks and months and now years, like now it's something that people are able to champion, and they get it. Like I just feel like now we just have this wave of momentum that is, I would say, unstoppable. I also like to say inevitable. You know, you're looking at the markets right now, and it's obvious that if states don't have laws where you can build a blockchain company, they're missing out. And our country not having unified federal legislation yet, it means our country's missing out. So, you know, we can do our part to make sure that parts of this industry are comfortable building in America and have that, you know, stability and reassurance of legislative and regulatory infrastructure to feel comfortable, you know, building their dream company here as opposed to somewhere else.
Yeah. And, you know, that's a great point you bring up, Brittany. We states are, in the conversations we're having, you know, is right on that topic. You know, the federal government's inaction and not giving us clarity isn't meant for us to not take action. You know, I agree in a hierarchy or supremacy of the law, and you know, the federal government does control what states tend to do, but there's also a great inherent small government 10th Amendment argument. If the federal government doesn't act or do something, the states absolutely must do something, because in the case of Wyoming, it's created this whole economic stimulus. There's going to be a windfall of revenue, regulatory capture created. And, you know, now with COVID, there's huge deficits and voids and gaps that the comptroller's offices don't even know what to do with. Some are just now floating the idea of finally coming around to legalizing marijuana. I don't know why it's illegal, but they're now thinking, well, maybe it's the time we have to do this, right? Well, we shouldn't come to that point, and that shouldn't be the you know, the critical mass that causes people to want to innovate and keep on parity with countries and states that are well beyond us in this technology. China, Russia, you know, it really is a digital arms race to the finish line for supremacy and sovereignty. And, you know, I don't want to say it, but, you know, if we don't get our stuff together, these countries will completely demolish us. So we need to be encouraging. We need to foment economic development. And I certainly think that every state should be doing that as much as possible for their people, for their citizens, and for their local economies, especially now with all of the new mounting obstacles we face. So,
I'm so glad you brought that up. Honestly, like it was such a pleasure this summer to be able to, you know, work with you and work with Nick on the Brock Pierce for President campaign, where we got to talk about the importance of the digital dollar. And that's where Brock started a lot of conversations with legislators, just because they didn't understand the competition that we're up against across the world, especially with China. You know, China is releasing the digital yuan. What do you think is going to be used for global trading? Something that is more transparent, which is not usually what we would say about Chinese money, but something that all of a sudden is now transparent and fast and efficient and easy to trade with. Like, that's going to come first. And I know a lot of blockchain entrepreneurs and developers that are partnering with the Chinese digital yuan project, because there is a government blockchain project for their national currency to partner with. Obviously, we know that these conversations are going on behind closed doors in the United States, but I don't think there are many blockchain entrepreneurs that feel that they can go to the US government and get a partnership to build on the digital dollar. Like, that's not something that is available to people right now. And so we have American entrepreneurs that are working with China instead, just because the opportunity is there and the innovation has already been flourishing over there. So I think we have a duty as people that expect to, continue to be Americans and continue to want to build our companies here, to explain to our government how far behind we are, and that it doesn't have to be that way. Trust me, American blockchain entrepreneurs are going to be very happy to get us up to speed. So we just need to get the green light from legislators that say that we're going to be safe to do so.
Yeah, that's the best thing about the people in this space, Brittany. You know this firsthand. The guys that are coding and working with distributed databases, everyone is such an honest person. They have probity. They're not disingenuous. It's not, people aren't trying to pass these laws to go become gazillionaires. That's already happened because the industry's been blessed with this economic surplus because it's got its intrinsic value. The fact that you can transfer this anywhere, low fees, low transaction fees, the network effect. It literally is a gift from God in the sense, or whatever God you believe in the sense that it just keeps on proving itself time and time again that this should be the standard, and that's why other countries are going into it, and we are behind. And as an American who loves our country, who does believe we are the land of the free, home of the brave, we really should be. We should consider our duty to go into the legislatures and encourage our friends and colleagues and people that we've given our trust and entrusted to write good law and legislation to say, look, man, it's time to steer the ship on course and make sure we're on parity with the countries around the world. And I know that you've done it, and I look forward to tapping your brain and going 100 miles an hour on this path with you. We're definitely in talks with a lot of states, so it'll be exciting to see how that unfolds over the next week, and especially over this weekend. So,
absolutely. And so, for the sake of our audience that's listening, we have already dropped bills in North and South Dakota. Possibly about to do something in Nevada. And what are the other states that are coming up, Trent?
Utah has blockchain voting. That's very exciting. We have bills in Nevada, New Mexico, Michigan, possibly Wisconsin, Texas, Alaska, Idaho. And we missed a couple deadlines, but we have some amendments possibly in a few other states. And we'll see where we end up after the dust has settled. I think that we have a pretty ambitious portfolio, but we'll definitely be focusing on our campaign efforts around a few of the more promising states. And just so everyone knows, not every state is to pass. I know Wyoming passed 19 bills. They range in everything from banking to distributed databases to property rights. And they really run the gamut of all of the pillars of blockchain technology. And probably the one that they didn't hit on out of the 6 or so pillars is voting. Is that correct, Brittany?
Correct.
And I know Wyoming now is partnering with a few companies in the space, so they're actually moving into that 6th pillar, which is really exciting for Wyoming. They're basically knocking it out of the park. A lot of the states, it's not strategic to go in there and just kind of throw everything against the wall and see what sticks. So while Utah may be able to deal with voting, we're not trying any cryptocurrency regulations there or anything dealing with banking. And then in other states, we're trying to tokenize energy, utility, production, and actually introducing cryptocurrency stuff. North Dakota, we're codifying property rights in other states like South Dakota, just allowing people to own a digital asset and explaining what that is. And then in other states, we are focusing more on voting. This year is really exciting because of the election irregularities, or I guess irregularities in quotation marks. It depends on who you're talking to. I think there was nothing regular about the election in general. So from many perspective, you could say that the election was very irregular. But in the campaign, certainly were, black swans as far as insanity. But I think, that certainly provides a lot of good opportunity there on blockchain voting. and to experiment with distributed databases and distributed ledgers and the ability to hash things and prevent systemic fraud and some of the hacking fraud that people claim to have seen. The allegations I know are unfounded and unproven, but there is enough worry to where people are holding hearings and things of that nature. Blockchain technology, one of the pillars is voting, and it's been utilized in boardrooms for the last decade. Multiple companies have been providing this technology, and I know states, as you mentioned, have experimented as well. So that's a really exciting development, and I think that there's a lot of promise there and a lot of opportunity, and I'm really excited to see where that goes. And if anyone wants to be involved in that, please, again, reach out to anyone at the Blockchain Center. I'll provide my personal email and cell phone. I know Brittany will too. We'd love to have people. We're building team right now in many states. So if anyone has a connection to any of the states we mentioned, we'd love to have you on board. So yeah.
Yeah, absolutely. Totally. As I said before, this is an all hands on deck thing. So if you guys are interested in helping, like, please reach out and we can explain to you the different ways that you can help, because it could be as simple as writing a letter to your legislator in a state where we don't already have enough people that are writing. Like, everybody should be writing, but we can give you like draft templates to send those emails. If you're interested in testifying because you're a blockchain entrepreneur or an investor or a developer that that has a concern in the industry where you want to see new things, like, reach out to us. We'll give you an opportunity to get involved, because I know it's not just me and Trent that find this exciting. I've brought tons of people to their first ever kind of congressional testimony or interaction with the legislator, and they never thought that it could be so easy or so straightforward or so rewarding, right? So we're very happy to get you guys involved. And yeah, so just reach out to the Blockchain Center. We'll make sure that they have all of the information, and we really look forward to working with all you guys.
Yeah, thank you guys so much for having me. I'm gonna log off right now. Please stay in contact, and let's have a good year.
Absolutely. Thank you guys so much, and we're looking forward to seeing you out there. Anna, Nick, and everyone at the Blockchain Center, thank you guys so much for hosting us again, and we'll make sure to give you guys all of the information you need to make sure that if people want to get involved in these efforts, that they have the opportunity to do so. So enjoy the rest of Miami Blockchain Week. Enjoy the hackathon and BTC Miami. Wish I could be there again in person with you guys, but enjoyed a little extra for me. And I'll see you next time. Have a good one, guys.
Thank you so much, Brittany and Trent. Brittany, we always love having you. Thank you so much for all the expertise and knowledge you bring. If you haven't seen the Great Hack documentary on Netflix, be sure to check it out. It's so important and it's an incredible documentary. Up next, we have 4 panel experts talking about privacy protocols and stablecoins. Stay tuned.
Good evening, everybody.
Hey.
Hello.
Where's everybody?
Where is everybody? I am in New York.
Cool, cool. I'm right next to you in Boston.
All right.
Chicago, Midwest.
Nice. That Chicago DeFi Alliance.
Yes, they're based quite close to me. We're also known for hot dogs and pizza.
Well, do you want to have a some debate over that one?
This is the pizza panel, right? I'll defend it to the death, but we don't have to distract ourselves from the more pressing issues.
Right. So stable coins are here. Yeah.
And more specifically, secret stablecoin transfers.
Sounds good to me. Then the Tor can take the evening away.
Yeah, how to begin? I'm happy to talk about any aspect of this. We've been looking into privacy for everything, and transactions is a piece of that, and then private stablecoin transactions is another piece of it. But I don't want to take away from people who are working on sort of like we're more on like the technology supply side. I'm curious what people think of the demand side, like what the demand right now is looking at for stablecoins and private versus public stablecoins. I'm even trying to get as a like somebody building out the products and the protocols, trying to get a better sense of where users and governments and enterprises are thinking about these issues right now.
I don't know who's moderating this, but probably the right place to start is to introduce ourselves first, right? I'm guessing.
Yeah.
So, I mean, since you have been talking, Tor, why don't you start?
I'll make it really quick. I'm Tor. I'm the founder of the Secret Foundation, one of the many entities contributing to Secret Network. Secret Network is a blockchain that features privacy-preserving smart contracts that use encrypted inputs, outputs, and state. So the ability to build new kinds of applications in Web3 that have never existed due to that fun and interesting functionality. And I guess we'll get into some of those potential applications here.
So when did you first hear about the Tor network? Is that when you wanted to do a secret stablecoin network?
That's a coincidence. What about, I don't know, maybe we should just keep going around it. James, you should probably introduce yourself as well.
Sure. I'm James Waugh. I work as a community manager at Near, and I used to work with Tor at Secret Foundation. So I'm part of the Secret ecosystem and very interested in privacy, identity, all things decentralized organization. And, Near is layer infinity. What more can I say?
Layer infinity. The future is near.
So is the past.
They're all one.
Yeah.
I'll go next. Yeah, I'm Haramurata Thompson. I'm the CFO and CIO of Celsius Network. It is the crypto operating company that does the crypto lending being the sort of major core of the business. We look into all other ways to keep the community happy by allowing them to make money on their crypto token.
My name is Richard. I'm CEO of a decentralized Celsius called Quid. Quid.io is a Near and Polkadot lending protocol. And it uses a mix of uncollateralized, collateralized, and fiat collateralized models. And
very cool.
Product stage.
Nice. And you live in a spaceship.
I do. We're still a cave at this point, but once we attach engines to the wings.
Yeah, absolutely. Well, it's pretty interesting. So we've got at least a couple protocols and a couple of these very interesting platforms that probably deal with a lot of this user level demand. I'm curious to learn more about both like Celsius and Quid and their approach to this stuff, because I've heard actually Alex talk about Celsius. I heard him on Crypto Banter or one of those programs, and I called in like a weirdo, and I asked him about privacy, and he was like, I don't think people really care about that. And he got me really mad. So I want to know if you agree, if you think people really care about privacy.
I think privacy is something that, when he said people don't care about the privacy, I'm sure it means like, we can use the public blockchain, and certain information can be made public. There's no reason to keep everything like, sort of all the transaction sort of behind the door. I'm sure that's what he means by that. He doesn't care about the privacy. If that's what he said. He speaks at a lot of different events. He's probably talking about 10 times a week. So, I don't catch him talk on every show, because if that's what I do, then I wouldn't be working and I wouldn't be doing my job, right? We do care about privacy, and what's confidential is confidential, and obviously Celsius going for full sort of regulations and a license and all that kind of stuff around the world. What needs to be compliant and what needs to be private, we actually do respect what needs to be done. So keeping the sort of personal information, client data, that's something that we really, really care. Now, in terms of user privacy coin versus a public coin, so to speak, we do support some of the privacy coins. We don't, as long as it's trackable, if you know what I mean. So privacy is privacy, but at the same time, we don't want to get mixed into some kind of undesired business, right? That's not what the blockchain stands for. So those are the balance that I think goes into the equation when we talk about which coin we support, what we care, what we don't necessarily what we necessarily don't have to pay the same kind of attention that banks do, just because we're in the public sort of blockchain field, so forth. So I'm sure that's what Alex meant, and I think that's what we stand for.
Speaking of the balance and imbalance around things, one of the main demand side reasons for privacy solutions is exactly to protect against centralized whales like Celsius, which could front run its own users, and nothing is protecting that from happening, because you're the portal for the traffic and volume as well as the underlying piping. And with something more decentralized and owned by no one, plus privacy built into the block transaction clearing process, you have a unstoppable financial instrument. You need both of those elements, I think. Speaking from the demand side.
I think that was a statement, and there was no question to address there, right? Yeah, I do think that we do say that there's such thing as a CeFi in the DeFi world. And yeah, I think the Celsius does stand sort of an in between that, this is a CeFi for the DeFi world. And I do believe though that, whether or not that was by design, by intention, I think, during the ICO sort of craze 2017 to 2018, and majority of these projects are gone, and a lot of, I think, projects had this concept that we build it and people come. Such sort of a completely DeFi concept, without actually having somebody actually managing the project for managing the project's sake, not so much that you get in the way of what the price of each coin does, or what coin to support, or where we're going to pull the weight, or whatever it is. That should be really left to DeFi. But I think any company, because it's a company, I think there is that sort of centralized, experienced management team should be sort of addressing certain concerns. And as long as this is, as long as we are all operating in some variation of a fintech world, eventually we're going to have to deal with some kind of regulators, because they will come, whether or not you like it, they will come, and they like to have the sort of certain doors that they can go and knock, They don't want to go to knock thousands of different individuals who are behind the privacy door anyway. And they would like to see how are you protecting these people, and for them to be able to go to specific people and then sort of have that conversation. It's much appreciated, and then that actually leaves, I think, consequently, that leaves all individuals alone. I believe that.
Before, I was going to say that I wanted to hear James's opinion too, because I know James is a very privacy passionate person. I don't know if he has a personal or near focused opinion. Either one would be great here.
Both. I don't speak for Near, same as I don't speak for Secret, but I think regulation is a big question mark for not only decentralized finance or centralized finance, but finance in general. I think we've seen craziness this week that leads me to believe we're at a tipping point, and we have tremendous demand for privacy because the current system doesn't work, because you have people just basically pickpocketing other traders, and this is why we have regulation to combat against these manipulative schemes on Wall Street. We don't want retail to get dumped on. Believe it or not, crypto is not about making the rich richer. At least I thought, when I joined this industry, we were gonna feed the people, get the pizza to the people, and hasn't been the case with DeFi, at least in my opinion. So I feel privacy is a huge missing piece, because otherwise you're just perpetuating the same problems that we're trying to solve.
I don't want to go ahead, man.
The same dream is get someone to deposit some dollars into their savings account and not have that be 2% APY, but have something more letting people get out of the cycle of poverty where they most need these financial services and they don't have access to them. And
I want to at least propose. I'm not moderating. I'm just proposing some sort of moderate in between for some of these things, because I can empathize with a lot of what Harumi is saying around the need for doors to knock on and the need for some centralized control in cases where you're trying to build systems that are sustainable. And then I can also appreciate everything that's being said around, we want to build a system that doesn't work like the old system. We're talking about slotting in a lot of these companies into traditional fintech, but we're seeing how the traditional finance system is not democratic and routinely screws people. And this week has kind of laid it bare in a lot of different ways, regardless of who you agree with in the whole Robinhood GameStop scenario. It's at least brought the conversation back to the front. But I don't think this is an either or. And I think that's what Alex was implying when I heard him speak. And I wanted to at least clarify my perspective on that. It's not a choice between everybody in the system needs to be anonymous and everything needs to be Moneroized. It's not these absolutes or this absolute of perfect transparency, because I don't think either scenario benefits end users. The reality is we're probably going to end up with decentralized and permissionless applications that run more like, permissionless protocols, and maybe they're user and community governed, or maybe enterprises have a hand in governing them. And you're going to have privacy protections that need to be built into those applications, because otherwise they're completely unusable. Any application that requires you to use private or sensitive user data that wants to be decentralized, you need those protections to exist to have this thing be decentralized. Otherwise, it's just another centralized application that somebody can exert outsized control over if they pull all of the strings. There's mediums in all of this. There's shades of gray we're going to have to explore. I just get frustrated when the conversation comes from, well, privacy matters, but we can't have a bunch of anonymous people running around, so let's stop the conversation about privacy. Privacy is about choice. It's about protecting people in the systems. It's not about just anonymity and hiding from the government and not paying your taxes. And every time I can correct that, I try to.
Well, let me ask you this, Tor, because I feel we often try to stop this kind of technology. And I wonder, if you can't stop it, we always use the word unstoppable when talking about some blockchains. And if you truly can't stop it, why should we try, and how can we address the challenges?
Well, we call things unstoppable. It doesn't make them unstoppable. We call DeFi decentralized. It doesn't make it decentralized, and it certainly doesn't make it finance. It just makes it permissionless leverage. So calling something's not going to make it that way. If we want protocols to be unstoppable, we have to build them to be unstoppable. And if we want to see if they're unstoppable, we have to attack them. And we have to see if they're vulnerable in the ways that we believe that they're vulnerable. And over time, it's an evolutionary process of attacking and iterating. And eventually, we're going to end up with the most robust possible protocols that benefit the most users. I at least believe in that evolutionary process, unless, of course, that evolutionary process is centrally controlled so that by the end of it, we only have three whales determining which exact systems we're going to be using for decentralized finance. And I'm not saying that that's an outcome that any of us are choosing or intending, but it is something that worries me because that's what happened in the legacy world. I am not confident enough that we've built in the right protections to not see it happen again.
Yeah, that makes sense. I think we use that word unstoppable way too often. We like to think of these infinite tokens that will last forever, and it's really not true.
I mean, everything is unstoppable until it stops, right? Every peg is meant to break the underlying mechanism, but how that happens is there from the beginning. It's just a question of when. Everything that has a beginning has an end.
But then how do you pitch it? How do you...
It's a rocket at that last moment. It's a rocket, and then it propels you forward. It drives evolution, but ultimately, how far can we get as a human race before we become extinct due to our own flaws?
So we're talking about sustainability. I'm curious, Harumi, how you think about sustainability with Celsius, because it seemed like you were implying that for sustainability's sake, or for these systems that we're creating to still be here in like 5 to 10 years, there's certain aspects where you do want these more like regulated organizations. So what do you think would make the systems that we're building in this burgeoning new financial ecosystem, like what do you think is critical to sustainability?
Well, I'm not saying that the regulation is necessary or not necessary. I did say, what my stance is that it is inevitable when there's so much money floating into some system, ecosystem, industry, it is inevitable that they come in. And then that's exactly what happened, right? Until the ICO craze happened, the regulators were like, Bitcoin, what is that? And then all of a sudden, like all these ICOs came in and a lot of projects are making so much money. That's when they decided to come in and say, this looks like and smells like a security. So whether or not we vote for them or vote against them, they will come. Now, and then how to deal with that sort of authority is up to the project. They can say screw with them, we'll take our chances, or say for the sake of sustainability and for our community, and in the best sort of interest of our customers, we will deal with them the right way, or whatever that you talk about, right? So that's something that you do. In terms of the project managing, sort of project operating smoothly, I do think that rather than saying the build and they come fallacy, I don't think that necessarily works. And then I think we saw that after 80-90% of the projects already failed since the 2017, 2018. And if you look at the majority of the projects that came out around that time that somewhat grew up in today's era, they all have somewhat CeFi, at least in the fintech sort of an area. I think they all have some kind of sort of management that is running the operations. So that's where I say, in terms of management, it's not a complete DeFi. There's always some kind of central group that will lead a project to make sure that it is sustainable, it is doing the actually the right thing for the community, and it's also these central people go out and educate people, because you think about it, how many people really know blockchain in today's world still? What is it, 5% of the entire population? Maybe even 3, 2? And I think it's on us to be able to say, this is what it can do. And then if you want to protect the privacy, or if you want to let go of privacy, that's entirely up to you. But this is what the technology can offer you. And then this is what the coins can do with you. And then within the whole coin range, there are certain, like, there are some that are utilizing the public chain, and then there are some that are utilizing privacy chain, a private chain. And what would you like to do because of the different consequences that you're going to have? I think that's all on us who are managing a project in the sort of like somewhat centralized way, to be able to communicate that. So I think that it's not completely one or the other. It is a combination of the two. And I think that's what I was trying to say at the beginning.
Indeed, that is one thing that CeFi mechanisms have solved elegantly, is this interchain communication problem. Without someone insuring your assets while they're moving in between these disparate ledgers, it's very similar to how these little trucks, they take ATM cash and bring it to one central location. Losses like that can be very very tricky. So since we have these two glorious protocols here, Near, which has its own sharding mechanism, and Cosmos, which was one of the first inter-blockchain communication standards. Just wondering if you guys see any alternatives to the centralized solution.
Well, I know the secret Ethereum bridge relies on a trusted setup, but the Near Rainbow bridge is trustless, and that means you can have a permissionless validation mechanism for the activity on that connection between Near and Ethereum, which really connects the protocols instead of just connecting the two networks. So I think that's really interesting. But if I may shill Secret for a minute, building on what Harumi said, it is a combination. I think one of the trickiest parts of understanding Secret is the duality of its public coin, Secret, and the privacy tokens running on the blockchain. So it's a combination which is easily confused when compared to the Moneros or Zcashes of the world. Secret is not a privacy coin, and it's accountable. It's a public blockchain with abilities to support all kinds of privacy preserving smart contracts. So I think that's a really unique approach that is underappreciated.
Yeah, not by me, but yeah, over there, sure.
Well, not by me either.
All right,
That's
Tor,
good.
say whatever is on your mind.
Rather than reiterate James's kind words, I mean, and yes, so this as decentralization and centralization is a spectrum. Private and public, is also a spectrum. Like this idea that we call programmable privacy is basically what we're all describing. The idea that certain things should be public, certain things should be private. The application developer and the user should have a choice. And I always say that like choice is really the pillar of privacy. When we're talking about privacy for users, we're talking about giving them choice. But this trustless and trustlessness nature of things, it's also a spectrum, and it's always a trade-off. There's always trade-offs between how centralized or trustless something would be and its performance or its cost or its usability. And we're all, as developers and entrepreneurs and product designers, trying to find our place on that efficient frontier to say, this is usable by users, there's demand for it, and it's going to function. It's also going to be compliant enough, but it also needs to be trustless enough to be sustainable and to be like a meaningful improvement on the systems that have come before it. And we, as an ecosystem, we're always trying to use the best of what there is. In the Cosmos universe, there's a lot of these kinds of developments underway. James is very familiar with Peggy, but that's like one of these efforts that's underway to further connect like blockchains at the protocol level, where you're not relying on like a proof of authority type of setup or, a single custodian. Or like, for example, RenBTC is effectively a single signer that's masquerading as MPC. But enough about that. I think that like we're going to see a lot of this kind of experimentation and all of these different kinds of implementations, and it's going to be evolutionary. And at a certain point, we have to see more trustless solutions win out in the market, and if they don't, that's because of some failure on education, or it's because of some sort of like other market failure. I don't know what. If we want trustless solutions to win out, we need to be educating users, and we need to be providing a meaningfully better experience. And if we don't provide that better experience, they just won't win.
Who's going to build the secret Near bridge? Cosmos Near.
What if I do this? Which direction is it? Is it over here?
We're both going to build it together.
I think Near as layer infinity thinks a lot about bridges. Secret as a privacy hub thinks a lot about bridges. But again, like, it's a different calculus for us than, like, it sounds like, Celsius is its own thing. And then Quid is like, you're also talking about something that's sort of inter-blockchain, right? Like, it's very interesting to see it on the product side.
The way that Celsius solves this problem on the product side is that it owns the ledger of the position on its own ledger, and it controls that. When you do inter-blockchain, you're kind of sending around an NFT that also has code baked into it about how each receiving chain should deal with the asset based on what kind of asset it is. And that way you have all these blockchains effectively sharing a DeFi spec without any of them having necessarily permanent custody of the individual user's ledgers. The centralized product, that's what you're kind of promised and guaranteed. It's always going to be safe. It's always going to be a database that we can take care of for you. And it is nice to have that guarantee for some types of users, I guess.
Well, users with billions of dollars, probably.
That they want
we're all lazy by nature, right? So isn't that nice that if somebody can just manage your money by kind of like, putting the money into a wallet? I mean, that's something. I mean, we are all solving, I think, different problems that we have. Problems as in different things that we can solve in the sort of financial services by providing our respective solutions. And in ours is, I think, a Celsius solution. Celsius problem to solve was always, how are we going to give the financial independence to these individuals by allowing them to make a little bit more money than 0.1% per year on their hard-earned dollar. And I would say that the fundamentals, the mission statement of Celsius is nothing more, nothing less than that. And while doing that, if we can use the blockchain solution to allow a little sort of like more independent sort of like way of managing your coins, isn't that nice?
At the end of the day, we are all shareholders of the same community of crypto devices. So,
and when it boils down, ETH is the common denominator to me.
Yeah.
And we think about Cosmos as the internet of blockchains. Meanwhile, they're busy trying to connect with Ethereum, and same with Near. So to answer the question from earlier, maybe we won't have to build a secret Near bridge. We'll just use Ethereum.
It's interesting. Fees willing. There's a lot of things that work on Ethereum, and there's a lot of things that don't, but it's definitely not for lack of effort, and it's definitely not for lack of community enthusiasm. Ethereum is a massive experiment that's working at scale. Whether it becomes a global settlement layer, that sort of remains to be seen. In the meantime, I think there's room for dozens of more experiments to be run, and at the foundational level of protocols, like with Near, with Secret, or at the application level, like Celsius taking one approach, Quid taking another. I think the best thing we can see from this conversation is that both of these applications or both of these visions can leverage Near and Secret and Ethereum, despite the fact that the visions are so different. There are components of each of these applications that can be leveraging our protocols. And that's really exciting because that means we can have experimentation at every layer of the stack, and should.
I love that moment where you said sediment and then settlement, because ETH, regardless of if it's going to be the application platform, it's the house of a lot of value, billions of dollars that have been mined in crypto. And regardless, it's going to be like an off-ramp for all of that to get out, at its least. It's always going to have to serve some function.
Let's hope.
us back to our time. Thank you, guests, for this panel. It was really have a nice day wherever you are, whatever time it is. And it was nice having you
Nice.
and chatting with you.
Thanks, everybody.
Thanks, everyone.
Good night.
Peace.
Thank you guys so much for that panel. We learned a lot. Up next, we have a panel discussing NFT money laundering. Stay tuned. It's going to get good.
Hi.
Hi, how are you?
Good, good, good. Haven't seen you for some time.
I know. It was a very busy day when we last met.
Yes, today is very similar.
The world in crypto got turned on its head the last time we did a panel presentation for the hackathon.
Yes. So let's see what this time happens.
There are things at play here.
Definitely.
We actually just put out an announcement of a webinar we're doing next Tuesday on domestic extremism and the impact that has on anti-money laundering compliance professionals.
Okay. Do we have a moderator as well, or how does it work?
I think that we are moderating ourselves.
Okay.
So I guess we should welcome everyone who's here today. I'm Carol Van Cleef, and I'm wear dual hats of lawyer and consultant with the law firm of Bradley and the consulting group of Luminous. I do a lot of work in and around anti-money laundering and sanctions compliance, and have been heavily embedded in the crypto and digital currency world for many years before Bitcoin and before convertible virtual currencies. For those in the U.S. who know what that term means.
Yeah, short introduction to me. My name is Jürgen Höbert. I'm in the blockchain space since 2014, deeply involved since 2017 in this whole NFT universe, down the rabbit hole since 2 years. I have a company which is called Tokenization Limited. I also own NFT.art as a domain because I'm active particularly in the NFT art space, where we all know, like if you talk about art is used for different things. Maybe the topic today is also like exploring money laundering in NFTs. I mean, I was shocked when I read the topic, to be honest, because what I would like to know from your perspective is, well, what is seen as money laundering when it comes to art, the art industry in general, and then maybe like as well, do we see something like this happening already, like in the digital art space, aka non-fungible token art space?
Well, let's start by setting expectations correctly. I think this is being advertised as NFTs, money laundering and NFTs, and we're not here to teach you how to launder money through NFTs. And in fact, this is really intended to be a session to help those who are designing and selling assets through NFTs. There are some very serious issues that need to be considered, and people are going to stumble, and people are going to end up in a lot of hurt. And our intention today is to try to help and ward off some of that hurt.
Yes.
So to your point, is in the world of art has long been seen as a mechanism or a medium for money laundering. And for high value money laundering through a variety of different types of mechanisms. And we could go into that a great deal, but what I think the short way to say how serious it's gotten is that there have been some studies done in the US and done internationally about money laundering through art. And we recently had a new piece of legislation, new law enacted in the United States that broadens our anti-money laundering statutes significantly. And one aspect of that law is to bring antiquity dealers in under our anti-money laundering regime, where they have to do the same kind of record-keeping reporting that banks do. What has not been done fully yet, but the stage is set, is to bring art dealers in under the same law. And there will be a period of study by our Financial Crimes Enforcement Network, which makes the rules in this area, about whether they're going to do it. But it's likely that will be coming not far behind the antiquity dealer proposal.
Yeah, I think if we mirror that over into the digital space and in the NFT space, so one could think like, I don't know, like last week we had a sale of an NFT. I think it was a Alien Punk, which was sold for nearly, what was it, like $750,000 which sounds completely insane. Also to like, I think in the recent days and weeks, we all heard about this NBA Top Shots, where like small video clips were sold for thousands of US dollars on this as NFTs, which basically even me like was questioning, is this like something that people maybe want to hide some transactions? Can it be really that crazy that hundreds of people are buying expensive short-term video clips? I mean, I myself I like collectibles. I have like, how to say that, artworks, traditional ones, but I also do have like sculptures, like pop figure sculptures as collectibles. But sometimes I even don't understand what's going on in our space. I think to tone down the expectation as well a little bit, I think this challenge is exactly what I was seeing now. So a friend of mine, which accidentally bought into NBA Top Shots like a couple of months ago out of curiosity. For me, it was like, I'm not interested in basketball, so it was not attracting me. But he's a big basketball fan. So he just basically called me like literally like, what was it, like 4 days ago, and he's like, I sold like two videos like for $7,000 each. And I was like, what did you do? And for him, as you said as well, it was like, okay, he has now sold something, and I warned him and says like, so to be honest, I mean, you're sitting inside the European Union. You purchased this kind of video clips for a small amount of money, and now you made $14,000. So maybe you be aware in your next tax application, you need to fill out what you have done. And it's not about filling it out. It's even more about how do you explain it to your tax consultant what you even did. Like if you explain to him like, yeah, I sold something for $14,000, which is an NFT, it could be very, how to say that, not understandable even for the tax authority what this is. So I think there will come in the coming years when all the tax reports are sent in different governments, they will all have a, how to say that, a little bit of experimenting and digging into it, what this is, because it looks like somehow it could look like someone was sending him money and just he was selling some overpriced digital item, let's say this way, which I find very interesting in one way.
Well, I have whether it's a new distraction or a new passion. I'm now on Clubhouse.
Oh, yes, me too.
And I don't know how many others of our listening audience are doing that now, but I sat in on a meeting, Clubhouse meeting, over the weekend, and it was on NFTs, and there was someone who was speaking who was in the process of conducting a live auction, and while in the Clubhouse room for the period of time that we were on, which was probably over about 2 hours, the auction was around, I don't know, $1,500 or $2,000 for a piece of art that had been created by this artist. And over the next 2 hours, the price got bid up over $35,000 or $40,000. And I stopped listening at a certain point, and I don't know where it ended. And I'm sitting there because the artist's expectation was really quite modest from what I could hear, of maybe a couple of $1,000s, maybe a few $1,000s. But when the numbers kept going up and up, granted, there was some hype around it and people wanted to be part of this process. But at some point he made the comment, well, I know so-and-so who's bidding, but I don't know who that other person is that's bidding. So as soon as I heard that, I'm like, oh boy, I hope that this person isn't in for a world of hurt. And the reason why is, at least in the United States, we have several different kinds of laws that can get at this and can expose the seller to real liability and sometimes criminal liability. As I said earlier, we've got this new law that's going to impose certain record-keeping and reporting requirements on antiquity dealers and potentially art dealers. And the question is going to be, if you're selling your own artwork online, because you can use this new technology, does that make you an art dealer? So that's one thing to watch. But in the meantime, you need to be aware, if you're a U.S. resident or U.S. citizen, that you are also subject to federal criminal statutes that say you're not supposed to be involved in money laundering or aiding and abetting or being willfully blind to it. So if someone comes to you and makes an offer for a piece of artwork that really doesn't make sense in the context of that piece of the artwork, if you don't ask the question, why are you paying so much for this? Or where is that money coming from? Or the crypto in this case, where is it coming from? That you could be deemed to be willfully blind and then be implicit in the criminal act, if in fact that person is laundering money. And what's interesting is that the hype that I think is now going on in the art world around NFT is not dissimilar to what we saw of the hype around ICOs back in the 2017-18 time period. And what happens is that we run into these time periods when there's been a lot of what we call dark money, money that's been gotten from potentially illegal activity that needs to find a way into the financial system. And those who are holding this kind of money need to find outlets. And they will start to, they'll look for whatever kind of outlet is available where there are the least controls, the least eyes on the transaction, and they'll take advantage of it until the time that those appropriate controls are put into place. And for those who are jumping into this NFT area, you need to be aware of that, because if you start accepting, the kind of money that you were talking about with the transaction that you watched, the 750,000 USD, those things don't make sense, and they're going to attract attention. And now with the tools that are available for doing the blockchain analytics, if someone's paying in crypto for the transaction, those funds can be traced. They can be traced, 1, 2, 3 hops away, and who knows where those funds might be coming from.
Yeah, this is definitely a good point, which I also question myself always. Is like, if I am as an artist or whatever, as a person offering, let's say, something on Rarible or even on OpenSea, and someone is buying it, in 99% of the cases, you don't know the buyer. So how, as you yourself as an artist, can protect yourself? I mean, like, it's similar to, I don't know how you think about it, but for me, it's like, if you're using Uniswap, which is decentralized exchange, I also don't know what kind of Ethereum I'm getting. You know what I mean? And so for me, the question is, let's say I'm putting something up on OpenSea or on Rarible, and something is bidding, what out of every reason, a non, how to say that, like in general, you sell something for 1 ETH or half an ETH, and then someone comes and buys you something for 100 ETH. So what you, as a publisher of an NFT or a seller of an NFT, needs to do even there. So like you cannot reject it. You know what I mean? It's blockchain. He sent you the money. You got it. He got the item. So you cannot really say, no, I'm not accepting your money. Is there any law, also legal cases already for this? Or is it just not happened so far that something like this came to a court case?
I'm not aware of any court case, any kind of even investigation around the NFTs, because this is an area that's just starting to explode. I would anticipate that obviously the law enforcement community is watching very closely any new development like this, as they've become more sophisticated in their monitoring of activity, will be looking for this. But these kinds of cases often can take some time to develop, and it could be anywhere from a couple of months or a few months to years. But the problem is that one has to be alert to it, aware of it now, because your activity could be investigated down the road. So it's time to take steps to protect yourself now.
So you basically could even be like utilized and without knowing it that you're involved.
Absolutely. And that's where this willfully blind concept comes into play, is that if you had enough information in front of you, that had you asked the question, you would have found out, but you didn't ask that question because maybe, oh, wow, that's a lot of money coming in, and I'm really excited to take that money in. And you decide not to find out where that money is coming from, especially when it doesn't make sense for the nature of what you're selling.
Yeah, this is for me also this point, like, like sometimes I have the feeling there's like a price gouging happening. So like you see like I think recently it was about, they're called crypto cubes. I don't know if you hear about them. It's a special kind of a collectible, and a person launched them, and then some people were buying like a large amount of them, and like like if you control the supply, you control the price. So that they play all these financial games with it, which is also for me like a little bit of like, okay, someone is misusing their, basically it's pure market manipulation. But the argument is always, it's like Pokemon cards. Like
well, you're actually raising a couple of additional issues here that are important for us to talk about, and that is, is your NFT truly non-fungible? There's a sliding scale there, and the further you move on that scale towards fungibility, it raises another set of issues. And one of the issues is whether you need to have appropriate licenses to be able to be selling and taking value in for it. And in the United States, we would regulate that under our state money transmitter licensing. So the closer you get to a fungible token, the trickier those issues get. And the problem is that as one of the great things about the technology is that they're easily transferable. And once you start setting up exchanges, then you also have to look at whether you're dealing with an exchange that's an exchange for value for money, so you're under the money transmitter laws, or potentially moving into a commodities exchange, or if there's a feature of the NFT that might in fact make it a security.
Yeah, and counter this as well. I don't know if you hear about, because I have you there, if you hear about NFTX, which is allowing you to package NFTs, and don't get crazy if I say this now, to package NFTs into an index fund. Did you hear about this one?
I have not yet, but nothing surprises me. So once, then the question is, what are you buying? Are you buying the NFT that's on top of an NFT?
No. What they do is basically they issue a fungible token, which has as an underlying asset like a fixed defined amount of non-fungible tokens.
It could be considered potentially a derivative product.
It is technically, but everyone is saying it's decentralized, so I don't care. Like, this is the argument.
Well, I think there's again, there are a lot of very tricky issues to be, one has to very carefully sort through. Because our Commodity and Futures Trading Commission has taken the view, as some may have seen in the BitMEX case, is that if you're in fact trading, have an exchange that's trading derivative products, that you need to be registered as a future commission merchant, and the failure to do so also leads to some very serious consequences. So while the technology is there to easily build an exchange on which you can trade these things, you need to understand what the function of that exchange is, what jurisdiction you're in, and how that your jurisdiction looks at the function that is being performed.
Yeah, I sometimes really think like what we encounter at the moment in the NFT space is like, also, like you can now lend against your NFT, and I mean, it's fully collateralized, so it's not a problem. But I sometimes think technology is empowering the people so much, but they're not thinking about if it's really like in a regulated framework they are operating or dealing in. And I mean, like, it's even in the NFT art space. I mean, if I look at it, particularly like on the higher end market, like Nifty gateways or so, there you basically need to do your KYC and AML, which I can, how to say that, I'm like a little bit like, okay, I understand. And if large money moves, I'm like happy. I'm happy to do my KYC and AML, but I don't want to, basically, as I said last time as well, I don't want that I need to do everything, you know what I mean? But if I'm looking then, for example, sometimes on the Rarible, and I'm seeing like people just selling literally rubbish, and for me the question is like, how many of those people are even just selling without knowing they're doing a commercial operation? Because as we know, as an artist, you normally generate art for the purpose of art. It's a little bit different than if I'm selling something as a collectible, because a collectible is purely made for the purpose of selling and stuff like this. And I think some of the people there, they are just selling it without having any business or setup or anything like this, you know what I mean? So which brings also to like a large amount of problems in the mid to long term. But everyone feels protected because, it's a pseudonymous name they are using most of the cases. They're not visible. You don't know who they are. And so none of the jurisdictions would feel responsible for what they are doing.
Wow, you've just said a lot there. I guess what I would say, coming from the lawyer's perspective, is, again, you have to understand what you're doing and what context you're doing it. If you're selling something to someone you don't know, at least in the US, you've got another issue that we haven't even talked about yet, which is sanctions. So we've got the potential that you're selling to someone who may be engaged in illegal activity and is using you. So, that's what you want to guard against, is being used by somebody else for criminal activity, because you can still be implicated in it. The second is the sanctions. That our sanctions laws are such that you're generally prohibited from doing business with someone who is on the sanctions list. And one of the things we found over time is that whether it's people who are on the sanctions list, especially named our SDN list, the OFAC list, as many people know it, or maybe in a country that is subject to sanctions like Iran in from the United States perspective, that if you're engaging in transactions with them, you're violating the law, and nobody's going to come and ask you what your intent was. If you do the transaction, you're guilty. And what we have found over time is that in many of these places, people coming from sanctioned countries are looking for any opportunity that presents itself to get into mainstream financial circles. And if you're offering for sale an NFT without sort of guardrails around making sure you know who you're doing business with, you're going to find yourself, you potentially, again, being used for someone who's trying to evade sanctions. And quite honestly, OFAC has been a much, much more aggressive regulator or enforcer, and coming out and prosecuting people for those violations. And the fines can be very substantial.
But isn't like the platform responsible for it, or is it me who is responsible for it? Because it's like, you know, I cannot, like on eBay. Okay, eBay. If someone buys on eBay, I also cannot control if it's like, how to say that. Okay, I think on eBay they need to register. The problem is all those marketplaces there, basically you don't need to register. You just send money and get the NFT back.
Well, the issue is what the third-party market, the exchange, is doing. And if they're doing a certain level of due diligence on the people that they're doing business with, you may have a certain level of comfort. But if they're not, then the burden is going to pretty much fall to you. And I guess for everyone should be aware that law enforcement and OFAC have tools available to them now. So if the transactions are being paid for in crypto, especially with Bitcoin and Ethereum, that those transactions have a certain degree of traceability to them.
Yeah, sure. That is. I think that everyone is aware about that nowadays. Yeah. For me, another question is that, do you see that this is a growing problem which is coming? Because, you know, more and more people are coming in that space, and you know, like in the meantime, I had a very deep look at something like Coinbase, and I find they are acting very safe. So, do you expect that something like, you know, if you talk about what is it, like Nifty Gateways, which is more or less, I think, a US company, do you see there is like a more legitimate place to exchange NFTs and a more like I would not call it a dark place to exchange NFTs?
Well, I think that's where Gemini made a very bold move by acquiring Nifty and brought it within the context of a regulated exchange. I know that, again, because the technology is such that it's accessible, that you're going to have a lot of new exchanges that are going to be popping up for purposes of offering NFTs. And the view is going to be taken by people who are creating these that this NFT exchange isn't a cryptocurrency exchange. Yeah. And I'm not subject to regulation the same way that you hear a Coinbase is. And it's going to take a little while, I think, for this to sort out. But the problem is that those who are going about these activities are going to be held liable from the day that they start. So even, again, if the regulators don't catch up for it for 6 months or a year or even 2 years, or in the case of a case we saw recently with, is it Hero Coin, that FinCEN took action, our financial crime enforcement. Was it Hero Coin, the one that happened back a few months ago? FinCEN took action against the creator of the coin and the transactions, and that dated back to 2012, 2013 activity, and they finally imposed a fine even after the creator went to jail. So it takes a very long time for these cases to work out.
I didn't know about that one. Oh, that was the Bitcoin ATM thingy.
I have the wrong name.
Mohammed's Bitcoin ATM, which advertises itself as Hero Coin. Yeah, I know it, because I know a project which has, stupidly enough, a similar name to their Hero Coin, and they got mixed up with them, but they have completely nothing to do with this. I didn't know that go that far. Interesting.
Yes, it goes back years and years and years. And in fact, recently FinCEN took action against the compliance officer of one of the major banks, one of the largest banks in the US. And the actions that were part of the FinCEN action dated back to 2005 to 2008 time period. Oh, it was Helix, excuse me. It was Larry Harmon, DBA, doing business as Helix, that was subject to the action. And that came out in October, November of this year.
But how do you see, we originally, the idea of all this was like decentralized, more unregulated, and now we are talking about using all this technology and putting it in a complete regulated framework. So is this the end game, or?
I'm not sure what you mean by the end game.
The end game is, it's a little bit like, what is the purpose of building something decentralized when in the end we're completely regulated?
Well, I guess the question is, how decentralized are we at this point? And I know that US regulators typically are taking the position that there's not much at this point in time that's really truly decentralized. At some point, we may move in to a true decentralization, but the critical piece, they'll be looking at different pressure points along the way. So it may be the exchange on which the NFT is trading. It may be the creator of the exchange. Certainly,
well, it's like simply like, if for me it's like NFT trading. So like, you're not trading it, you're just selling it. It's just like if I'm putting up on a website a picture and I'm selling it against money on PayPal. You know what I mean? For me, it's just more like a Shopify. It's not really an exchange. Or is this like a misunderstanding from my side?
I guess you have to walk through the transaction to understand, but if you're selling it, so let's think about selling a car. If you go out and sell a car, and you sell a car to someone who is coming to you with money that they just got from a bank robbery or from selling illegal drugs, and they give that to you, you're going to be part of the money laundering transaction. Because just giving you that money that they've taken from an illegal activity becomes money laundering. So you have to look at every step in this process as a potential step in a money laundering process.
But for me as a normal person, it's not doable. Like say I put up an NFT on OpenSea, which is a open platform. Someone comes and buys it. I cannot, so there are no tools for me as an end consumer to trace back if that person who bought it was involved in anything, or let's say even that address was involved in anything. And like those people, they know their ways, what they do. I mean, for me, it's normally if something comes out of an exchange, hopefully it's clean, because even if I'm trading on Binance and they send me ETH, what do I know where they have the ETH from? It's coming out of their pool. It's not like, like if I have a 10,000 ETH in a pool, I cannot say which ETH I got. You know what I mean? It's not like that easy. Like if you have a stash of money, I cannot say this is the illegal ETH and this is the non-illegal ETH in the stash of money. This is for me what I'm not really completely can follow, because then technically all the crypto money is illegal. You know what I mean? Because it's there's not like I cannot touch this. If I have a purse and it's 1,000 ETH, then I don't know which one of that 1,000 ETH I got. It's not like this is the $100 bill which was involved in a robbery, but this is the $100 bill which he earned like legitimate. I cannot really dissect it.
You're raising some very good questions and some real challenges, and also highlighting what we what's at stake as we move forward in this discussion, because this technology is so powerful that it allows you to go straight to the market and sell in a way that you could never sell before. But as you said, then what kind of a burden do you take on? And again, the way, at least in the United States, our prosecutorial community looks at situations is on a sliding scale. So that if you say, I've got a piece of artwork and it's probably worth $100 or $200, and that's what you sell it for, and that's what comes in, and it's regular activity for you, then you're probably not going to hit anybody's radar screen. But if suddenly, that $200, what would have been a $200 value or euro, is now suddenly being sold for that 750,000, that's going to attract attention.
Yeah. So basically,
I think a number of things are going to evolve over time. And one of the things we're hoping is that the technology in and of itself will start to build some controls into it. And it may be that you'll be looking for people who are more or less approved buyers. That there'll be systems that'll be created that allow you to have a better sense that crypto that you're taking is not coming from a tainted wallet. Isn't tainted coming from a wallet that might present problems.
Because for me, this is if you, how to say that, like, I'm in the crypto space since more than 6 years. How do I know? You send your money through endless exchanges, decentralized exchanges. You participated in, how to say that, in token sales. So you're not even able to track everything which was happening, to be honest.
Well, we're definitely in uncharted waters in this area. And as I said, there are going to be a number of challenges. But one of the changes that came in this new law that I mentioned earlier, for those of you who may have been tracking, it's the National Defense Appropriations Act. It's the bill, the piece of legislation that was vetoed by our former president, and then Congress overrode the veto to make it law. And in there, it was about a 5,000-page piece of legislation. There are 230 pages that make some very significant changes in our money laundering statutes. And as I said earlier, one of the changes is that it's going to pick up, I think I said here earlier, it's going to pick up anything that substitutes for value. So while our laws, our regulatory system has been sort of bootstrapping for the last several years in the world of crypto, they now have for the first time clear legal, clear law that says that they can regulate crypto. And the proposal we mentioned earlier on that came out on December 18th preceded this law coming out, but is strengthened. The proposal itself is strengthened by the new law. And one of the key elements of this provision is that it's going to require banks and crypto exchanges to report transactions in excess of $10,000. What a lot of people don't realize is a lot of people know that the banks and money transmitters now have a requirement like that if they are dealing with fiat cash transactions. What a lot of people don't realize is that we also have that requirement on any trade or business. So any trade or business, going back to our car dealership or a retailer that has somebody walk in with $10,000 in cash, they have to file that same kind of report. And so I think one of the things that'll be interesting to watch is whether they start to require, we have somebody joining us here.
Hi. Yeah, unfortunately, we have to end the stream, so I do apologize.
No worries.
It was for 7 o'clock,
okay.
so I do apologize for just jumping in here, but we are over time.
One thing real quickly,
if you want to do closing statements,
okay.
that would be wonderful.
We're
Okay.
right now in a situation that we have to watch very carefully, because we may see this $10,000 or more equivalent requirement come into play for anyone who's involved as a trade or business in handling crypto. So if you're selling your art as a trader business and you do a transaction for in excess of $10,000, you may be required to make this filing in the future.
Well, that will, how to say that will bring a lot of complications into it. Let's say it this way.
But very quickly wrapping up is that there are steps that those who are involved in the business of selling art should be considering taking, even before we have clear laws that say you have to have a compliance program in. If you have a compliance program in place that has at least some basic steps that you're taking to protect yourself, it really is all about protecting you as the seller. Jürgen, your closing comments?
Yeah, like for me, it's just like how to say that, how to explain that. I find regulation good, but over-regulation I find horrible, to be honest. I know it's sometimes not possible, and you know, like how to say that. I agree with you if it's going in this direction. If you transfer serious money, there needs to be some control, definitely. But also too, you know, you can see this as an how to say that. For me, it's a little bit like eBay in the beginning. I don't know if you know the story of eBay. In the beginning, people were selling like tons of stuff on eBay without even recognizing they are basically doing a business. I don't know if you were aware about that, but in the early days of business, like eBay, even in Europe, is like a ton of people were selling, and then it's like at a certain time, like 2 years later, the tax office said like, what the hell are you guys doing? I mean, you sold like 200 pieces of whatever on eBay. That's not your average, you know, like you did your clean out on your seller and starting to sell like 2 or 3 pieces. That's like commercial operation. For me, I think this is one of the biggest issues I see which will come to this NFT space, that people are basically, you know, like even if you trade, hold, and flip NFTs, a lot of people do this just as a, how to say that, as a side shop. But the challenge with they're facing is if they're doing it for the purpose of making profit, it can be seen as a business operation. You know, there's a difference if I buy one NFT, but if someone is going out and buys like 20 NFTs an hour and flips it within the next 5 hours again, so that's like more like a fully commercial operation. So this is where I see like in the first level of how to say that, like where we see like some challenges ahead. All this other stuff where it's about, okay, making everything traceable, I think there will be some, how to say that, spots in a way. And as you say, it's something like if you're like selling on Nifty gateways, you most likely know what you get because both parties are okay with it. If you're really selling in the wild west, something is basically you're going to somewhere in a city and saying, hey, here I have a car who has $10,000. Give me the $10,000. I don't care where they're from. I mean, I understand completely what you're meaning. And it's exciting definitely to see how this will be taken by the community, because so far the whole NFT space is still like very, very tiny.
So Jürgen, how do people find you?
How do people find me normally? You mean on the internet?
How if somebody wants to reach out to you, what's the best way to do so?
Oh, the easiest one is on Twitter. Just search Jürgen Höbert on Twitter. That's the easiest one. And then like www.nft.art. There's also like a Telegram link, or tokenization.limited, which is my company.
Okay, and I'm Carol at Carol_Van Cleef on Twitter, at Original CVC on Clubhouse, and Carol.Van Cleef Luminous Group, or C Van Cleef at Bradley.
I think we were yesterday in the same group, actually.
And who knows, was it GameStop the subject?
So I think the Black Bitcoin community, the GameStop stuff, something like this. Was it this? Yes. Yeah, they have sometimes very radical.
Another example of technology getting ahead of the regulatory community. So it's just as an example, we've got a lot coming. I don't kill the messenger here. I've got a lot of experience of anticipating where it's going, and I've unfortunately dealt with too many people who found themselves on the wrong end of the stick because we haven't dealt with the issues sooner.
Okay.
So with that,
Thank you very much.
It's been great. We'll have to do this again, Jürgen.
Yes, definitely.
Thank you.
Thank you.
Bye-bye.
All right, that wraps up day 2 of our Miami Blockchain Week Hackathon presented by the Blockchain Center and Zap.org. Thank you all for joining us on our live stream. Remember, if you like what you saw, don't forget to subscribe and hit like below. You can follow us on all of our other socials, join our Discord group, join our